Shout out to you, Jared. Jared, I'm just on here, but I'm not trading today, Jared. I don't think nobody is. Waiting to see what happens with this deadline with Trump and Iran. That's gonna really change a lot of things, bro. So I just hopped on here to get the chart set up, and I'll be jumping in back and forth a little bit, today. But I don't plan on trading today, bro. I'm gonna sit today out, wait for some normalcy to come back. Todd, how you doing, bro? I was just explaining to Jared. I'm not gonna Shaka, shut up, boy. I was just explaining to Jared that I'm not gonna trade today. I had a feeling that the yesterday was gonna be like it was, just a straight nothing burger. I still have my levels. I adjusted them a little bit, but with the deadline given to Iran and the inevitable turn that none of us are prepared for, that could potentially happen. You see, yesterday we just had a straight sideways day. So I don't plan to be involved in the market at all today. I'll be watching from the background, but I'm not fooling with this in no way, shape, form, or fashion until after we see what 47 is going to do with this ultimatum and this deadline that was given to Iran.
Going up in anticipation.
We'll get Delta tomorrow. Hopefully some clarity on how the airlines at least are thinking about oil.
It's funny that advanced is so good. I heard people say in the last couple of days, at least it's Ed will be our pillar. And I've been coming back saying, as great as Ed is, there's still something that they fly on. And that is in short supply. By the way, diesel, jet fuel, these are all things that did not turn out to be energy self-sufficient.
Yeah, that's again, as Semblus said yesterday.
Yes.
Not the firewall we think. There's a look at the bell at the big board today on Wall Street. Oceana Gold Corporation, a Canada-based gold and copper producer, celebrating its listing. We'll talk to the CEO in about an hour. At the NASDAQ this morning, it's Greenland Energy, an energy exploration company focused on developing Greenland's hydrocarbon, with an emphasis on the Jameson Land Basin. And at the CBOE in Chicago, trading firm Acuna Capital doing the honors this morning. Jim here. So once again, just shy of 6,600. Really haven't moved a lot in the last few sessions. Actually, S&P's riding a 4-day win streak.
Yes, I think that there are people who just say, look, nothing's going to happen, or there's going to be a deal, and nothing going to happen or deal. There are 2 out of 3. And the third, which could be this, sending them back to be the Philistines, a culture that just vanished, is extreme. And a lot of people feel, I think, that, they'll go to CBOE and buy some options, protect themselves.
Well, that's interesting. Today, Schaefer's looks at the option market risk premium is kind of gone, as traders kind of think we're going to wind up around here as opposed to more escalation.
I don't know. When I got up, oil was $4 lower, and these are real prices. And oil's up 32% in 1 month. David, when oil's up 102%, okay, for the year, it's very difficult to talk about what the valuation of Anthropic, which isn't even public, could be.
Why? I want to talk about it. Why would that be hard to do? I can tell you right now, it's a $30 billion run rate, probably going up dramatically from here if things continue. Now, I don't know that they will at the rate they have, but you could be talking about a company that's has a run rate of revenues towards the end of this year at $70 billion. What are you going to pay in the public markets for that, Jim?
Well, whatever it is, it's going to come out of other stocks, because if that's added to the S&P, and we're all trying to figure out what the S&P will do. How will they rebalance? Because we do not have enough money for that to happen. We do not. That and SpaceX is going to be.
I mean,
it could be if they price it.
You could make an argument again. Who knows, right? 30 billion run right now. Obviously, that's based in the last 28 days. It just keeps going like this at Anthropic. I don't know if it will, but you could argue, put a multiple that's not 13 times revenues. You get to $1 trillion for an IPO for Anthropic.
Okay, so
and
SpaceX,
you got OpenAI coming, and of course SpaceX coming potentially as soon as a few months.
If they only do 5%, they can't do 10%. Bring SpaceX public. Do 10% is just too much money. So that's bring, say, 5%. But then it's a sliver deal. So let's say the stock opens at 2.5 trillion.
Why are you so worried about where the money's coming from?
This is what everyone's worried about. I'm not worried about it. I echo what other people are worried about.
Explain it to me.
Okay,
I mean, there's an awful lot of money in money markets.
Didn't we go over this yesterday?
There's a lot of money out there in general.
We did this.
I know you did. And I continue
I'll
to
do
question
it again.
it.
Okay, so if you can get early listing the S&P, well, it isn't like the S&P.
Yes, you're going to get included in the S&P.
They don't have 10% cash sitting around. Like, oh, wow, look at this. Let's put some of the money to work.
The managers who have the index funds that follow the S&P.
Right. So we need to know what the ratio is. We need to know what the syndicate desk is going to do, because they could pop the stock, right? If they just do. Do we need to know? This is the other thing. Will there be no lockups?
I don't know, but it is taking an interesting approach. And obviously, it's always the case with a Musk company, it would seem, and what the lockups will be, whether there'll be immediate inclusion in the index. And by the way, reporting from Reuters has it that a lot of it will be sold to retail, as opposed to the typical breakdowns in terms of perhaps as little as 10%, 15% to retail. This could be as much as 30% or more to retail investors.
I think retail would hold it. Hedge funds would kick it out.
Yeah, retail
but the
will
long
most likely hold it. Yeah.
No, I mean, that's why it makes a lot of sense.
But at a $1.75 trillion value, I don't know if this thing's.
Now it doesn't matter.
Listen, it's months away. We'll see. We're going to probably get a real look at the financials of the company when the S1 is made public. Let's call it a month or so from now.
But David, you understand that they're going to have to take capital away from all of these big cap stocks.
I get it.
So if you're buying Microsoft right here, and this deal happens, Microsoft is not going to be at the price that it's selling at. It's not, you're just like, wow, Microsoft, what happened? So of course it's down again. What the hell is going on with that thing? It's 370. Well, how did Microsoft get to 325?
Yeah.
I mean, that's my big worry.
Well, today Morgan Stanley's Mike Wilson again defends Mag 7, says there's a group they're trading 24 times. Staples is 22.
Very cheap.
Even though the Mag 7 has 3 times the forward earnings growth.
They're very cheap, but they've lost their luster. I mean, they're very cheap for reasons. And someone takes a shot today at Apple. The Apple Store not that good. Although the
Nikkei piece
the
on
fold is not
delays on the
delays in
foldable
the foldable phone. I mean, people don't like it. I mean, they don't like Apple till it goes up to 300, and then suddenly they like it. Thanks for nothing. Alphabet continues to plug along. I like Alphabet very much, but there are a lot of people who say, shh, be careful on Alphabet, because the next thing you know, Gemini is going to be passed by. I mean, I think Gemini's fabulous, and it's also the fastest. But you know what? I'm fickle like everyone else, which brings me back to Claude. That's not a fickle group of people. They're on Claude. They're not going anywhere.
Isn't the idea that in the enterprise you can't afford to be fickle?
You have to be with Claude.
Right.
Everyone wants to be. I don't hear anyone with anything else. By the way, I mean, someone said to me that day, Jim, you like that Amazon? Be careful, retail's weak. I said, look, Walmart, Costco, and Amazon are the 3 retailers, and you do not know whether it's weak. It's one of the most closely held secrets in the world. Amazon does not leak anything. It is just, I mean, people just say, well, listen, I was talking to Amazon. Well, you better be talking, the only thing you can talk to an Amazon is Rufus. And Rufus is poorly behaved.
Who's Rufus? Rufus?
You don't talk to Rufus?
No, I don't talk to Rufus.
Why not?
I don't know who Rufus is.
Rufus, I said, listen, I was asking Rufus for help on sneakers. Rufus was a great help.
I'm glad to hear that.
Well, you don't even know what Rufus is.
No, I don't. No, I don't.
He's like, what culture do you belong to?
I don't know what culture I belong to. It's a good question, actually.
The Philistines.
Subculture.
Or the Phoenicians.
Yeah, the Phoenicians. Yeah.
I like that. That sounds good. Do we not do well, the Phoenicians?
Well,
right.
Yeah, you got to check on. You got to Gemini.
Do you want to move on to UMG, insurers?
Yeah.
We got some news to cover this morning.
Private credit?
Bill
You haven't
Ackman
mentioned that, but-
no, I don't want to talk private credit right now. We got to hit the insurers, and we got to hit this non-deal for Universal Music Group. All right, it's being headlined as some sort of a takeover. It's not a takeover. Bill Ackman has made a proposal of a company that his funds own roughly 10% of. It's helping the stock a lot, but really the way you should think about it is it's a non-binding proposal to merge current Universal Music Group with the Spark Holdings that is controlled by Pershing Square. But basically, the shareholders would still be the same shareholders, except they might try to take out Bolloré, who owns 18+% of UMG. Is that making any sense to you? Probably not. But it's really a leverage recap. They're going to borrow money, buy some stock from current holders. That's the cash payment, and then this thing will trade in the U.S. Conceivably be included in indexes, like which we've been talking about. And so you have a change in jurisdiction and listing. You have a leverage recap. And then you have a lot of projections from Bill Ackman as to why, if it's better run, it will do better. That's kind of it. It's going to require a 2/3 vote. When you look at the math, by the way, let me go through this. 2/3 UMG shareholders will be required for those attending. And then I mentioned the Bollorés. They could block it if the turnout is 84% or less if they don't want to go along with it. That said, it could present an opportunity, again, for this family to get out and to get monetized to a certain extent. Will it happen? Not if management and the large holders don't want it to. If they support it, then it might happen. But it has to be friendly to work. And then you get on to the idea that it's been mismanaged and it's undervalued, and those are the arguments that Pershing Square is making, that Ackman is making. They may certainly be valid, but these headlines that have it as some sort of $60 billion takeover offer, I think, are misleading, to say the least. That's not what we're dealing with here when you actually look at what we're talking about, which is a leverage recap and a move of jurisdiction and listing to the United States.
Why have they been doing so poorly? They have the best slate.
I don't know why. I mean, there certainly could be some validity to what Ackman is saying in terms of current management. He's also saying the Spotify stake is undervalued there, and he wants them to potentially monetize that as well.
It seemed pretty realistic.
But, it's a proposal. They need large shareholders and/or the largest to go along with it, not to mention management. We'll track it and see what happens. Jim, you want to talk about CMS and the finalization of the 2027 Medicare Advantage and Part D payment policies?
When it was first announced, everybody said that it was, don't worry about it, it's going to go up, and then it went up.
And then it went up. You may recall the day when we were talking about what was a significantly lower rate.
And we were thinking that
CMS,
Dr. Oz,
the Center for Medicare and Medicaid Services, had initially released in terms of what it's willing to pay. But that came up across all the programs, and that is helping many of the stocks that were suffering that day when we kind of said this could certainly change.
Yeah, and Humana and CVS. Humana's got a big Medicare Advantage business, so that stock's doing quite well. I like CVS because I've got to tell you, that company is the survivor of Rite Aid and Walgreens, and they're doing a lot of great things. This David Joyner, have you spoken to him?
At CVS?
Hitter.
I have, but not in a while.
Guy's a hitter.
Yeah.
And he's making it so that CVS is going to be America's drugstore.
I'm just looking at a note from Goldman here on this. With the final 2027 rates ultimately improving by what they call 239 basis points, they expect UNH and CVS will anchor their commentary on their upcoming earnings calls to advance a message of confidence in now driving margin expansion on a multi-year basis. And so that's kind of what you're dealing with this morning in terms of some of the commentary around this, and obviously a far better rate than had initially been the case.
But it is important to remember next time this happens, when someone says, listen, this is just the first, maybe it's an opportunity.
Right, either don't sell them or wait and buy them back.
Right. But there are so many signs, David, that some things are slowing down. I mean, I keep seeing these dollar stores, which is, you know, they're a very good indicator of what the people are really thinking and doing.
Yeah.
They're not doing very well.
They're not.
Just not. But Walmart's doing well. The stock doesn't reflect it today. Costco's doing well because remember they've got the inexpensive gasoline, so people sign up because of that.
Yep.
And then of course there's the elusive.
Well, is it? I mean, higher fuel prices starting to really hit more than broad-based way in the consumer, right?
Is.
I mean, it may not be as large a percentage of everybody's budget, but it's still a not insignificant percentage. And when it goes up as much as it has,
I think that we
that
have
hurts.
to start. That's why I look at those as very good examples of what the consumer's really doing, and it's not reassuring. Okay, and you know I want to reassure, but it's not reassuring.
Well, it reminds me of ISM services yesterday, Jim. The employment component fell almost 7 points, one of the biggest drops since COVID. And then prices paid went up almost 8 points. So very much a twinge of stagflation in the survey.
And then when you think about the new Fed chair, what a difficult position he's in. That inflation going up, and you should try to cut if these numbers. I mean, if the dollar stores aren't doing well, then that's an example where you got to dig in and say, hey, what's going on here? Maybe I need to cut. But then you see the inflation numbers, you say, God, I can't do that.
It's definitely a rock and a hard place. I know you saw the Seaport downgrade of Toll and Horton, where Jim, it's not about prices really. It's about, in their view, weak job growth. And you got starts still almost 20% above past recessionary levels.
And we are dealing with really fine companies. This is not the Toll Brothers of the old. Not that Toll was never bad, but but Toll Brothers, Lennar, these are really good companies, and they've become very acyclical. But the average house is 44 years old. You would think that people are trying to sell it. And, people aren't doing renovation repair like they used to. That's a market that's entirely stalled. And when you hear Gary Friedman, I know a lot of people went, he was too bombastic with all the different things he was doing, but he's right. The turnover, there's just no turnover in this country, and that's something that again, a Fed chief has to care about. There's no turnover. Wow. That balance sheet's not as good too.
Yeah.
They bought back a lot of stock.
Did they? I assume they did that higher.
That was a $700 stock at one point.
That balance sheet, you don't want that balance sheet.
Still like that showroom down, and it's really nice.
Oh no, I love it.
Yeah, it's beautiful.
It's an Instagram.
Down in the meat packing.
It's Instagram.
That's great. Guys, real quick.
The Gilead deal. What are you going?
No, P-Sky, Paramount. I did want to
just big today.
No, it's not big, but it has the stock
Top
up.
10 S&P.
It has the stock up almost 7 or over 7%. You remember yesterday I was reporting on the $24 billion or so that's going to be raised in terms of towards the equity of some $44+ billion going towards the purchase of Warner Brothers Discovery, being raised from outside investors, from the Saudis and many others. And it initially we were told in filings they were going to be buying stock at $16.02 a share. That has now been changed. The purchase price per share for each share issued in the equity syndication now was going to equal the 20 trading day average of the daily volume weighted average price determined as of the third business day prior to the closing of the merger with Warner Brothers Discovery. Ceiling $16.02, floor $12 a share. And so the price conceivably is going to be lower for those who are contributing towards, obviously, the purchase of Warner Brothers Discovery in terms of the equity check there. It's no longer going to be 16. It might be, should that 20-day average actually be 16. That's the ceiling. But it could be as low as $12 a share as you take a look at shares of Warner Brothers Discovery as well. Remember, it's a $31 all-cash deal. It's actually quite a spread there when you think about it. Real questions about the California State AG, whether they're going to seek an injunction, whether that will have the effect of delaying the deal in some way, whether you'll start to get that ticking fee. But you annualize that, that's a pretty good rate of return at $27.36 on a $31 deal, depending on when you think it is going to close.
I'd rather take the rate of return of Netflix, which is doing quite well.
Yes, Netflix shares have been on the move. There was some positive commentary yesterday. The stock now up almost 6% for the year, and now above. I was keeping an eye on it. Remember the bottom of the collar that they originally had when their deal to acquire Warner Brothers included stock, which they then moved to an all-cash deal. But it's now exceeded that, and obviously far above the lows it saw there, where it was in the high 70s.
Yeah, boy, that was an opportunity.
Before they walked away from their transaction.
Well, I got to tell you, Carl, there is this unreal move right now among the data center, like Dell, just quietly going higher again, as if let's just party. We don't care what's happened, but if nothing happens, we got to be there for a giant move. So let's start buying now. It's almost as if these postings are just being ignored, and I don't know. I find them harder and harder to ignore.
Well, up to now, you've attributed Dell's strength to maybe some share shift out of Supermicro.
Well, I still feel that way, and there's a lot of negative stuff about Supermicro coming back, but we're starting to see that same group of the Seagates of coming back, and even NVIDIA, which I know David thinks is just an obsession of mine, is beginning to make a move today.
Guys, real quick, if I could just come back to Paramount, because I wanted to add one key thing. No, you've moved us away, but I'm going to come back to it because I didn't include something, and that's one of the key reasons why the stock is up. There are warrants here as well, so shareholders are going to get warrants to buy a share at the same price as the sovereigns coming in. Now, again, right now it may not look that good, but you get something, and they're 10-year warrants. So you get those opportunities as a current shareholder to get those 10-year warrants, the same price that the sovereigns are going to come in at in terms of the equity check that they are doing. That's it. Just wanted to add that. That's why the stock is soaring.
Yeah, leading the S&P.
Yeah.
As we go to break, watch bonds today. Durables were not bad, down 1.4, looking for down 1.1, but X-Trans beats with by about 0.3%. There's a look at what yields are doing at the moment, but near 1% declines here on the NASDAQ, and the Dow with some early lows down 320. Biggest decliner on the Dow at the moment is Apple with a Almost a 4% move, going to take you back to the 200-day. Not quite, Jim, to the Monday low of 245.
No.
Not much on the tape other than this Mac Rumor report about pricing negotiations, sticky, and these foldable phones.
And the foldable phone, but I mean, from the company, it doesn't sound like there's anything. This may be actually, I hate to say, I mean, look, ahead of the war, you don't want to, but I like the stock very much. It's kind of an interesting level. You mentioned 200-day, and I just look at Apple and say, if you don't own it, I mean, we got a lot of good stuff coming in Apple. That's been the one Mag 7 that I think has a good story.
Yes. Yeah, one of the mildest Mag 7 declines.
I got the Mac Mini. I don't know if you guys have gotten this new line. Oh my God, if you're like one of these people that's on TikTok or anything, this stuff, or on Claw for one of them, it's PCs. It's their stuff is so back. It's so exciting. People should try it. People should go to the store. They're really excited.
We will get Stop Trading with Jim in a minute. It's time for Jim and Stop Trading.
There's a fabulous piece out today. UBS upgrading hold to buy Morgan Stanley, and they're talking about best-in-class IPO. They're going to have some very sexy IPOs. They're talking about tremendous growth continuing in wealth management. And they're also talking about just, I don't want to use the term that they use, but a huge amount of M&A. I think David may agree with me. When this war is over, you're going to see a level of M&A that may be radical as people realize all clear. I did Cisco yesterday with it was Restaurant Depot, but it's Jet Row. I don't think there's any chance that deal would ever, Lena Khan would have blocked that before it even hit the tape. But I think the companies are saying, you know what, we got a once-in-a-lifetime opportunity to get to, let's call our banker, let's call Morgan Stanley, and let's buy our biggest competitor, and let's, get it so that we can raise price, because it's about time. Let's get scale.
For a minute there, you sounded like Lena Khan.
Yeah, I probably overspoke there,
It's okay. Are you going to take that job as the top antitrust enforcement official in the country? It sounded like it.
If offered, I will not take it.
Okay. It's good to know.
Jim, we'll see you tonight.
Thank you.
Mad Money, 6 p.m. Eastern Time. When we come back, Robinhood's Vlad Tenev on his company being selected to help run the government's Trump accounts for kids. When we're back in a minute.
Team, if this is not a clear indication why you should not be trading, I don't know what is. Just look at this madness and look how it took place. You know, just pure ridiculousness. This is how you get trapped. This is how you get into revenge trading.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live, as always, from Post 9 of the New York Stock Exchange. Coming up this hour, oil prices moving higher as we close in on President Trump's deadline for a deal with Iran. We'll talk with Rockefeller's Ruchir Sharma about why he says this oil shock is different from all others in the past. Plus, Robinhood CEO Vlad Tenev with us after news that his company has been selected, along with BNY, to help run the government's Trump account for kids. And some details on big individual movers this morning, including UNH, Broadcom, and a major jump for Universal Music. We'll dig into all of that. But guys, wanted to start with the jobs picture because we did get some incremental news from ADP. They put out the sort of weekly number, 26,000 jobs per week, according to their latest sort of hiring pulse. It's a weekly update of the monthly ADP private sector jobs report. But what you need to know here is that it was the third straight week of improvement in hiring. That's a good number. We want to see improvement in hiring, especially amid all the noise and the concerns that employers would be holding back as a result of the war and of the oil spike. So it just adds to evidence, I think, on top of the jobs report, the government report that we got on Friday, on Good Friday, that was good amid some mixed messaging around jobs and what might happen. But I really wanted to dig into the AI story, right? How much is AI impacting the job market? David, I know you focus on this a lot. We all do, because we're trying to figure it out.
I mean, it's the most important. It's like there's nothing
It's
more
the story.
important than
It's
this.
the story.
Now, it doesn't mean that we're going to have any answers or that even things are happening near term. So everybody's just guessing, Sarah, but it's not unimportant.
But what we're starting to get past the guessing is some Wall Street research on just how they're analyzing it. And of course, it comes with the caveats that we're certainly early in the adoption phase. It's hard to tell exactly. You know, we get these announcements. The latest was Crypto.com, based out of Singapore, that they're going to lay off a certain percentage of their workforce because of AI, but we don't know exactly what that means. Is it really because of AI? So let's just start with a Goldman Sachs chart that I found interesting this week. So they look at basically employment with industries with AI augmentation versus industries with AI substitution. And there's a big difference there. Augmentation, the high line, actually shows employment growth. So this is the key to AI, right? If your job can be augmented or helped out by AI, you're seeing better employment trends versus AI substitution. How do they measure this? Well, they look at different AI augmentation occupations, medicine, right? We know that doctors are using AI and for all sorts of tests like colonoscopies. Education, they include in that. They basically added 9,000 to monthly payrolls and lowered the unemployment rate by 0.06. So we're talking about small incremental numbers here, but just as a roadmap. And then the substitution is more IT services, the software engineers, and that's where they see the bigger risk overall. So that's the Goldman chart. And then Morgan Stanley also, guys, did a chart. They have their own sort of proprietary way that they look at AI exposure. And they looked at basically, now this is the reverse, it's the unemployment rate based on AI exposure. And the unemployment rate at the top there shows the tick up with high AI exposure. Mm-hmm. Again, it's kind of marginal at this point right now. What they're saying is that at the high AI exposure runs 0.3 points above what aggregate conditions would typically predict. And then the bottom line, the upshot of all this, David, is that maybe we can look at a 10 basis point increase in the overall unemployment rate because of AI. So that's 0.1%. I mean, it's still small.
That's very small.
Small, but I think it presents a risk, is what they're saying.
Right.
That if we continue to see adoption, especially on these jobs that have substitution, that could be a bigger problem.
But I mean, to put that in perspective, one of the leaders of AI in the world, Dario Modé, who runs Anthropic, has warned, now this is a worst case perhaps, we could see 15 to 20% unemployment.
Yeah. But he's the only one really warning about that.
Yes, and I think he's doing it in part to try to engender a real conversation around what may be coming to a certain extent. I think that's...
I know, and I mentioned this yesterday.
By the way, I don't know if he's alone
in
in that. I mean, I would come back to statements from even Elon Musk or Sam Altman. I mean, remember when they were together and they launched OpenAI together, of course, to be a safeguard against the abuse of AI? They did not put it an insignificant chance that it would wipe out humanity. It was 10%, 15%. So I don't know where everybody is.
That's not a 20% rise in unemployment, but yes, I get
That's
your
even
point.
worse. Well, I'd rather have that, I guess, than humanity getting wiped out, but I'm not sure.
There's a lot of fear-mongering, and I think there's a lot of concern, rightfully so.
You think it's fear-mongering, though?
I mean, if you look in places like Asia at some of the surveys and the public surveys in Japan and Korea and China, they just don't have the kind of negative attitudes that we have around AI stealing our jobs. It's something Bill Gurley was talking to us about.
Right.
He was blaming Dario for creating this public perception that we should all be terrified of it, when it's actually can be game-changing in a positive way.
Is Bill McDermott fear-mongering when he says youth unemployment goes to 30%?
No, I think that youth unemployment is definitely a part. And by the way, I'm glad you brought that up, because all these research reports do show that's a place that feels it the most, because a lot of those jobs are, they're early, they can be automated, for sure. The question is it a canary in the coal mine, or is it, a certain segment of the labor market, or is it overall? We got to watch it.
Yeah, and listen, one thing nobody knows. You can talk to the absolute experts in this, the leaders of it, and everybody's taking a guess in terms of what's going to happen. This is a society-transforming technology, conceivably one of the most powerful, if not the most powerful technologies we've dealt with in humanity, some would say.
Unless it's not.
Unless it's not.
That's the other thing.
And that's,
yeah.
I know. And I don't know.
Right. And again, it presents a conundrum for policymakers, I think, when you talk about how to deal with all of this. If we don't know exactly, it's like these companies like Crypto.com or Block or Atlassian should have to explain, I think, a little bit why. So you say this is because of AI, that you're cutting 10, 15% of your workforce. Why?
Right.
What does that mean? What does that actually look like? Because it's hard to craft a sort of policy response, whether it's reskilling or some sort of social safety net, when we don't know exactly how it's working.
Right. I mean, I would reference the OpenAI note from the other day in terms of talking about all the different things that may have to change in tax policy if, in fact, some of these fears are realized as well. I wouldn't call that fear-mongering necessarily.
No, I just think that I think that there is. Look, there's a lot of negative. There's a lot of.
And there's a lot of positive. The optimists also would say this is.
Bill McDermott says that he's worried about the youth unemployment, but that he's keeping jobs stable.
Yeah.
He's not cutting
Well,
workers.
but then there's Klarna and there's Block. I mean, examples of companies wiping out a
That's
third.
what I mean.
Jack Dorsey would tell you, it's not like he's changing the entire way a company is run. And I think he thought of firing a far higher number of employees than he ended up with, which was 50%. That said, again, to your point, Sarah, the argument on Block has been that they had way too many employees.
They were
bloated. Because they overhired. They were
Right.
bloated. So you're right. But we'll sit here every day and discuss it.
But also
we
ask
have
the
to.
CEOs. So far, the market has rewarded CEOs for cutting jobs because of AI efficiencies.
Yes.
But I think there need to be more questions about, okay, tell us how the AI is creating so much efficiency that you need to fire thousands of workers.
True.
Yeah.
One thing I will tell you is Anthropic has a $30 billion revenue run rate that started at $9 billion 3 months ago. So it's showing something. All right, let's move on now to Iran. The major averages, you can see, we're down 1% on the S&P. President Trump has said the United States will target the country's bridges, power plants, and other critical infrastructure if a deal is not reached to reopen the Strait of Hormuz. That is by 8 p.m. Eastern tonight. So 8 p.m. here on the East Coast. Megan Casella has the latest from Washington. Megan.
Good morning, David. Both sides escalating their rhetoric this morning as we move closer to that deadline, which the president says will be the final deadline before the U.S. military begins to target civilian infrastructure in Iran. And at this point, talks appear to be on shaky ground. A government official in Pakistan who was close to the peace talks told our colleagues at MS Now that, quote, there is no hope anything will be confirmed today following U.S.-Israeli attacks on Iran and Iranian attacks inside Gulf states. It's looking very unlikely, but Pakistan continues to try for peace and stability in the region. That statement coming as a White House official confirmed to me this morning that the Pentagon struck military targets on the oil export hub of Kar Island overnight. And also in the last hour, a senior Iranian source telling Reuters that there are no negotiations with the U.S., which wants Iran to surrender under pressure. The source also saying that the Iranians will show flexibility in talks only once the U.S. does, and that if the U.S. attacks Iran's power plants, then the entire region and Saudi Arabia will fall into complete darkness. So, guys, it remains unclear what sort of a deal to avoid escalation would satisfy both sides. The president says he needs to see free flow of oil through the strait, but the Iranians say they will not open it in exchange for what they called empty promises, and that they're not interested in a temporary ceasefire. One point possibly, though, in favor of a diplomatic resolution. Vice President Vance telling reporters this morning that the White House is confident it will get some sort of response from the Iran side before 8 p.m. tonight, suggesting that maybe they will find a way forward. Guys.
Megan Casella in D.C. Megan, thanks so much. Our next guest says the oil shock from the Iran war is different from previous disruptions. Let's bring in Ruchir Sharma, the chairman of Rockefeller International and the founder and chief investment officer at Breakout Capital, has a new op-ed in the FT today. Ruchir, good to see you again. Thanks for joining us.
Thanks, Carl, for having me back.
We do have the IEA saying that this crisis is worse than 73, 79, and 22 put together. How do you think it's different?
Well, I think it's different from a economic angle, which is that we have discussed it in terms of the oil supply being taken out, all the geopolitical ramifications. But what I argue in my latest op-ed in the FT is that never before has the world entered any sort of a crisis with such high debt and deficit levels. That if you look at the average budget deficit of developed countries around the world, it's close to 4% of GDP. America is, of course, the highest at close to 6%, and that could get up to 7% of GDP this year. And of course, we have average debt to GDP levels, just government debt, of like 100% or more in America and other developed countries. So this is very different. And this has a major implication, which is that unlike in the past, I think that this time governments are going to be quite severely constrained to cushion the economic impact of this oil shock the longer it lasts.
You're right to point out deficit percentages. Yesterday, I think it was PIMCO that did say 7% for 26. And once you started counting in certain ways for, say, student loan provisions, maybe 7.4. That's not the number certainly that Secretary Bessent was hoping for.
Yeah, and I think that's why the bond market's reaction this time has been quite different. But if you look at the past few crises, bond yields would typically fall. You'd get a safe haven bid for bonds. But this time, bond yields have risen. And this is not because of inflation expectations going up like in some past oil crises, that long-term inflation expectations remain relatively anchored. This time it's the term premia which has gone up. And the only way we can explain that, given that this oil shock is a hit to growth, is the fact that there are mounting concerns about the debt and deficit. So this time the bond market's reaction has been different than past few crises. And also we seem to be hitting some red lines on the debt and deficit dynamics. I mean, as many people will say that these fears about the debt and deficits have been around for decades. But what's different this time, apart from the bond market reaction, is that some of the metrics are flashing red. I mean, the fact that the interest expense now on our debt, the amount we spend on that in America is more than our entire defense budget, is something which has been problematic for big powers in the past. So I think that this is something we need to keep an eye on, which is that never before have we entered a economic crisis with such high debt and deficit levels, and that's going to limit the ability of governments to cushion the economic impact. And the longer this lasts, the more problematic that becomes.
I hear you, Rashir, but do you really think if they were worried about a U.S. debt crisis, the dollar would be up 2% this year and would get bought every time there's concern?
Yes, that paradox exists, Sarah, but I think a lot of that has to do with the position unwinding, which is the fact that we went into this crisis with people very short the dollar, as you know, because the dollar had a very bad year last year. And so this time, I think, and there's also the short-term impact, which is that because the US is seen as being energy independent, some of the countries with higher energy imports have taken a bit of a hit. Having said that, even compared to the past crisis, I'd say the dollar's reaction this time hasn't been that pronounced. Yes, I agree with you that there has been a return of a bit of a safe haven bid for the dollar, but it's pretty minor. And put in the context that the dollar came into this with people very short. As you know, that one big play in the market this year has been that people have been cutting back on their positions a lot. Whatever they were long, they've been cutting back. So that dynamic is to play. And yes, it's too early to say that we're headed towards a debt crisis. What I was pointing out in my FT op-ed is that let's be mindful that we're entering this crisis with very limited economic ammunition left to fight it.
Yeah, we'll keep our eye on, especially the long bond. We got to 508 last May, about 15 bips away. Ruchir, good to see you. We'll read the piece. Thank you very much. Ruchir Sharma.
Thanks, Colin.
So here's our roadmap for you for the rest of the hour. When we come back, Robinhood CEO Vlad Tenev joins us first on CNBC after news that the company was selected as the brokerage for the government's Trump accounts, along with BNY.
Plus, we'll have a lot more on the war in Iran and President Trump's latest threats when we're joined by former Israeli ambassador to the United States, Michael Oren.
Gold prices are down around 10% since the war began. We'll talk about the price action with the CEO of Oceana Gold, which is listing today here at the NYSE. Squawk on the Streets, back in just a moment.
right?
Welcome back. So we broke the news yesterday that Robinhood and BNY will work together to build out the Trump Accounts investment initiative for children. Joining us now first on CNBC for an interview on this is Robinhood Chairman and CEO Vlad Tenev. Vlad, welcome. You there? It's good to see you.
Yeah. How are you?
So I had a hunch that you guys were working hard for this when I saw you at the big event a few months ago for the Trump accounts. How does it work? What will you be doing for the rollout of this initiative?
Yeah, so we're going to be the brokerage and the trustee for the Trump accounts. And what that means is we're helping design the app in concert with the National Design Studio. We're also building the front-end experience. And then we're providing the brokerage functionality. So these are under the hood, very similar to tax advantage brokerage accounts, which is our bread and butter business. So we're going to be powering that aspect of it, as well as providing the customer support functions and the primary interface with customers in partnership with BNY.
Yeah, we were talking yesterday about how it's not just the federal government. Corporations have signed on to contribute for their employees, and philanthropists, and maybe even states. We're going to start to follow some of the discussions among states. What are your expectations as to how big this program could get?
Yeah, I mean, right now, every newborn child will get $1,000 funded by the Treasury into a brokerage account so that they could get ownership into this great country. And on the eve of the 250th anniversary of the nation, I think this is an evolution of the American dream. You know, if you look at the American dream, it used to be about owning real estate and, you know, having a nice house with a white picket fence. I think increasingly that's evolving, and now it's really about buying into American enterprise, and the ability to fund that for every child from the start, I think is an awesome initiative. So the administration, the president, deserves a lot of credit for making this happen. I think being able to execute this and actually put real ownership in the hands of every child, I think it's going to change the world.
I mean, for you, I would assume for your business, I mean, you want young customers, right? You want those 18-year-olds to be invested in the Robinhood platform. How should investors think about what it means for Robinhood as it scales and for your business?
Yeah, I mean, obviously, for our mission from the very beginning was democratizing finance for all and getting more people invested in the engine of wealth creation. The greatest engine of wealth creation has been the U.S. stock market. So very mission aligned. In terms of the business, you know, this puts Robinhood in front of the next generation. And this is literally going to be the first investment account for millions of people. So it's really an honor to be able to serve these customers and to work with the government. You know, this is our first experience really working with the government in this way. So we're learning as well. And, you know, our aspiration is to make this the best product the government has ever been associated with. So we're really, and I know, you know, with the National Design Studio, they feel the same. And those guys in concert with our team have been cranking through the weekends because, like you mentioned, the government hasn't always had the reputation for rolling out great consumer products. I think this time will be different, and this administration, and in particular with the care towards design, really is approaching it very, very differently than the government has in the past.
Do you get any fees or spreads or anything on these accounts, or is it just a fee from sort of contracting fee from Treasury? How does that work?
Yeah, so for the customers, the accounts will have no account fee. There will be no trading commissions. So these are intended to be, you know, the absolute lowest cost vehicles and ways to get customers invested. Now, there may be in the future management fees through ETFs that are deployed in these accounts, but again, those will be very small. in terms of how we're monetizing, the way it works is we're actually acting as a subcontractor to BNY, and so we have essentially a government subcontracting agreement.
Got it. And I guess, we talked a little bit about sort of the future generation, but what sort of steps do you plan to take to make Robinhood a destination, for multi-generations and to convert these kids into more active Robinhood users?
Yeah, right now our focus is just on making sure this program goes really well and the product is amazing, because this is launching on July 4th, and now we're in Financial Literacy Month in April, so there's some content going out around that. I think it's a good opportunity to engage not just young people, but also their parents on the value of compound interest and jumpstarting their financial future. So our focus is on building the best product, and it's not really for us. It's not really a marketing initiative. It's really about how can we do the best possible job at something that's so tightly aligned with our mission.
Finally, we were just talking about that age group. We were just having a whole deep dive into the AI impact on jobs. And one of the sort of higher risk areas we've seen has been this rise in unemployment for college age grads, and whether, automation is killing some of those opportunities in those entry level jobs. Do you have a view on that? That's a core customer for you.
Yeah. I've spoken about this. I actually gave a TED talk about it a couple months ago. Throughout history, we've had waves of technological transformation that have completely transformed the job landscape. And what happens is some old jobs go away when they're no longer needed, but they get replaced by a proliferation of typically more specialized jobs. I think that's happening at large scale right now. I think there certainly will be job disruption, as there has always been, but there's going to be an explosion of new jobs and new job families and entrepreneurial activity, the likes of which we haven't seen. And we're starting to see that, with some of these tools. It's easy for one person to have the equivalent of a full staff, a full engineering team that can operate what would have taken, dozens of people normally to operate in the form of a business. So you're going to see an increasing explosion of entrepreneurial activity and new business formation. And I think regardless, investing is going to become important. Even if you don't believe me and you think that, we're entering a world where there's going to be more concentration of wealth in a small handful of companies, being able to invest in those companies becomes important. So I'd say the ability for Americans to invest in great American companies is a resilient theme, regardless of which future trajectory we take. But I think it's going to be one of more entrepreneurship, more business creation, which will make it so that we have a lot more things that we can invest in as a country.
All right, there's the AI optimism we needed. Thank you, Vlad. Appreciate you joining us today to talk about the new deal.
Always a pleasure. Thanks, Sarah.
Vlad Tena, CEO of Robinhood. We're going to talk more about the government's Trump accounts when Treasury Secretary Scott Bessent joins us at CNBC's Invest in America conference. It's April 15th next week. You can still sign up, cnbcevents.com/Invest in America, and it is happening on tax day, Carl, April 15th.
Still to come this morning, the president promising devastating strikes on Iran tonight if the country doesn't reopen the Strait of Hormuz. Former Israel ambassador to the U.S., Michael Lawrence, here with his take. Gold prices tumbling since the beginning of the war. Where might they be headed next, according to the CEO of one miner listing here at the big board today.
We want to focus on shares of Paramount. Have been up as much as 12%, now up some 8%. Some news involving the equity financing for the deal to acquire Warner Brothers Discovery, and meaningful news for existing current shareholders of the Class B common stock of the company. The equity check that is being written by both Larry Ellison, his partners at Redbird, and many other investors in the Mideast, for example, is now going to be priced at a 20-day moving average that is going to be determined roughly 3 days prior to the close of the transaction, and will have a floor of $12 and a ceiling of $16.02. That's where they can buy their stock. So that does bring it down conceivably from the previous price that was scheduled to be $16.02. Still far above, of course, the current price. But importantly, one of the key reasons why we've seen the stock pop is also because current owners of the B shares will also get a warrant for each of those shares to purchase the stock at that same price for the next 10 years. And so if you put it in your Claude model, try to figure out a present value for that warrant, you get somewhere around $3.50, $4 a share right now that it would be worth, given the 10-year time horizon that the warrant will give you in terms of purchasing the shares at the same price those who are coming in to buy equity from the company to finance the deal to Warner Brothers are paying. And that is why we've seen that pop in the stock of some significance there, the inclusion of those warrants. Carl, just wanted to make sure I included that. I know we mentioned it earlier, but it's sort of a key component. Didn't want to lose that.
Yeah, one of the best performers today. Let's get a CNBC News update with Pippa Stevens. Morning, Pippa.
Good morning, Carl. Vice President J.D. Vance is in Hungary today, blasting the European Union for what he called disgraceful interference in Hungary's upcoming election. Prime Minister Viktor Orban, who is an icon of the far right and a close ally of President Trump, is trailing in the polls. He is seeking his fifth straight term. Apple has reportedly encountered engineering snags in the test phase of its first foldable iPhone. The Nikkei Asia says that could lead to delays in the production and shipping schedule for the device, which was expected to launch either in September or December. Apple has been rumored to be developing a foldable iPhone since 2017, and rival Samsung released its first one back in 2019. And a London music festival has reportedly been canceled after Kanye West, who was headlining the 3-day concert, was blocked from traveling to the UK over his anti-Semitic views. That's according to the BBC. Major sponsors, including Pepsi and Diageo, have already withdrawn from the event. Organizers say full ticket refunds will be issued. Sarah, back to you.
Okay. Guess there's consequences for doing songs like Heil Hitler. Thank you, Pippa Stevens. After the break, former ambassador to Israel to the U.S., Michael Oren, with us as the president warns, quote, a whole civilization will die tonight if a deal isn't reached to reopen the Strait of Hormuz by 8 p.m. Eastern time. We'll talk about what could happen next. Stay with us.
Welcome back. President Trump renewing threats to destroy bridges and power plants in Iran if the country does not open the Strait of Hormuz by 8 p.m. Eastern tonight. Warning this morning on Truth Social, quote, a whole civilization will die tonight, never to be brought back again if a deal isn't reached. Let's bring in former Israeli ambassador to the U.S., Michael Oren. He served as Israel's ambassador to the U.S. for 5 years, from 2009 to 2013. Ambassador Oren, good to have you. Plunging Iranians into darkness and destroying their infrastructure, I don't know. I'm curious as to how you view that or in the overarching sort of goals of the war.
Well, good to be with you. I think I can speak for most Israelis and say we view it with sadness that we've been brought to this point by the Iranian regime. The last thing we want to do is hurt the Iranian people. We understand that 85% of the Iranian people hate this regime, and we don't want them to suffer. But we hope also that they'll understand that in order to bring down the regime, to get the regime to agree to the conditions which both the United States and Israel have set as the minimum, which is giving up the nuclear program, giving up the ballistic program, stopping, ceasing to support terror throughout the region, and giving up that stockpile of highly enriched uranium that can make 11 atomic bombs. That's the minimum. Of course, there's also opening the Straits of Hormuz, that there may be no alternative but to strike at energy sources, which would bring about, a blackout of electricity. Iran, it should be noted, the Iran regime has been striking at our energy sources since almost day one of this war, not just Israel's, but all of our Arab neighbors as well.
I wonder, it's not discussed that much right now, the idea of regime change, but certainly I remember the president's first address the night the attacks began, where he addressed the Iranian people and told them, now's your chance. I know, there's been reporting that Israel certainly had that hope early on. How do you affect the hearts and minds of the population in terms of how they think about the current regime and their willingness to oppose it when you've plunged them into darkness and potentially subjected them to serious hardship?
Well, someday this war will be over, hopefully sooner rather than later. And if that regime remains in power, it's going to be the same regime. It's the regime that's going to torture its people, execute its people, shoot them if they come out to the streets. A deeply corrupt regime that ruined Iran's economy. This was an extraordinarily wealthy country, one of the great oil exporters in the world, and it was impoverished. And so the people will wake up after this war. Hopefully there won't be, deep-seated resentment at Israel and the United States and other countries who participated in the war. And they will proceed, again, to take to the streets. I'm speaking now personally. I think that the days of this regime are numbered. If not during this war, then afterward. The foundations of the regime have been so deeply shaken that eventually it will fall.
The Wall Street Journal is reporting, Ambassador Oren, right now that Iran has cut off direct communication with the U.S. over this threat this morning to destroy Iran's whole civilization. Though apparently talks with ceasefire mediators continue. I wonder what you think the odds are of getting some sort of deal before 8 p.m.
Not great. Not great. The question is, will we get a deal after large-scale bombing raids have been conducted against the energy sources, the energy infrastructure of Iran? Will the regime have to sip from the poison chalice, if you remember that term, the term that the Ayatollah gave to end the Iraq-Iran war back in the 1980s? It was difficult. So we know the regime is capable of sipping from that poison chalice. The question is, what can bring them to raise that cup? And that's the hope that this will make a fundamental change in the Iranian thinking. And keep in mind, an Iranian regime that doesn't have a nuclear program, that doesn't have a ballistic missile program, doesn't support terror, doesn't have that arsenal, that stockpile of highly enriched uranium, and doesn't close the Straits of Iran, is a very different Iran. It still could be a hateful regime and a regime that is corrupt and hated by its own population, but it's a regime that threatens its neighbors, and in our case, threatened us existentially far, far less.
I wonder, there is a lot of division in this country, as you'd expect, specifically around the idea, well, as you just said, Israel's certainly a beneficiary of eliminating an existential threat. Do you believe, though, that the goals of the U.S. and Israel are similarly aligned? Because, again, as you know, critics of the war would say they're not, and therefore we are not going to be as big a beneficiary of the various things that are happening here. In fact, we also certainly open ourselves up to, to potential risk.
Excellent question. I think right now our our interests and our goals very much dovetail. That there's not a lot of daylight between us. That the Trump administration understands that Iran will pose, if not an imminent threat now, certainly an imminent threat in the years to come. Imagine the same Iran regime that had this ballistic missile capacity, that had the nuclear capacity. Imagine that regime in another 5 years closing the Straits of Hormuz, and nobody would ever do anything about it. It'd be like North Korea closing the Straits of Hormuz. And this is an Iranian regime that has committed literally hundreds of acts of war against the United States and the West, and has declared its intention to raise war against the United States since the first day of its first day it came into power in 1979. So there's no question about having a legitimate reason to go to war against Iran. Where there's a breakdown, I'm talking to you from northern Israel right now. We are under constant rocket fire from a proxy of Iran, from Hezbollah, as well as from Iranians, as well as from the Houthis in the south. So for us, the threat is imminent, and it is very, 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 very concrete. Literally running to these bomb shelters almost every 10 minutes.
But I have a question on that, Ambassador Oren. If you say that the days are numbered for the Iranian regime, why are they still able to send these, horrific cluster missiles that are murdering Israelis, that they're able to block the Strait of Hormuz and hold the global oil price hostage, and also save, firepower in the Houthis? I mean, from their perspective, as long as they, you've said this, as long as they hang in there, they see a win.
Exactly. And I said they're numbered, but I didn't give you the number. The number could be a year from now. It could be 2 years from now. But they're not. If you ask me if they're going to be around for 5 years from now, I'd rather doubt it. I wouldn't put my money on it. And again, the Iranian regime that doesn't have the ability to threaten Israel, Arab countries, and ultimately the West itself, because now we know that their missiles can reach Western Europe, and they lied about the range of those missiles. That they lie about everything. That's a very different Iran. It's a vicious, nasty regime and corrupt regime, but it's not so much a danger. At least not to us. It'll be a danger to the Iranian people, and that would be very tragic indeed. So yes, they have that capability, and I tell you honestly that when people were saying in Washington that 90% of the missile launchers were knocked out, we were kind of scratching our heads, thinking that the people haven't gotten that message in Tehran because the rockets kept on coming. They are less than what they were. Certainly from Iran, we were getting about 30 a day. Now we're getting about 10, 15 a day. But that comes as little relief to us. One of those rockets fell very close to my house this morning and shook the entire building. So we know. And we know that this is not going to stop unless Iran capitulates to these demands of the United States and Israel, which basically means that Iran no longer threatens us.
All right. Well, we are obviously all counting down till 8 p.m. Eastern tonight. Ambassador, thanks for your time.
Thank you, everybody. Take care.
Coming up after this, details on the takeover offer boosting Universal Music to one of its best days on record. We've got some exclusive reporting. Stay with us.
Well, they say what goes up must come down, but who stands to benefit if oil prices reverse course? Our expert is eyeing a couple of specific stocks to tune in for, so watch the Market Navigator segment later on today on Power Lunch for what names those are, 2 p.m. Eastern Time.
Take a look at shares of Universal Music Group. Of course, it is not listed in the United States. There's a proposal out this morning, though, that would change that from Bill Ackman and his Pershing Square. It has had some misleading headlines associated with it, sort of the idea essentially that he's offered to buy the entire company, which would amount to some $50–60 billion. That's not really what we're talking about here. What we are talking about is essentially a recap with a move in jurisdiction and listing to the United States, will allow for the inclusion in certain indexes, and then what he hopes would be better management overall that would increase its valuation. Unclear whether this proposal is going to happen. It would require both management and large holders to essentially say, yeah, we think it's a good idea. It's not inconceivable. If you are a current holder under the plan, you get about a little over €5 in cash. That's the recap part of it. And then you would get a new share, a share in Newco, essentially, which is the combination with his existing Spark entity that would then be incorporated in Nevada, and you would take it from there. It would give the opportunity for large holders such as the Bolloré family to potentially exit their position. But alternatively, if they don't sign on, this thing is kind of not going to happen. And obviously, all of it an effort to get the stock price up, which is helping because Mr. Ackman bought into this, this company some time back and has not done particularly well on the overall investment, guys. But you can see right there a very positive response, at least to the proposal. Again, it is not a purchase of the entire company. It is essentially what I would call a recap and a relisting.
Where he argues could trade to 25 times, 30 times, something like that?
Yes, he's arguing for far higher valuations based on, I guess, management or change potentially in management.
Plus the listing itself.
The listing itself, the monetization of an equity stake they have in Spotify, and any number of other things that he's hoping for. So those numbers you're seeing are based on sort of those projections, but not on what he's bidding for, which he's not, for the company.
Also interesting that SPACs are back. They're a thing. I mean,
they haven't gone away in a weird way. SPACs sort of stay with us. We don't cover them the way we used to. Oh, well, 21 they were huge. It was 22 they got the hate.
Collapsed. Yeah. All right, after the break, fresh read on gold prices and geopolitical headwinds with the CEO of Oceana Gold, a global miner, making its public debut here at the big board today. We're back in a moment.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
Welcome back. Gold just posted its worst month in over a decade, snapping that 8-month rally. Prices down around 11% since the Iran war began. Joining us this morning here at Post 9 is Oceana Gold President and CEO Gerard Bond. Oceana Gold's a gold miner, exploration company based in Canada. Rang the opening bell today to celebrate its listing on the New York Stock Exchange. Gerard, welcome. Congratulations.
Thank you.
What's the reason for the listing?
Well, look, we've grown as a company tremendously over the last 4 years. The market cap was about $1.5 billion 4 years ago. Today, it's around $7 billion. And with that scale and the relevance to the market came the opportunity to enter the largest capital market in the world. 45% of our production this year will come from the Hale Gold Mine, which is in South Carolina. It's the 4th largest gold producer in the USA. It's the only gold mine east of the Mississippi. And so we had a tremendous year last year. We think we're going to have a better year this year. It was just time to get us exposure into this market.
As we mentioned, it came after a great run for the precious metal. Is the recent softness to be expected given its outperformance prior to that?
Look, I mean, gold prices had its best year in like 40 years last year, and certainly we benefited from that. In addition to delivering on our production commitments to the market, I think in the market conditions that have occurred in the last month, I think we've had a lot of profit taking. But if you widen the lens, our performance has still been stellar over the past 3-5 years.
Yeah, relative to just about any other asset class. How about cost of production? Has the war changed any of that?
Oh, look, I mean, most people are experiencing a rise in their fuel prices. For us, diesel,
right,
which is the derivative of oil, is around 6% of our cost base. We actually hedge on a rolling 12-month basis our diesel requirements for our 2 largest producers. So, if I look to what we put out as guidance, which was pre the Iran conflict to the oil price today, we think our cost base is up 1.3% over a year if it holds at this level.
Right.
So not really material.
Right. And as you sort of widen the investor base, is it mostly institutional or retail that you're after?
Well, both. We have done retail conferences, and we've been really impressed with the level of interest in a new gold equity. Most people don't know there's a gold mine in South Carolina, US.
Yeah, I think that's a fair statement.
Yeah, I mean, and gold has been that gold mine celebrates its 200th year. In 2027, the first gold in the US was discovered in Charlotte. That's just nearby. So we have a novel story. Again, we had a record year of performance last year. We're tripling our dividend. We're doubling our share buyback, and we just have a story that really is attractive to all investors, but also retail.
Gerard, again, congrats. We'll keep an eye on it with your help.
Thank you.
Good to see you.
Likewise. Thank you.
When we come back, AWS Chief Matt Garman with us on the First on CNBC interview as Money Movers begins in just a few minutes. Good Tuesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen here at Post 9 of the New York Stock Exchange. Today, Wall Street is on edge as the president escalates his Iran threats with this 8 p.m. deadline tonight. We're joined by one guest who says it may no longer make sense to sell stocks on Iran-related news.
Plus, shares of Amazon under pressure so far this year, underperforming the S&P 500. The CEO of AWS with us this hour to discuss the company's AI strategy as well as the geopolitical challenges facing the overall tech industry.
Broadcom, the best performer on the NDX today, striking some new deals with both Anthropic and Alphabet's Google.
First up, though, in the markets, under a little pressure here, down 1% on the S&P 500. The NASDAQ getting hit harder, down 1.5%. There's weakness in some of the big tech names. Apple, for instance, down almost 5% now. That's a big weight, for instance, on the Dow. The only two sectors higher are energy and utilities. Consumer discretionary is at the bottom of the pack as we get back into this higher oil prices, pressure on the consumer, trade, higher treasury yields that we faced closer to the beginning of the war in Iran, ahead of this key deadline, 8 p.m., where the president has threatened to end a civilization tonight if they can't make a deal. We'll start off with that threat of massive military strikes in Iran. Our Megan Casella outside the White House as this deadline approaches. Megan, what do you expect today?
Sarah, dwindling hopes this morning that the U.S. and Iran will be able to reach any sort of deal ahead of what the president says will be his final deadline tonight. Just in the last few minutes, new reports from the Wall Street Journal and the New York Times citing Iranian officials saying that Iran has cut off direct communications with the U.S. and has told Pakistan that it would no longer engage in ceasefire talks. That comes after earlier this morning, a Pakistani government official who was close to those talks told our colleagues at MS Now that there is no hope anything will be confirmed today following U.S.-Israeli attacks on Iran and Iranian attacks inside Gulf states. It's looking very unlikely, but Pakistan continues to try to push for peace and stability in the region. All of which, guys, leaves it deeply unclear whether a deal remains possible at this point. And it comes as we know of at least some increase in escalation overnight. The White House confirming that the Pentagon struck military targets on Karg Island, while Israel's defense forces have warned Iranians not to travel by train today, signaling strikes on rail lines. And then in exchange, an Iranian source telling Reuters that if the U.S. attacks Iran's power plants tonight, then the entire region and Saudi Arabia will fall into complete darkness. And guys, then there was, of course, the president's True Social post earlier this morning warning that a whole civilization will die tonight, never to be brought back again. The president did leave the door open slightly for negotiations in that post, saying maybe something revolutionary, wonderful, he called it, can happen. But he went on to add, who knows? Guys.
Meantime, Megan, the vice president's in Hungary as we await Orban's potential re-election. And it feels like he's sort of being positioned as a potential mediator if, in fact, things do progress to the talk stage.
That's right. We've been told that Vance is just one U.S. official that's leading those negotiations, along with Steve Witkoff, Jared Kushner as well. But he is at least close to the region, sort of on standby, it seems like at this point, in case there are any sort of direct in-person negotiations happening. The president was asked yesterday whether Vance would be dispatched for some sort of in-person negotiations. He said he could be in the coming days, was very non-committal there. But Vance earlier today is speaking to reporters in Hungary, sort of suggesting there was still reason for optimism in the talks, saying that the U.S. did, at that point at least, still expect to get some sort of a response from the Iranians before the 8 p.m. deadline tonight. So, as you say, we'll hear more from Vance coming up, and maybe we'll get more details at that point from him.
Megan, appreciate that. Megan Casella at the White House today. Got some new data from the New York Fed this morning showing consumers' inflation worries are ticking higher, particularly in the near term as the conflict in the Middle East ratchets up. Inflation expectations for the 1 year up 0.4 to 3.4. 3-year rises slightly to 3.1 and unchanged at 3 for the 5-year. That's obviously all well above the Fed's 2% inflation target. Gas price expectations, highest level since March of 22, up more than 5 points to 9.4. Expectations for food and rent also higher after falling in survey data before the war. On the labor front, job finding expectations actually got better, but concerns about job loss and the outlook for the unemployment rate declined. Finally, perceptions about households' current financial situations fell compared to a year ago, and year-ahead expectations are also down as the percentage of respondents expecting a worse financial situation gets to its highest level since April of last year. I guess the question will be whether we consider this getting untethered or not, at least on the 1 year.
Well, it's not surprising that you would see it in in consumer expectations, like surveys, right? People see the gas price rise. They feel it. They see every tick of that price go higher when they fill up their tanks. So it's not surprising that we've seen it in consumer confidence numbers, higher expectations of inflation, in the services number of ISM yesterday, where prices paid, which is basically a business survey, rises, and here surveys as well. And we know that the Fed pays attention to these surveys. You don't see it as much in the market-based inflation expectations measures, like the 5-year forward, that sort of thing, outside of just the very near term. So it will continue to be a debate at the Fed of how entrenched these expectations are of higher inflation and whether they should look through it or not.
Yeah, as Myron told us the other day, some of those forwards are the most interesting numbers to look at least to the moment.
Right, which do not show sort of like rising risk of higher inflation expectations. We'll keep an eye on it, though.
Meantime, for more on inflation in the market, let's bring in growth equities portfolio manager at Gabelli Funds, John Belton, talk about where we stand here with the S&P. John, back to 6540-ish. We teased your segment by maybe suggesting the idea that selling on Iran news is having diminishing returns at this point.
Well, yeah, thanks for having me, and we'll see, because clearly there's going to be a big event for the market and the world tonight. For better or for worse, I think volatility has crept back into the market. We'll clearly be seeing that continue over the next couple days. It's been a tough stock pickers market since this conflict unfolded. You've got dispersion in the U.S. equity market is sitting around 5-year lows. So I think the market's just waiting for visibility and what the path forward is going to be in the Middle East before kind of normal market dynamics resume.
A lot of efforts to defend Mag 7 today out of Morgan Stanley, out of Goldman. B of A puts Microsoft on the US 1 list. I wonder, does a multiple on the Mag 7 at 24 make sense when staples are trading at 22?
I think valuations are never really an investment thesis or a catalyst. I think valuations really just something that kind of defines risk reward once a catalyst does happen. Clearly everyone can see Mag 7 valuations have come into historically low levels. Most of the Mag 7 barely trading at a premium to the market now on a forward PE basis, despite the fact that fundamentals for these companies remain very strong. The big debate in the Mag 7 ahead of the Iran war had been whether these big investments in AI capex were bearing fruit or were generating returns. And we got a very interesting data point on that front last night in conjunction with this series of agreements between Broadcom, Google, and Anthropic, where Anthropic's disclosed a revenue run rate that's now at $30 billion. That's tripled since the start of the year. So that is a very encouraging data point. I expect once normal risk management dynamics in the market resume, once these Mag 7 stocks start to work again, there's a lot of upside for many of them.
I'm looking at your top holdings, not surprising, NVIDIA, Alphabet, Amazon, Broadcom, GE Vernova, all the AI plays. What's going to happen to funds like yours, growth funds like yours, when we get public listings from SpaceX, Anthropic, OpenAI, all rumored to potentially come as soon as this year?
I think investors are going to have to learn about the space business very quickly over the coming weeks. But in all seriousness, you've got potentially $3 trillion companies maybe coming to market this year and next year. And there's been talk about accelerating index inclusion for some of these names. So I think there's going to be a lot of learning, and the market's going to have to figure out whether they like the large language model business model that OpenAI and Anthropic have, or they're going to have to figure out how to value something like the space business, which it's still early on the revenue front, but it's not hard to see why that's going to be a huge business in the fullness of time.
Well, what about you? Like, will it completely change the composition of a growth fund like yours?
I like to move slower. I think it's going to force me to start to make decisions on these companies quickly, but I think I'd prefer to move slower. I still think AI is a huge theme that is in early innings. how to play that is going to evolve over time, whether that's through Anthropic, OpenAI, or through the cloud platforms. I think there's many different ways to express that. So I think the first step will be, how do these new companies, these newly public companies, I should say, complement the existing portfolio? And then from there, are there any that I could see being the next major winner over the next 5 to 7 years?
Yeah, you're right. We're going to see a lot of hot takes on what it takes to replace a motherboard in zero gravity and how that's different from doing it in Texas. John, talk soon. Appreciate it as always. Good to see you.
Thanks for having me.
Still to come this hour, Apple, we mentioned, worst performer in the Dow this morning. Losses accelerating there. It's down almost 5%. It's a big move for a big stock like that. Largest decline since mid-February. We'll explore what's fueling today's decline.
Meantime, the CEO of Amazon Web Services is with us. We'll get more on the company's $50 billion investment in OpenAI, as well as the impact of the Iran war on the business. As we're close to session lows, Dow down 418, oil 117.
Welcome back. Shares of Apple are under pressure this morning. Let's bring in CNBC senior markets commentator Mike Santoli with a pretty sizable move here for Apple.
It is. Accounts for almost half of the S&P 500's decline, which is a very kind of mega cap driven move so far today. There's a variety of chatter and articles out there that are excuses, I think, for some of this selling, one of which is a report out of Asia, Nikkei Asia, saying that maybe there's been some delays or manufacturing snags with this expected foldable phone, which has been a bullish talking point, the rollout of this phone. But some other stuff, an adverse patent decision in China. I think the reaction to the news is, in a sense, more interesting than the news because it is a nearly 5% decline. And I think it also reflects the fact that Apple has been a relative haven in this period of time. It has outperformed the NASDAQ 100. It's outperformed the Mag 7 quite a bit over the last month. And so it often goes kind of counter trend. There you see it against the NASDAQ 100. It had built in this couple percentage point advantage over the course of the month. It's just giving it back right now. So clearly that's part of it. And I wonder how it fits into the evolving psychology of this move in general, where you've constantly kind of retreated to dry land and then had the floodwaters show up periodically, and it's really just components of semis that have maintained leadership within tech as the overall market, in a sense, tries not to lean too far negative. Whether that's the right call or not, that's what the market's doing, is trying to say that maybe we can ignore for now new highs in crude and see if we get some kind of near-term resolution on all this.
246, almost to the penny, Mike, takes you back to Monday's close.
Well, there
that
you go.
very rough Monday.
Exactly, yeah. And so I do think that's sort of an unwind of low conviction players thinking you could hide there. And obviously that's what Apple does. Apple serves as a bit of a counter trend player because it's not the big CapEx spender. It's not the big AI story. It's financially bulletproof and therefore has these kind of defensive properties. And this is a time when, sometimes in a correction, you want to see a lot of the havens get hit too, so that it feels like there's nowhere to hide.
So, Mike, let's talk about tonight. This deadline that President Trump has set, 8 p.m., has threatened to destroy a civilization. How does an investor process that? Is it a bigger upside risk or downside risk?
I think the market is trying to stay balanced on both feet because I think it's hard to discern that type of rhetoric as a promise of something very destructive and long-lasting happening, to distinguish it from what somebody might say if you want to sort of build up a lot of hoopla before you de-escalate. And I honestly think the market is confused about that. It's the duration of this crisis that matters, I think, a lot more than the next move. We don't even know if 8 o'clock is going to stick. We've had these deadlines pushed up. So you have to remain open to a lot of scenarios. I think what's relevant is crude keeps making new highs.
Yeah.
Okay, it's not calmed down. That previously has meant stocks need to go down and make new lows. We're not making new lows. We're using up this 3%, 4% cushion versus last week's lows on the S&P 500. I think because people have that sense out there that there would be a hair trigger upside move if you got some clear line of sight toward some resolution of this crisis or hostilities ceasing for a while.
Meantime, discretionary, I'm just looking at XLY. I mean, that's still down 10% for the year.
Oh, for sure.
10% and maybe that ties into Apple too,
It possibly ties into Apple. I think it's also an argument for the market has done its job partially in meting out the punishment or recognizing the danger in parts of the economy and not necessarily across the board. Yep, it's been a defensive move. Today, it's interesting, you see the health insurers rallying, and what's getting sold is Big Pharma, which had been the defensive healthcare play up until today. And so people just rotate into the next thing. So it's been trying to get away with, kind of rotation, getting them out of trouble. That's been the escape hatch for this market. We'll see if it can continue.
I mean, the cruise lines, right? They're the most, a chart of the cruise lines and oil. That's where the correlation is. You have to spend more on gas, can't spend as much on.
Right, they're very susceptible, and also it's a consumer confidence thing, and it's really easy to cancel your cruise reservation, right? So it's not like the demand is rock solid looking out many months.
Right. Then Delta, which we'll get tomorrow, did join the bag surcharge party, and that's a major that, as we all like to say, is probably the least exposed to fuel cost pressure.
Skews high end, obviously, yes, least exposed to fuel costs, but also, as people make the case, it's kind of a credit card. It's a credit card rewards company, and what I find interesting is consumer finance has gotten smacked in this move too, right? If you look at, I know it's not really the same as Delta Rewards, but Capital One and all of those, Affirm, and SoFi has been terrible. Yeah. So it's rates, and it's also just at the margin consumer balance sheets.
I will say, though, on the plus side, and maybe why the market has been more resilient than people thought, some positive signals on the jobs front, both from the report. I mentioned the ADP today, the expectations we just reported from the New York Fed around job and employment. I mean, that going into this, at least, the better retail sales last week,
there's a general,
more solid footing.
Yeah, no, I agree. There's a general sense that if only we can get past whatever is going to happen and see if oil calms down and you have some de-escalation, if it's all going to be about the fundamentals again, then I think the market believes that would be supportive because of all those factors and because earnings estimates keep going up, even though it's mostly tech. The estimates going up. It's not really the rest of it.
Dollars are still green.
And energy, of course.
Yes.
Yeah.
Mike, thanks.
Yeah.
Mike Santoli. When we come back, how the war is impacting sentiment in housing. CNBC with a new survey this morning. We'll get you those results next.
Plus, could a new deal between Broadcom and Alphabet be the start of a much bigger industry shift away from NVIDIA? We'll discuss that question later this hour. Don't go anywhere.
Welcome back. CNBC out with a new survey on how the war is impacting the housing market here at home. Our Diana Oleg joins us with this week's property play. Morning, Diana.
Good morning, Carl. Yeah, mortgage rates are now much higher than expected, and financial fears are front and center. And those concerns were already heating at the end of last year, but the war really turned up the gas. Now, buyers in the first quarter of this year, they were more concerned about the economy and mortgage rates than they were in Q4, and that's according to real estate agents responding to the quarterly CNBC housing market survey. Just 9% of agents said their buyers were most concerned about home prices, and that is a sharp drop-off from the previous quarter's 18%. This even as nearly twice as many agents reported home prices rising in Q1 versus Q4. And the economy led, even though mortgage rates during the quarter jumped sharply from a low of 5.99% on the 30-year fixed the day before the war started to now around 6.5%.
They're fearful of the war. They're fearful of gas prices. Their job security, with all this news lately about AI and AI taking over work, that kind of thing.
Now, there had been a lot of talk that this spring would finally be a buyer's market. But in the first quarter of this year, fewer agents actually said it was a buyer's market than at the end of last year. 36% said buyer's market, and the same share called it a balanced market. More agents said it was a seller's market in Q1 than Q4. And as a result, more agents are reporting buyers leaving the market.
You're just seeing buyers that were on the fence and deciding to buy are now on the fence and going the other direction, saying, I'm not going to buy.
That's why now only half of agents think the market will improve this spring, and 44% say it'll stay the same. That is not how it usually goes from winter to spring.
Anytime we experience any uncertainty in the real estate market, the knee-jerk reaction for both our sellers and our buyers is to pause. Let's see what happens.
There is so much more in this quarter's housing market survey, and you can see it all in the Property Play newsletter out right now. Make sure you're signed up, cnbc.com/Property Play. Back to you guys.
All right, really good color, Diana. Thank you. Another weekday for the home builders, down another 3%. For more on housing and the economy, let's bring in Renaissance Macro Research Head of Economic Research, Neil Dutta. This is a group that's been slammed down 17.5% in the last 6 months as these rates have crept higher. I mean, how does housing factor into your overall view of the economy right now?
Well, I think it's important because home builders obviously have been doing a lot of affordability adjustments to incentivize people to buy homes. I mean, that's what they're in the business of doing. And despite that, they really can't get things moving. So it kind of tells you how tough the situation is at the moment. And ultimately, I mean, if you're not selling new homes, the pipeline for future construction goes away. And obviously, there's a lot of household spending that is involved with respect to housing, right? So
it gets to the Fed's predicament, which is you've got this and the sort of consumer environment, which they're watching, and the jobs environment, which is kind of held up, but watching for signs of weakness, and then the higher inflation. So this is the conflicting sides of their mandate telling them to do different things.
Well, I mean, I think it's only, ultimately these things will resolve in time. And when they do, it'll be time to cut. I mean, that's kind of where I'm at. I mean, I would tend to resist the idea that the Fed's actually hiking this year. The fact that, you look at the job market, wage growth is slowing, the quits rate is low. I think that mitigates the risk of an actual hike. I mean, they'll sort of talk about it maybe, but I think they'll probably stop short of actually doing it. But ultimately, you're right. In the short run, the Fed's hands are tied. And if there is some resolution around the war, my expectation would be that, oil prices start to come down, but a lot of damage would have already been done to the economy at that point, and that'll kind of give the Fed some license to ease policy later this year.
I think on your podcast a couple of weeks ago, you put it succinctly when you said the job market sucks.
It does.
Did Friday's print do anything to change that view?
No, I mean, it's a really weird job market, as you know. I mean, the data are very bizarre. I think we've gone basically 10 consecutive months where the sign on the employment report has changed. And there's been an increase in volatility in the jobs numbers in recent months. I think the real signal to me is what's going on with wage growth, and wage growth is slowing. And if wage growth is slowing at a time consumers are about to feel an income squeeze from higher gasoline prices, it really, increases the downside risk to consumer spending.
Well, that is one topic of debate, which is how much the rise in gas prices will squeeze the consumer, right? How?
I mean, is it a debate? It's really a debate between whether it's linear or non-linear. Right now, we're in the linear.
It's a debate because you have higher tax refunds coming in. You have a job market that shows improvement.
Yeah, I mean, I don't know the job market's showing improvement. I mean, ask consumers if they think the job market's improving. None of them say that's the case. But I would just say that there's a time consistency problem with that argument. It's not like, oh, the gas prices came back down, let me go out and spend my refund. No household thinks that way, right? So to me, that's cooked. I mean, I think the bigger story is that the consensus went into the year with a lot of enthusiasm around refunds, and the refunds basically have gone kerplop. And, to the extent that gas prices are up, it's kind of eating away at a lot of that optimism.
Where do you think, let's say, core CPI tops out this year?
I mean, it could be a little over 3%. I mean, but that's CPI. I mean, obviously, core PC is already running somewhat higher than that. But I would just say that, to me, it's really about wage growth, right? And the fact that wage growth is cooling off, to me, will take pressure off of non-housing services, which is where a lot of the upward pressure on inflation right now is coming from relative to the Fed's target.
The IMF chief, ahead of her big meeting next week, making some headlines saying all roads now lead to higher prices and slower growth. And by the way, we'll have an interview with her ahead of the IMF World Bank meetings this Thursday, ahead of the IMF. But, globally, Neil, I do wonder what kind of growth picture we're looking at here.
Well, I mean, I think for U.S. investors, what's important is that right now there's a lot of enthusiasm around manufacturing, transports, logistics. People are very bulled up on those areas. But ultimately, I mean, if you have weaker spending on household durables and weaker global growth, I mean, remember, there's an asymmetry. I mean, we're prosecuting the war, but the rest of the world feels it a lot more than we do. What do you think that does to our export markets? So that's a huge part of the manufacturing base, right? Exports. So if exports are slowing, I think some of the areas that people are enthusiastic about right now, there'll probably be less reason for optimism later.
You think we will sell fewer exports because people are upset about the war?
Absolutely. Yeah, I mean, they are rationing. I mean, there's demand destruction going on already in Asia, to a lesser extent Europe. If that's happening, U.S. exports tend to be expensive. Where are they going to get the money to buy our stuff?
All right, that's a risk we'll watch. Neil, it's good to see you. Thank you for joining us.
Thanks for having me.
With an update on your thinking about the economy. Neil Dutta, the CEO of Amazon Web Services, with us on the other side of this break with more on the company's $50 billion investment in OpenAI and, of course, the impact of the Iran war on the business. And then do not miss CNBC's Invest in America Forum. It's coming next week. We'll be joined by top executives as well as government officials. The Treasury Secretary, Scott Bessent, will be kicking it off. Washington, D.C., April 15th, CNBCevents.com to learn more. We'll talk to CEOs from all these industries we were just talking about, from manufacturing to technology to shipping. We'll be right back.
Welcome back. Top tech and AI executives gathering in San Francisco this week as part of the Human X Conference. It's where we find our Kate Rooney this morning, along with the CEO of AWS. Morning, Kate.
Hey, Carl. Good morning. And Matt, it's great to see you. Thanks for being here in San Francisco in person.
Yeah, thanks for having me.
So we have not caught up since the OpenAI investment. I want to start there. $50 billion. It comes at a time when investors have been pretty nervous about CapEx when it comes to Amazon. $200 billion total. How are you justifying that spending, and what will the return timeline look like when you think about AWS and that new OpenAI relationship?
Yeah, well, we're quite excited about the partnership we have with OpenAI and on a number of different fronts, by the way. And I think that you'll see here over the next little bit of time, our relationship with them continues to grow. On the investment front, what they've accomplished is really incredible. I think their ChatGPT is one of the fastest growing applications ever. And we continue to be really impressed with the quality of models that that OpenAI produces. And so quite excited with that investment and to participate in that upside. In addition, we think that there is a really big opportunity for OpenAI to continue to grow in the enterprise. And that's part of the partnership that we have together in coming out with our joint offering, where we have a stateful offering that makes it really easy to build agentic workflows together. And so we're quite excited about building that, and we think that is another area that we can really continue to grow and innovate for customers together.
When you mention enterprise, we have to talk about Anthropic too. You guys have poured billions, I mean, early investor in Anthropic.
Yeah.
I don't know if you've used these words specifically, but sort of I think about you guys as the Switzerland of AI, and you guys have kind of messaged that, wanting to be neutral. Is that possible when these companies are competing so fiercely? How do you think about actually serving both?
Yeah. We absolutely think so. And our goal is to provide the absolute best technology for our customers. And that's been true for the last 20 years, and it's going to be true going forward. And in the age of AI, it's absolutely true. And it's true at the model layer, it's true at the application layer, it's true at the infrastructure layer. That's why we build our own chips with Trainium. That's why we have a partnership with NVIDIA. We want to make sure that we have the absolute best technology for everyone across all areas of the stack. And that includes really working together with Anthropic and OpenAI, two of the absolute best models out there. And our customers have told us they want access to all of that technology. And so our job is to help make that available in the absolute best performance, best scalable way for a broad set of customers. And so we're excited, and we think that there's lots of business out there. This is not going to be a one winner take all type of a market. We think there's going to be lots of different opportunities. We thought for a long time that people will build across lots of different models, and we continue to think that's the case.
But with your partners, you don't need to pick a winner. You don't need to pick a favorite.
We don't. And this has been true. From the very beginning when we built AWS, we knew that there was going to be a massive ecosystem of partners that build on the cloud and offer to customers. And when you think about databases, if you think about analytics products, if you think about applications built on top of the cloud, and if you think about AI models, there's not just one winner. There's capabilities that are great for a certain use case and different capabilities that are great for different use cases. And we want to enable all of those, and we think that there's lots of room in the world for all of these to flourish.
The revenue growth has been eye-popping for both of those companies. Anthropic overnight put out a $30 billion revenue run rate.
Yep.
How much of that goes back to AWS? And what do you make of the criticism that some of these investments appear to be circular, in that you are putting billions of dollars into Anthropic, they are spending billions on your platform? What do you make of that?
Well, from an investment point of view, we see these as great investments, and I think most of that has borne itself out, and you've seen the valuations of these companies go up. And so we like the investments that we make for the investment. We think we wouldn't make investments just for usage of AWS. These are completely separate decisions for us, and the investments we think are allow us to take advantage of some of the upside of us helping them grow their business inside of the enterprise. But we also get great partnerships from them. If you look at Anthropic, they've been growing like crazy, as you mentioned, and the models that all their models that are out today are trained on Trainium. It's our custom chips, and so we've learned a lot from them on how to build better chips, how to build better clusters, how to drive better performance. And now you see the best performance in the world coming from AI models running on top of Trainium, which is fantastic for us.
You have this interesting relationship with NVIDIA too. So you've got your own chips. You mentioned Trainium. When will that start to replace NVIDIA on your own tech stack? You guys have this relationship where you're really relying on NVIDIA, yet you're also kind of competing at the same time.
Yeah, I mean, it's true across all these layers of the stack. And as mentioned, just as it was with models, it's true with chips. And this has been true forever. You know, we've partnered with folks like Intel and AMD since the very beginning of AWS, and we build our own compute chip called Graviton, which is wildly popular with our customers, is hugely impactful. In fact, There's just an announcement out today that Uber is moving huge portions of their workload over to AWS to take advantage of Graviton and Trainium as part, and that's one of the big parts of the value proposition of why they're coming to AWS. But we're big customers of Intel, we're big customers of AMD, we're big customers of NVIDIA because our customers want to use that as well. And so, again, there's not just going to be one technology, there's lots of technologies, and we want there to be choice for all of our customers out there.
How are you balancing that, though? I would think NVIDIA, is there enough market share to go around, or are you needing to take market share from NVIDIA?
Look, everything is growing. And so all you have to do is look at NVIDIA's numbers, which are fantastic. And that team is executing like crazy. They build awesome technology. They really do. And I'm not saying it. They are a fantastic team that builds really, really great servers. And there's a reason they're the most valuable company in the world, and they continue to grow rapidly. And we think there's space in there for other alternatives. And so we think there's room for both.
We have talked so much about the software sell-off. What are you seeing in your own business? Are companies starting to shift spending from traditional software into AI? And do you think some of the fears around software are overblown?
Yeah, I do think they're overblown. I think I haven't seen that shift. It's possible. Here's what I would say is I think it is a real risk. And anytime there's a technology disruption, it is a risk to incumbents, anytime. But it's also an opportunity. And so if incumbents lean into that risk, they have an enormous benefit. They have a customer base, they have data, they have knowledge about workflows. And so you think about the AI disruption and agents disruption, incumbent software providers have a huge opportunity to lean in and actually grab more market share. But if they don't do that, if they try to protect themselves, if they try to put up walls and hold on to what they have, that I think is a huge risk for them, and there's a big opportunity for them to be disrupted if they don't really lean into that disruption.
You've been around for 20 years. AWS just celebrated your birthday, basically, 20-year anniversary.
Yeah.
Congratulations.
Thank
you were
you.
there from the beginning.
Yeah.
You've lived through other tech cycles. What are you seeing in AI that gives you faith that it is not completely overblown and just a massive bubble?
Yeah, this is by far the biggest disruption that I've seen in the last 20 years, and probably since cloud, and maybe even including cloud. And what I've seen is that I have not seen any technology that has such a massive impact on how work and businesses really change fundamentally. Yeah. It's not just a small step function change in improvements and efficiencies. It is a massive improvement. If we look inside of Amazon, our use of AI, our software developers, as an example, just to use one group of employees, are not 10, 20, 30% more efficient. We've actually recently measured and got a 4.5x improvement in efficiency from our software developers. A massive improvement. And so
in margins as well?
In efficiencies. And so being able to...
What does that mean, margins? What does that improve?
That means we can build more products, build products more quickly, release features more quickly. It does eventually lead to... Now, again, there's competition in the market, so it's not like magically delivering to margins. And so others will, in theory, get that too. But if you can be ahead of those other competitors out there, it means you can innovate more quickly. It means you can capture market share. It means you can capture more value and deliver more for your customers.
I want to ask you about what's going on in the Middle East. We have this ongoing war in Iran. You have data centers in that region that have been hit. Are they back online? And how are you thinking about investing and building in that region in the future, given what's going on right now?
Yeah, it's a really difficult situation, and we're working incredibly hard. In fact, we have teams 24/7 working to make sure that we can keep our infrastructure up for our customers in that region. And I will tell you, for long term, I am continue to be as bullish as I've ever been about that region. I think there's a massive opportunity for economic growth in that region, and remain really bullish around the markets there. There's a fantastic entrepreneurial spirit. There's a willingness to invest, and so and my excitement about investing long term in that region is just as strong as it's ever been.
If it does drag on, if this conflict keeps going, what will it mean for the supply chain, for building out globally, and your business at AWS, given the data center build out right now?
Yeah, well, it's obviously hugely disruptive for the global economy, as we're all very dependent on energy, and it also is just distracting for industry. For us, there's not short-term immediate things, but it really is just the drag on the global economy that we have to think about, and almost every single industry is in some way, shape, or form impacted by that disruption, and you just have to go further down the supply chain to find something. And so we're not different than that. I don't know that we're overly impacted by that. But everyone is in some way, shape, or form impacted by that disruption, and so we're dealing with that the best that we can.
Yeah, Matt, I really appreciate it. Thank you so much for being here and sitting down with us. Guys, we'll send it back to you in the studio.
Okay, thank you, Kate Rooney, for bringing us that conversation. Amazon stock underperforming this year, down more than 8% year to date. When we come back, the potential reaction in the oil market if the U.S. does carry out widespread attacks on Iranian energy infrastructure tonight. We'll get into that when we come back. Welcome back. Wall Street trying to assess the potential impact widespread attacks on Iranian infrastructure will have on the energy markets. Pippa Stevens looking at the scenarios this morning, Pippa.
Good morning, Sarah. So oil is moving higher ahead of President Trump's deadline of 8 p.m. Eastern tonight for Iran to open the strait. Now, we have seen crossings pick up. 7 vessels transited yesterday, following 11 on Sunday, 10 on Saturday, and 14 last Friday. That's according to Kepler, although it is still well below the more than 130 that crossed daily prior to the war. And there does continue to also be this disconnect between what oil is trading at for immediate versus future delivery, with dated Brent over $140 and at an unprecedented premium. Morgan Stanley saying the market is, quote, paying an exceptional premium for secure refinery usable Atlantic Basin barrels available now. Now, heating oil futures, that is a proxy for diesel, up another 2% today. The national average for a gallon of diesel now at $5.65. That's just 17 cents shy of 2022's all-time high. In California, diesel is at a record $7.73 per barrel. That impacts all those containers that are unloaded at the Port of Los Angeles and the Port of Long Beach. So, guys, ultimately ends up being a tax, so to speak, on the consumer.
We've had a lot of discussions last few days, Pippa, about what the real disruption number is. Some are trying to say tie all the reserve releases in. Maybe you're looking at 9 million per day. Others argue 12. You usually take the under or the over on that?
Yeah, it's really hard to forecast this, Carl. And of course, we've seen a lot of conflicting reports about just how many ships are getting through the strait, given that we have seen a lot of spoofing going on and turning off of those AIS signals. But it seems like now the most kind of apt analogies, looking back to COVID, when you're talking about just the ship supply shock, of course, that was a demand side shock, and this now is a supply side shock. So it's a little bit different there, but just the magnitude of what we are seeing. And it really seems like now, whether or not you call it maybe 6 million barrels short or 9 million barrels short, what everyone is saying is that it's going to be, the demand side is going to have to be what ultimately ends up balancing this market. A lot of the supply side levers have already been exhausted, whether you look at the strategic reserves or the waiving of sanctions on Iranian and Russian oil. And so then the question becomes, at what price does demand destruction really start to kick in? That I've seen around the $150 to $170 per barrel level. But of course, the ability of different nations to absorb it does vary. And what we've seen in the past is that the first $10 increase doesn't have that big of an impact, but then each subsequent $10 impact starts to be much bigger than the last. And so whether or not we get up to that level, I don't know. We're seeing more ships, hugging the Oman coast and getting through. But clearly a lot of outstanding questions here, and also just a lot of analysts trying to model just what kind of impact this will be and how long markets can sustain the loss of, call it, 6 million barrels per day.
Yeah, the convexity that we've been talking about really since the day the conflict began. Pippa, thank you, as always, Pippa Stevens. When we come back, how Alphabet's new deal with Broadcom might be the start of a shift away from industry dependence on NVIDIA. That story when we come right back. Welcome back. Broadcom shares jump today as the company confirms a deal to develop and supply Google's in-house chips for the next 5 years. What's the long-term impact for Alphabet? Our Mackenzie Sagalos is looking into that in today's Tech Check. Good morning, Mac.
Hey, Carl. So Broadcom shares getting a much bigger bounce than Alphabet this morning. But longer term, Google may be the real winner from this chip deal. For years, TPUs were Google's internal secret weapon, these custom-built chips designed to handle its own workloads like training, search, and running Gemini. They've been available publicly through Google Cloud since 2018, and now we're in the phase where customers like Anthropic, Meta, and other major AI players are leaning into the Google stack, with some reportedly leasing and others buying Google's TPUs directly as they look for cheaper alternatives to NVIDIA's GPUs. And that demand is only accelerating. Anthropic's computing capacity from Google's chips alone is set to more than triple by next year. Now, TPUs are designed to speed up AI workloads. They're not as flexible as NVIDIA's chips, but they are less expensive and more efficient for the jobs they were built to do. And increasingly, they're shifting from an internal efficiency tool to a core pillar of Alphabet's AI revenue strategy. D.A. Davidson estimates that Google's chip business could capture 20% of the AI market over the next few years, making it a roughly $900 billion opportunity, potentially worth more than Google Cloud itself. And it really underscores Google's edge in AI vertical integration. Unlike its big tech peers, it has the chips, the cloud platform, the Gemini models, and the consumer products all under one roof. And Google still trades at a discount to Apple and Amazon. So you've got a company with what analysts are calling a credible new revenue driver and a market that hasn't fully priced it in yet. Guys?
Gotta say, Mac, you remember last summer where it was all about existential risk for search? It's gotta be one of the most profound education processes for the market in the last year, this rethink about Alphabet.
Oh, certainly. And part of what's so interesting about the uptick in interest in the TPU is that it directly coincided with this comeback for Gemini, where originally they were on the back foot compared to ChatGPT, and then it started to outperform those models in a lot of the benchmarking tests. And suddenly we started to see this uptick in appetite. And through the purchase orders that Broadcom has put out in relation to Anthropic's purchases of TPUs, we know that they're able to undercut NVIDIA on price. And then we're seeing efficacy in terms of their use case with Gemini, both training their models and running them, the inference use case.
Yeah, as NVIDIA tries to get out of the 170s, really interesting market battle here. Mac, thank you. I'm Mackenzie Sagalos.
I was just looking at, we got an update on the GDP Now forecast from the Atlanta Fed, down to 1.3, tracking for the first quarter of 2026. So that's below trend. Clearly, a lot of factors playing into it, including these high oil prices and gas prices, which is obviously something they'll be watching for the rest of the day today and into tonight. Again, a lot of the focus, and we've talked about this in the commentary, is not how high oil gets, but how long it stays there, right? The duration. And I'm hoping we'll have some clarity tonight around this 8 p.m. deadline and what everything looks like tomorrow on that.
And then we'll be dealing with mostly stale data. I mean, I'm not sure how much Q4 GDP at this point matters, but we'll get it Thursday. And of course, CPI with our first glance at the effects of this war.
Yeah, the Friday CPI is March. So that's perhaps the most timely impact on inflation on this war.
Let's get to the judge at Post 9.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the Trump deadline hanging over these markets today. Investors left to figure out where all this is heading. We'll discuss and debate all of it with the investment committee. As always, joining me for the hour, Joe Terranova, Stephanie Link, Sarat Sethi, and Josh Brown. Take you to the markets here. We are red across the board. About 1%, 0.75% losses for the Dow and the S&P. You can see NASDAQ is down that amount. WTI ticking up today, just shy of $115 a barrel. So, Steph, you know, we say we're on edge a bit in the market ahead of the deadline tonight. These really unprecedented social media posts from the president. Oil's up, the VIX is above 25. What are we to do?
I mean, it feels binary, doesn't it, about tonight? We're all going to be watching 8 o'clock tonight or listening or whatever it is that we're going to hear about. We don't even know if we're going to hear anything in general. So what do? We have to just lean on what we're seeing from the economy, because the economy, even in my opinion, it has held up remarkably well, Scott. You know, I always cite a lot of various different data points, but they're still pretty good. And thankfully, so that just speaks to the tailwind that we had before the war, and that had a lot to do with the administration's pro-growth policies, deregulation. The One Big Beautiful Bill is kicking in. I thought it's interesting the tax receipts year to date are up 4%. That's a little bit better than expected. And all the labor market data points last week came in better than expected. We got an ISM manufacturing that's north of 50, 3 months in a row. We had an ISM services up north of 50. So it's hard to ignore that the economy is still hanging in. Yes, if the war lasts longer, then it's going to slow materially. But for now, what I think is very interesting, even though strategists are lowering their targets on the S&P 500, they're actually increasing their earnings. Even yesterday, we got more numbers that were revised higher, and that speaks to the economy, which is why I always fall back on that. So it's a scary moment. I don't feel good. It's binary tonight. Let's see what happens, but I'm leaning on the economy, and I'm leaning on corporate America to do what's best for the companies to deliver on earnings. Cautious guidance likely, but I think that should be enough to be a catalyst for the market.
Atlanta Fed revises down Q1 growth to 1.3. You mentioned that. You mentioned it when it's positive, so let's mention it when it gets a little negative.
No question,
right?
It's not good. It's the direction though that we really care about, and obviously the direction is south, and that's not a good thing.
Trend. I mean, to Steph's point, it's hard to argue against the idea that in the here and now the economy's hanging in. I mean, the jobs report was better than expected, noisy revisions, we get it, but nonetheless, on the surface, the number was better than expected. Steph's right. Earnings expectations are still projected to grow 14.5 nearly percent. It's a matter of if this goes on and on and on, and who knows whether it gets escalated this evening. You just have a whole different batch of questions that need to be asked and then try to answer.
So here's what I think. First of all, if we are going to get good news, and I'm prohibited from trading zero-dated options, I would actually buy zero-dated options calls for today. Because if you're going to get good news from the president, he loves to deliver the good news in the middle of the trading session and deliver the bad news when the market's closed. That's been the pattern going all the way back to COVID. So I think that when I look at overall the environment, institutions are defensive in their positioning. Retail had a bearish turn. Systematic is kind of neutral. And then to Steph's point, I know earnings are going to be strong. We know that the economy is hanging in there. There's resiliency. I don't think the Federal Reserve is going to get on our way. So by no measure is there an inflection point in front of us. I think what's in front of us is the possibility that if you get that good news, you are going to have a powerful rally. What do you do with that if you've had hedges in place, whether it be oil or fertilizer or defensive positioning? I think you pare that back at some point today.
Yeah, you're just going to be, for lack of a better description, at the mercy of, headlines that are likely to be volatile throughout the day. Like, I'm sure every investor, every person watching the show is looking at these intraday moves. You see the Russell spiked higher, S&P comes up, and they're like, what happened? What happened? What happened? Is there a headline? What happened? That's the kind of day that it's going to be for, certainly for the rest of the day, and who knows thereafter.
And to Joe's point, if something positive happens, it's going to happen in the next 4 hours. Yeah. So when you see these things go on, it's, well, did we miss something, or was something said, or was something not said? And I think, to invest around this is very hard, other than sticking with your core positions and understanding that, we're going to have good earnings, but we're going to have caution as well. So where do we go with that, and who are we going to listen to? And I think the earnings calls, they're always important, but they're going to be very important now, considering what companies' input prices and demands are going to be.
Josh, the big dilemma, I suppose, if it even is a dilemma, is, as an investor, do you take risk down even further? Because we've seen institutions and hedge funds de-risk significantly. Do you, as an investor, take your risk or your exposure down even more because you're worried about a bad outcome this evening? Or do you do what Steph's doing? Do you focus on what you perceive to be still a good and credible story around the macro? And until that changes, it's foolish to make any bigger decisions that might skew negative around either your positioning or your outlook.
Yeah. So can I have a third choice? Can I have choice C?
Yeah.
I don't actually think.
Or do nothing.
I don't actually
or
think.
Do nothing.
Well, no. I'm gonna say something very productive here, and I think the macro is right at this very moment less important than the micro. We're going into earnings season tomorrow. We're gonna hear from Delta, stock I own, very important. The commentary, because they serve the corporate customer, they serve the middle income, they serve the high end, they're international. So we're going to start getting earnings as the focus. I can't tell you what happens in the Gulf. Nobody else can either. Mutual fund managers in Boston don't know. Hedge fund managers in New York don't know. Private equity doesn't. Nobody really knows. But the earnings picture is bright, and we've already received the discount thanks to geopolitical turmoil. We already have it. Think about this. We now have 110 S&P 500 companies that have issued quarterly earnings per share guidance for the quarter we're about to get reports on. 51 negative, 59 positive. This is the lowest number of companies issuing negative guidance since 2021. On the other hand, the number of companies with positive earnings per share guidance for this set of reports we're about to get is way over the 5-year average and over the 10-year average as well. So we have the highest number of S&P companies issuing positive guidance in 5 years. Very few negative pre-announcements. Too late now. Even at the sector level, you have tech leading with positive guidance. In the meanwhile, you're getting that benefit of the geopolitical turmoil in the multiple that you're forced to pay for these earnings. We hit a 23.1 forward earnings this time last year. You know what that is today? It's 19. Year to date, the S&P is down 3%. Dividends added 0.3 to returns to the index. Earnings added 5.7%, which means multiple contraction has already reduced what the S&P's return would have been by 9%. So I don't know that I care about the macro because I can't control it. What I care about is that earnings are going to be great. And I think whatever resolution we get in the Gulf, whether it's tonight or tomorrow or next week, earnings will become the story. And there's nothing not to like about that story outside of a few isolated industry groups.
You have to care about the
But
macro.
I can't bet it.
I'm not saying you have to bet it, but you have to actually focus on it because that's what's going to lead to better than expected earnings, especially the cyclical companies that have actually outperformed the growth companies year to date. It's because of the economy having the momentum that those sectors, financials and industrials, materials, even energy, have done pretty well relative to technology. And it's because the economy has so much momentum, and a lot of that is the whole AI food chain.
Not for everyone.
Not for everyone.
I got home builders making 52-week lows. So that's the macro. That's the macro.
Josh,
I can't control
it. That is macro, but that's been horrible because mortgage rates are at 6.5%. That absolutely has not benefited from the macro, but all of these other sectors that I'm talking about, especially the AI food chain, which is data center, grid power, and led by AI. I mean, those stocks, they're green
Here's
today,
the problem.
by the way.
The question is, and this was brought up by somebody yesterday, one firm who had a note because we mentioned it near the top of our program. Yes, of course that's true. The question is, does now the war and oil and all of the risks put heavy risk on that continuing, what you said, that has been a place to sort of hang out, the value stocks which have outperformed growth, but have we introduced enough risk now that that's not going to work anymore, which is one of the reasons why money's gone back into the growth trade and why tech has come off the bottom of the war harder than everything else.
And you know what I'm buying, and I am buying technology because some of those stocks are awfully cheap, and some of the sectors, cyclical sectors, will not benefit if the economy rolls hard. But I do not think that whole AI food chain is the benefit of just the macro being good. I mean, AI, $761 billion being spent by Mag 7 is incredibly important. And again, it's incredibly important for all the other industries that are benefiting from that. And I don't think the war is going to change that by any means.
Macro, I think the macro is a little more, the picture's a little more fragile. It's a little more muddied up, which is why you can't make as credible a case right now, I don't think, for the cyclical areas and the broadening trade and the alleged value stocks in the market, because now you have greater unknowns introduced into where you were pretty good and you had pretty good visibility. Now it's foggy.
And that's why I've said all along, if it's a short war, I think we can get through it because there's enough tailwinds and there was enough momentum in the economy pre-war that we'll have a blip, definitely. We have 1.6 in Atlanta Fed tracker. I mean, that could even go even lower. So I have no question about that. But I think if it's a short war, we can get past it, get past through earnings. Earnings should be the catalyst and we can get through it. If it's a longer war, I'm totally wrong.
But that's why the S&P is only down 4.5%.
That's exactly right.
Since the war started, because people are trying to keep their eye on the same ball that Steph's looking at and saying we came into this in a pretty good place. We're still in a pretty good place. And heaven forbid we don't get into a really bad place, because the market's going to look a lot different if we do. And the earnings outlook's going to completely change if we do.
Well, I think it's growth over value. And I think as you move towards the end of the year, the earnings estimates might be a little bit too high in the regard of seeing Q3 and Q4 near 20%. That requires that the broadening out thesis remains intact. I don't know that you're going to get that, especially if oil prices remain elevated. So what I'm seeing in the near term kind of validates my view that I think more than anything else, it's the Mag 7, it's technology that's participating in the AI infrastructure build out. It's the industrial names that lead the market higher. I don't know if you're going to get the participation that we anticipated coming into 2026.
That's the point that I was just making with Steph.
And you had at the end of 2025. Look at a day like today. I mean, where did healthcare go? Why is healthcare making this turn lower? Should it not be participating as a defensive play? No, it's not participating. So I just don't see moving forward that you're going to have the value resurgence that we anticipated earlier in the year.
Sarat, Wells today upgrades tech and downgrades energy. So it sort of plays a little bit into the conversation that we're having here.
Yeah.
On all fronts. War not lasting too long. If you think the war is going to last much longer than people even today expect, you're not going to downgrade energy.
No, but you could also take the effect that if the war goes longer than we expect, the earnings of energy are going to come down because the demand for energy is going to get reduced, right? So then you get the cyclicality coming in, the degradation of earnings. So I think that's the right call to start taking some money off energy at these levels, because pretty much the right discount rate's been priced in there. And I think to the point of tech, it's been so beaten up, they're cash flow positive, and they've got strong kind of earnings momentum, so the valuations have come down, and it's the time to buy some of the good tech stocks.
Steph's moves today could not be a better representation of this, not only this conversation, but of her overall views. You sold, not trimmed, sold Chevron, and you bought a couple of tech names, okay? Bought a new tech name and bought more of another one. But tell me about the sell of Chevron.
Well, I've been selling SLB. I've been trimming that. I still own a big chunk there. I'm still overweight energy, but I've made 33% in the year to date in Chevron. It trades at 21 times forward estimates. When I was buying it in the beginning of the year, it was trading at 14 times. So it's a great company. I just think that energy is overextended, and I would encourage people to take some profits. You don't have to sell everything. Like I say, I own SLB, but I have been trimming that as well.
You bought Marvell and you bought more ServiceNow.
Yeah, I've never owned Marvell, and up until about 3 weeks ago, I've never owned ServiceNow. I'm trying to look for bargains, right? So Marvell is trading at 15 times fiscal 28 estimates for 40% growth. It's an AI infrastructure beneficiary. Their optical business is growing like a weed, up 50%, and their custom ASIC business is growing 20%. Really strong free cash flow of $3 billion, operating margins and gross margins also above plan. And NVIDIA is actually investing $2 billion in this company. And by the way, I think they can do something like $5 plus in earnings power by the end of fiscal 27. ServiceNow, 25 times for 27% RPO growth. We talked about last week how Palo Alto CEO bought $10 million in stock. Well, this CEO just bought $3 million, increased his stake by 22%. And they have RPO growth, as I mentioned, of 27%, free cash flow margins of 36%, a buyback of $6.5 billion, and a $2 billion accelerated program. And they have an analyst meeting in May. So I think that there's a catalyst. So I don't know if these are going to work in the short term. I mean, software is like in no man's land, but I do think that there's a bargain there. And Marvell, I think it's a great way to continue to play the AI trade. And I was taking some money off the table from Broadcom because I've made so much money there. So I was looking for other places to put within the semi world.
Josh, Chevron, I think it probably still on the best stocks in the market list. But this idea, maybe it's going to, maybe it's so binary, the outcome of this evening that this is a classic stock at risk of a binary outcome tonight. Whether, as we're talking with Steph, is it time to at the very least, lighten up on some of these energy names that have run up for the last 5 weeks since the war started?
So I like what Stephanie's doing. I would do it slightly differently, but the rationale is the same. These are the big winners this year. The sector as a whole is up 40%. These are gigantic companies that have had like some of the biggest short-term runs we've ever seen. And quite frankly, the fundamentals really haven't changed that much. It's a re-rate because I think the sector, energy sector, Judge, got to 1% of the S&P 500. Think of how crazy that is. So as large as the tech sector has grown and communication services, where did all that market cap come from? It came from the energy sector.
Which was about 3%,
shrank.
I guess. It just collapsed.
Yeah, but it was 12% when I started in this business. So it's incredible. So it got down to like 2-3%. Nobody owned these stocks. And so that re-rate higher this year, Stephanie was in first. So she's right to win the register. I would do it slightly differently. So I have like 40 energy stocks on my best stocks in the market list. Can't own them all. But if I'm in some of them, and I am, what I'm doing is I'm trailing them, and I'm looking at a weekly close every Friday. This is not the same as trying to nail the top, and I know that's not what she's doing. But it's this idea of, well, wait a minute. These are the best stocks in the market. These are in uptrends. And yeah, maybe I'm overweight. Maybe I own more than I want to. But let me let the market tell me it's over, rather than me just decide. Now, if I have something better to buy, like a Marvell, that's different. So I'm on the same side as Stephanie. I'm just talking about a different approach to how to manage huge winners, which Chevron is for her, Exxon is for me.
Sarat, you own Chevron, yeah?
I do. I mean, we've been trimming a little bit of Schlumberger too. We bought it around the same time, but I still like having the Chevrons and Exxons both in my portfolio. Again, they're 4% in total, just as a hedge. And as they go up, I'll probably take some of it, but it's just a hedge in there. When things go bad, that's where the money flows to.
We need to talk about Apple today for obvious reasons. When I show you the chart, if you haven't seen it yet, it's going to make you certainly sit back and look up. Stock was actually down 5%. That's the worst day in about 2 months, and you just don't see it that often. Would be the worst day since April of 25 if it in fact is down at least 5% or more. There was a story out of Japan that the foldable iPhone hits engineering snags and delays shipments. It was expected in the second half of the year. Now, who knows? That's one of the stories. Even as Evercore out here today reiterates Apple outperform with a $330 price target. Now you own this personally. You thought this thing was about to take off because I think you said it as much yesterday.
I said yesterday if it closed above 260, I was going to buy more.
That's right.
So what I see is what all momentum funds see. And if you're trying to be tactical within the market, it looked like you had an all clear signal where Apple had gone down at the end of March. It had tested the 200-day moving average and potentially had held. My purchase was on March 24th at 252.5. So it looked like, okay, it's going my way. Let's build to what will be a winning position. And remember, there's been a degree of resiliency throughout the year, and Apple it's viewed as somewhat as a safe haven. So I still think residing there, embedded into the name, was a degree of bullish positioning. And I think what has happened today and why you're seeing this significant reversal is you're quickly neutralizing that belief that the all clear potentially had happened. You got below the 200-day moving average earlier in the session. Look, that's not enough for anyone, in my opinion, to take action. You need multi-day settlements below there. And I also think you could lean against the 243.5 low, or 243.42 rather, from late January that sits there for Apple. That's another critical point of reference. So I'm going to maintain the positioning here.
Josh, you said, if I recall correctly,
close your eyes and buy it.
Your exact words were, "This is the one. This is the one."
Yeah,
that this name was going to take off.
close your eyes and buy it. It's a stupid headline. It doesn't mean anything. It has nothing to do with the earnings outlook. The foldable phone is delayed, according to Nikkei News. Seriously? It's not people selling it who use their wake up and think. This is machines. Oh, negative Apple headline, therefore sell X, amount, maybe with leverage, blah, blah, blah. And then look, the buyers come and clean them up. Can I have an intraday chart? Guys, let me point to what Joe is talking about. You have overhead resistance in the form of the 50-day moving average, which has rejected the stock twice, including on Friday. That overhead resistance has been in force since January. But now you've got this sort of gently upwardly sloping 200-day, which actually has served as support. And you see the stock coming to a decision point. And 260 is the trigger. That is the 50-day. But I think if you see this stock recover most of the foldable iPhone crash of 2026 between now and the close, you just need to be long this name. It is digesting sellers very rapidly, right at a very key level of support. And once the sellers run out of ammunition, it's going to lift like a beach ball you're trying to hold underwater. This is my opinion. I'm not stating fact. I can't see the future. But gun to my head, this stock ends the year closer to 300 than 200, and you want to be long.
Okay. Microsoft, is anybody going to come to its defense as vociferously as Josh Brown just did with Apple? Stock's down 24% year to date. The multiple has compressed from 27.5 times to 21. 27.5 times at the high to 21 times now. Well, Bank of America is answering the call today. They add Microsoft to the US 1 list, Sarat Sethi, of the RBC top 30 global ideas for 2026. You know what name's on there as well? Microsoft. So here come the defenders. Here comes the cavalry to try and save this name before it gets worse.
Yeah, look, I like it at these levels. I mean, Microsoft's been put in the same category as the ServiceNows, Workdays, the SaaS Accomplice, because of Copilot. Are they going to have the same seats to sell down the future? This is a company that throws off so much cash flow. They are in the AI game. They're in every enterprise possible. I think it's just a multiple compression story, and it's an execution story of earnings. So wait till earnings come out, and then you'll kind of see the trajectory of the earnings.
What about with Microsoft?
I mean, obviously, when you're looking at momentum, it does not look good as the biggest drag out of the Mag 7. I also think there's been a negative effect related to OpenAI. I think you see that.
No doubt about that.
If you show a chart of SoftBank, you'll see the same type of price formation. So there's been that negativity surrounding OpenAI. We know that potentially you are going to see an IPO at some point. Myself personally, and we'll talk about this, I'm more excited about Anthropic and anyone that has that relationship with Anthropic itself. So if we continue to see this kind of shift in sentiment where it's, okay, let's revalue Anthropic higher and let's kind of take OpenAI and lower that valuation, I think that acts as a continued drag on Microsoft.
All right, let's hit Broadcom before we take a break, and we'll do it quickly because shares are up sharply today. It agreed to expand its chip deals with, since you're talking about Anthropic, that company, and Alphabet. Steph, about 10 days ago, you trimmed it.
Yeah.
To some surprise. On the desk by me primarily. The stock's up a lot. I know you made a lot of money.
400%.
I know. So I'm just saying, like when you make a bullish case on a stock for like the last 365 plus days and then you sell it, I'm like, wow, okay.
I
was flabbergasted.
Oh my gosh, I trimmed it. No, this is a really good deal. 2 deals today with Alphabet. It's a 5-year lockup deal for their supply equipment. That's great. And Anthropic actually, they're increasing their capacity. That's also very positive. It could be 10 to 20 billion in additional revenue for Broadcom. So I'm not selling it all. I'm still overweight, but I thought it was prudent just to take some money off the table so that I could buy some of these other stocks that are down a lot year to date.
All right, so it's up, and we'll follow that, obviously up just shy of 5%. Still ahead calls of the day. We have a big call on the home builders today. We were just talking about those. Plus, Josh's best stocks in the market is coming up. And later, yes, we do have a new twist in the battle between Sam Altman and Elon Musk. Details ahead. right, let's talk some home builders today because as one of our calls of the day, Seaport Securities has downgraded a number of the names. They're lowering the ratings on everybody, okay? 15% downside expected for sell-rated names, which they have as Lennar, KB, Pulte, and NVR. They're neutral on DR Horton and Toll Brothers. Steph, I'll begin with you because you've liked these names for a long time.
Yeah, I have.
And mortgage rates are just not your friend.
They are not.
They're not your friend.
Not at 6.5%. And I've said that all along. It's interesting, though, that DR Horton recently was at a conference, and they said when mortgage rates dipped below 6%, that brief period, like for like a day or two, they said they didn't see a rush for the doors in terms of wanting to buy homes. But they did say that overall demand is running in line with what they had expected. They reiterated fiscal 26 estimates. The stock trades at 13 times. It's not very commanding. Believe it or not, the stock's only down 5%. I mean, the overall S&P down is 4%. You would think that if things were so horrible, it would be down double digits. And so I just think we have time. We have to wait for time. We have to wait for rates. But this is one of the best. Toll Brothers is actually flat on the year. It's beating the S&P, and that one is high end, so they're more insulated, and it trades at 11 times forward estimates. So when we get mortgage rates to be our friend, that's when these stocks are going to do well. In the meantime, they're just going to be flattish to whatever they're going to be.
Sideways. I mean, that's a sideways.
Flattish.
Now, it could be worse. I mean, those are neutral at Seaport, Toll, and DR, which are your stocks. You could have Pulte Group, which they have as a sell. Oh, you have Pulte.
I do.
Group.
Yeah.
Joe.
I do. So that position is now not looking so good. And everything that Steph said is accurate. We need a better, as you move into the spring selling season, you need a better rate environment. Just not seeing that currently. They have cleaned up the balance sheet remarkably well over the last several years. That's one of the reasons why we own that home builder over the others. But the momentum is broken down, and as you move along in the spring selling season, if you don't see the drop in rates, this is not going to look good at all.
That's about as good. Can you put the chart back to where you just had it? I think it was a year to date. That feels like the best psychology chart for the outlook for rate cuts.
100%.
It's
and
perfect.
there, by the way,
back earlier in the year, everybody thought, well, the Fed's definitely going to cut rates. Stock comes off the mat, looks like a mountaintop. Then all of a sudden, that dynamic completely changed. Bye bye.
We have, and if Judge, we have some bigger problems in this space. Hunter Brook Media, Sam Koppelman, they have a piece out a couple of days ago talking about how what these companies have done while the housing market is depressed. They're not building a lot of homes and putting them into the system. They're taking their land, sending them to a land bank, getting them off of the balance sheet, and in exchange paying a very high interest rate, in some cases in the form of, we'll owe it to you when we take the land back and build the home. This has been building up. I think Hunter Brook was writing specifically about Lennar. Give me this LEN chart. This is beyond the problem with interest rates. This is a way bigger problem, and you could longer than this. You can see this thing is basically for the last year been a falling knife. The land banks are charging these companies a fortune, but the companies need to offload so that they can make their near-term earnings look better. The problem is, even if rates come down and they start selling new homes at a brisker pace, and even if they don't have to do it with these incentives, they are still borrowing from future earnings in order to make the numbers look more decent today. And so I think it's a secular problem for the home builders that we've been in this depressed housing market. So if you want to play falling rates, I'm long Rocket. To me, that's the better play than owning the construction companies themselves.
So the chart that you referenced for Pulte year to date, if we could put that back up again, you will see where the peak is. And now put up a chart.
That's peak rate cut.
Peak rate cut, peak optimism on the broadening out narrative. Now show me the S&P value, because you will see it's the exact same chart. And that's when value, their S&P value, if you could, that's when S&P value topped out
IVB?
at that very moment.
Well, that's why we say that the dynamic potentially around value has changed with the war.
More towards growth, 100%.
Yeah, but it's interesting. Today, growth is actually massively underperforming value.
I don't think you can judge today's trade by anything.
But you could also
honestly.
judge equal weight year to date versus the S&P 500. You sure can, and the equal weight is still outperforming the overall S&P market cap weight.
It is not since the war started, right?
Year to date, it is the numbers
I understand,
are the numbers.
But listen. I get that, but there was a dynamic change as we moved into March.
Well, obviously, I mean, you can see that.
Well, that's why that's why Steph is saying year to date the S&P equal weight is outperforming. She's 100% correct. But since we've introduced this conflict, there's been a dynamic change in the way the various factors are
because,
trading.
Joe, the interest rates at that peak over there started going up and the value started going down.
Absolutely. You're validating my point.
Hey,
There was a change.
if a football team wins their first 8 games and then loses the next 5, you can't say, well, hey, the first 8 were great. Your record is what it says.
Equal weight
record is what it says it is.
Equal weight outperformed at its peak 600 basis points to the S&P 500 market cap weight. It is now still outperforming by 400 basis points. If it has lagged the overall market cap basis, well, that's fine, but it's still outperforming. It hasn't totally collapsed. And that's
I know, but if I won the first 8 games and I lost the next 5, I'm still above 500. I've got a winning record, but
if it was so terrible,
my season's changed.
If everything was changing and it was so terrible, then the equal weight would be worse than the S&P.
Well, I don't have a losing record yet.
The problem is you don't have the Mag 7s participating. That's your biggest problem.
Well, now you do. Over the last week, you do.
A couple of them, not all.
Almost all of them are green for the last week.
Well, every index was up last week.
No, but the NASDAQ has had the biggest jump off of the war bottom than any of the other major averages.
By 100 basis points.
But it doesn't matter. It still has.
Okay, we'll see if it lasts. I hope it does. I have plenty of names in that index.
Well,
I guess guys, respectfully, you had a rebalance.
Yeah, I got to go to the news. Sorry.
Isn't this the news?
No, this is Angelica Peebles has the news. Oh. See the news update.
Hey, Scott. Bill Gates will appear before the House Oversight Committee for a transcribed interview on June 10th. The billionaire Microsoft co-founder will offer testimony as part of the Epstein investigation. According to the Wall Street Journal, Gates apologized to his staff at his foundation about his relationship with the late sex offender, but said he never saw or did anything illicit. Anthropic is reportedly making a bigger play for business customers. The Wall Street Journal reports the company is planning to invest $200 million in a new initiative with private equity firms designed to get the firm's portfolio companies using Anthropic's technology. The report says the project could raise $1 billion in total and is backed by General Atlantic, Blackstone, and Hellman & Friedman. And Netflix is launching a new app for kids featuring games built around popular characters from Sesame Street and Peppa Pig. The Playground app is designed for children 8 and younger and is included in all levels of Netflix membership. Scott, back over to you.
Okay, Angelica, thank you very much. Angelica Peebles coming up. Josh Brown's best stocks in the market. The 3 travel names that made the list. We will tell you what they are next. All right, welcome back. Josh Brown's best stocks in the market. That's what time it is. Tell us more.
So the one area we have demonstrable evidence the consumer is not pulling back is travel and experiences. They're going to F1, they're going to concerts, and they will not stay off the airplane. And so I want to talk about 3 stocks in the travel space. We've talked about 2 of them before here on the show. Then I have a new one. Hilton is on my list of best stocks in the market. I don't know if you know this, Judge. Most people probably don't. Over the last 10 years, it has a better annualized return than Meta, Amazon, and Microsoft. It's tied with Alphabet. So this has been a great stock for a long time. They report later this month, 9% top-line revenue growth expected, 38% EBIT growth, and about 14% earnings per share growth. Pretty darn good. Yes, the stock has lost its 50-day because people freak out over high oil prices. The ETFs sell stocks randomly. But I really think it's the 200-day that matters here, which is about 280. I like the risk reward. To me, this is like a B. Marriott is a B minus. The Bonvoy loyalty program expanded by 43 million members to about 271 million members. This is one of the biggest travel businesses in the world. The breakout failed, but the stock is still hanging in there. I think with this one, it's a B minus. You got a 200-day around 290. You can see that that's been important in the past. That's probably support, but there's a lot of distance between here and there, so maybe not the best risk reward. The one I like is Viking. I've never talked about this name before. This is cruises for those who enjoy cruises. I'm not one of those people. This is the fancy river cruises in Europe, maybe someday before I die. As of mid-2026,
I see you doing that.
They had already booked. Yeah, maybe.
I do.
They had already booked 86% of 2026 capacity. Like, the whole year is booked out already. $6 billion in advance bookings. It's unbelievable fundamentally. I think technically, by the way, Bank of America today just put it in their US 1 list. Just added it with Spotify and Microsoft. So I think today it's very simple. 200-day 65. That's the line below which we're no longer interested in the short term. Above there, I think the stock works. 80 is the trigger. If it breaks 80, it could be a $100 stock. So those are my names in travel.
Okay. Check out Josh Brown's best stocks in the market on CNBC Pro. Thank you very much for that. Coming up, new allegations of, quote, harassment, deception, and anti-competitive behavior, end quote. We got the latest in the battle between Sam Altman and Elon Musk. Full details next. welcome back. It's been a minute since we've heard about Sam Altman versus Elon Musk, but here's their battles escalating. So says Mackenzie Sigalos. Hi, Mac.
Hey, Scott. So we got OpenAI trying to turn up the pressure on Elon Musk ahead of their trial that kicks off later this month. Our Kate Rooney got a hold of the letter that OpenAI sent to the attorneys general in California and Delaware, where the company urges them to investigate what it calls improper and anti-competitive behavior by Musk and his associates. That letter, written by OpenAI strategy chief Jason Kwan, alleges that Musk has been trying to undermine the company through a broader campaign of attacks, including legal pressure and coordinating with rivals, specifically singling out Meta and Mark Zuckerberg. Kwan says that behavior could also hinder OpenAI's efforts to bring about artificial general intelligence. The letter citing a recent New Yorker report claiming that Musk's intermediaries conducted opposition research on Sam Altman, including tracking his flights and circulating false allegations. OpenAI is tying that broader campaign to the competitive stakes here, arguing that if Musk's legal efforts succeed, it could benefit xAI and Grok, which is now part of SpaceX, and helping justify that reported $2 trillion valuation target. Scott?
Okay. Mac, thank you very much. How do you guys think about this? Are you looking forward to these IPOs, Sarat? Douglas C. Lane, portfolio manager, going to load up, back up the truck?
You know, I'm
back up the golf cart in your case?
I'm very interested in seeing the S1 to actually see the details of all these financials and looking at the cash flow before kind of making a decision, because I think at $2 trillion, there's got to be something in there that to show the next growth for the next 5 to 7 years.
If I said you had to buy one of the IPOs, either Open or Anthropic, what would you do?
Oh, Anthropic.
Anthropic all the way.
All the way. Anthropic has the enterprise. Anthropic has the growth. Anthropic has
they just that $30 billion run rate. Now
better experience in Claude. If any, I use Claude Max. It's phenomenal relative to what you could
buy
use
Amazon.
with OpenAI.
Okay.
Or Zoom.
You buy Morgan Stanley and Goldman Sachs, is what you do.
Well, that wasn't their choice. He was asking.
Well, that's my choice. That's my.
Zoom is the one that.
We'll ask Santoli next. What do you think? Welcome back. Senior markets commentator and overtime co-anchor Michael Santoli is here, as you see very clearly from that nice wide shot at post 9 for his midday word. I mean, you can't really make any judgments about this market today, I don't think,
Not
at all.
much. I think what you could say is the market is clearly antsy to move on. It's looking for any excuse why it might be able to do that, whether it's delinking a little bit from every tick in oil or kind of relying on the stuff that's held up better to shine through and maybe get past this point when, only one story matters. I mean, banks look fine. They have for a little while right here. Corporate, risk spreads are down on the bond market. So the market wants to sort of say that the fundamentals are okay if only we could focus on it. We just don't know if we're going to be allowed really to focus on that and to get this essentially this bet on de-escalation redeemed.
What do you make of the Apple slide today? Just don't see it that often on foldable iPhone delay.
It's funny because we can all think back to these reports where a lot of times there's a supply chain related story coming out of the trades or a foreign wire service, and the stock sometimes does kind of react to it, and then it sort of seems like maybe that wasn't the point. I think it says much more about positioning. I said earlier, you had built up a lot of this defensive bid in the stock. It's just unwinding, coming back to before. It's right in line with the NASDAQ 100 on a 1 month period.
All right, good stuff, Michael. Thanks. I'll see you on the closing bell. That's Mike Santoli. We'll do finals after this break. All right, welcome back. I would like to call your attention to CNBC's next big event. It is Converge Live. Kicks off in just 2 weeks in Singapore. Look who's on the board there. Look who's on the board there. I will be there. Morgan Brennan's going to be there. Dee's going to be there. Sedgwick from Europe's going to be there. We got a great group. It's going to be really exciting. Some of the world's brightest minds are shaping the future of business, sports, and entertainment are also going to be there. And if you want to be there, or at least you want to know what's happening there, you can go to convergelive.com. Final trades are next. Josh Brown, your final trade, please.
Heading to Netflix here, under 100.
Okay, thank you. Who's got Hershey? Hershey. Hershey? Nobody.
I'll take Hershey.
Yeah?
Skinny Pop,
All
for
right.
sure. We own it in the ETF.
Okay.
I think I have two.
Who's got Morgan Stanley?
That's me. I put Morgan Stanley.
All right, who's got Pepsi?
I have Pepsi.
I own
18
Pepsi
times
too.
forward estimates.
You have that too?
Yeah.
I have two final trades today. Alphabet and Hershey.
This went off the rails before
That
it even
doesn't make
started.
you happy. Yeah, I have
Right?
Alphabet and Hershey.
Okay. I'll see you on the closing bell with Liz Ann Saunders and the professor, Jeremy Siegel. The closing bell. On the closing bell, the exchange is now.
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans. Take a close look at the markets, which are off session lows, but still down 235 points right now for the Dow. That's a 0.5% drop, similar for the S&P 500. Hopes were fading for a deal before this 8 p.m. deadline. We have 7 hours to go, although there are reports from Axios that there is a glimmer of progress in talks. That's in the past half hour or so. We'll keep an eye on to see if that changes the trajectory here. And with the U.S. reportedly striking several targets on Iran's Karg Island, where they export oil, that has prices rising and stocks lower this hour. The Nasdaq was down 1.5% at the lows. The VIX Volatility Index jumping to nearly 27, as you can see there. As for oil, we hit 117 earlier on WTI. It's up 5% in 2 days and up 75% since the war began. The president, in a Truth Social post this morning, warning that a whole civilization will die tonight. He says, I don't want that to happen, but it probably will. Although he added maybe something revolutionarily wonderful can happen. Who knows? On that note, let's get right over to Megan Casella. She is at the White House with the very latest at this hour. Hi, Megan.
Kelly, we are very much on the brink at this point of a vast escalation of this war, both the U.S. and Iranian sides ramping up their rhetoric and their actions ahead of what the president says will be his final deadline tonight. And diplomatic talks do appear to be on shaky ground. A Pakistani government official close to the peace talks telling our colleagues at MS Now that there is no hope that anything will be confirmed today following U.S.-Israeli attacks on Iran and Iranian attacks inside Gulf states. It's looking very unlikely. And then the only thing we've heard directly from the president so far today, you mentioned this, was that inflammatory Truth Social post where he warned that a whole civilization will die tonight, never to be brought back again. He added that he did not want that to happen, but that it probably will. And Kelly, it remains unclear at this point what sort of a deal to avoid escalation would satisfy both sides. The president saying that he needs to see free flow of oil through the Strait of Hormuz, but the Iranians saying that they will not open the strait in exchange for what they call empty promises, and saying that they're not interested in a temporary ceasefire. One point, though, possibly in favor of a diplomatic resolution. Vice President J.D. Vance earlier this morning saying that the White House is confident that it will get some sort of a response from the Iranians before 8 p.m. tonight, suggesting there could be potentially room for a way forward. Kelly?
Megan, say that last part again real quickly to make sure we caught that.
That was Vice President Vance talking with reporters in Hungary, where he is earlier today. And what he said was that the U.S. is confident that they will get some sort of a response from Iran before the 8 p.m. deadline. He said he didn't know if it would be positive or negative, that sometimes it's slow to get a response from the Iranians, but he did think they would get something. That suggests that at least negotiations are ongoing and that he believed, as of this morning, that there potentially could be room to move forward.
All right, Megan, thanks very much. Appreciate it. Megan Casella. The energy markets, as you see, are on edge as time runs out to strike any kind of deal. Let's bring in Dan Yergin for more. He's the vice chairman of S&P Global, along with Charles Kupchan, who is a senior fellow at the Council on Foreign Relations. Really great to have you both here. Charles, if you don't mind just kind of kicking it off with the latest diplomatic geopolitical analysis that you can have with this deadline looming.
Well, you know, Trump has walked back from deadlines before on Iran, on Greenland, on tariffs. I don't think he's going to walk back from this one. And I say that in part because of the stark nature of the pronouncements today. Hard to back away from threats to end Iranian civilization, to hit them hard. And secondly, Trump's under time pressure, right? This is a war that has gone on longer than he expected. The impact on global energy markets is huge. And I think Trump needs to move quickly to try to end the war. I'm not optimistic that we're going to see a breakthrough in the next 12 hours or so. Let's wait and see where we are at 8 p.m. But so far, the Iranians don't appear to be ready to meet any of the demands that the Trump administration is putting forward.
Dan, what does that mean for oil prices? If, you know, I've seen people now saying this could go on for a decade. We see that the price of oil has had a little bit of a delayed response as it shows up in the markets, kind of the shortages. So does it get worse from here?
Well, of course we are, unless the strait opens up. It will get worse. It's already getting worse. You know, you have that futures price for Brent, but if you look at the price that Brent is actually trading at, physical cargoes, it's more like $140. And you have shortages, you have rationing in one form or another, restrictions being put on in Asia, you have jet fuel getting tight in Europe. And so we're already in it. And as longer this goes on, the longer the pressures in the marketplace.
Is there any other way for the market, Dan, to clear the oil supply out of this part of the Mideast? Is the strait the only, yesterday we spoke with Richard Haas, who said maybe we should do some kind of blockade, I think at the port of Oman or the Gulf of Oman, which is slightly to the east. And because Iran now has a situation where they're letting cargoes through, I guess, if they pay in yuan or stable coin, and if they're not involved with Israel or the U.S.
And of course, the Iranian oil itself is getting sold, and it's getting sold at higher prices going to China. So that's one possibility. The one relief valve that's really here is that the Saudis, because of the Iran-Iraq war in the 1980s, built this pipeline system. So they're able to send a substantial part of their normal exports to west to the Red Sea and export them, those barrels. The UAE has a pipeline that can get out, maybe about 1.5 million barrels a day, except the Iranians keep attacking it. So on balance, that maybe, at the minimum, maybe 10, 12 million barrels a day are not getting to the market. Others are there, but these markets are disrupted. And I'll tell you, there's a real split between sort of the financial markets, which are kind of expecting some kind of short-term, this will get resolved. But if you look at the physical constraints, I think you'll hear from the industry, and we heard this at our CERAWeek conference, that risk is that the price is underpricing. Risk is underpriced right now, given where we are and the kind of rhetoric and the language that we're seeing. And I think the other thing to say is the Iranians, I think, have made it pretty clear, if their basic infrastructure gets attacked, then the infrastructure of the Arab Gulf states gets attacked. And that's not only factories, that's not only military installations, but it's also desalinization plants.
Charles, the sort of threats against bridges and power plants that the president is making, is that specifically so that it would keep the Iranians from having missile capacity, kind of attack capability on the rest of the region? Would it get directly to kind of stemming this retaliation that Dan talks about from happening?
Well, I think the Trump administration expected that Iran would not have the ability to retaliate 5-6 weeks into the war. They're continuing to hit Israel. They're continuing to hit the installations that Dan was just talking about. They shot down a couple of American aircraft, and others have been destroyed on the ground. So Iran is showing more resilience than I think anybody expected. I think the Trump logic here is escalate to de-escalate. Hit them hard, hit civilian targets, hit people where it really hurts: electricity, water, food, the ability to get around the country, as a way of trying to get the Iranians to cry uncle. Is it going to work? We don't know. I think in the short term, Iran is going to do exactly what Dan was saying. They're going to go after energy infrastructure and desalination plants throughout the region. And that's going to exacerbate the problem that we're now facing with global supply. I think Trump, in some ways, is in a tough spot here because he can't let this war go on and on and on. You can't really open up the Strait of Hormuz, which is narrow and shallow, with a war going on. Tankers aren't going to go through. Warships aren't going to go through if they think they're going to get hit by Iran. So I think in some ways what Trump is doing here is saying, we need to end this war. We need Iran to agree to a deal at the negotiating table. I'm going to hit them harder and harder and harder until they say yes. Let's see if it works. Let's see what happens after 8 p.m. tonight.
Dan, you want to respond to that?
Well, I think that's true, that the president from the beginning has said this would be a 4 to 6 week war. He doesn't want to see it going on. He knows what's happened to prices. And the U.S. is not insulated from this. it's not only the price at $4 a gallon or above that at the pump, but it's kind of the whole world economy. Because one of the things that has been discovered, for all those years of wargaming, people focused on the oil and gas coming out of the Strait of Hormuz. They didn't focus on the fertilizer. They didn't focus on the helium that you need for semiconductors. They didn't focus on the sulfur. They didn't focus on the aluminum. And they didn't focus on the amount of money, of course, that those countries, the Arab Gulf countries, export. So this is a big hit on the world economy. And the U.S. is not insulated from it, even though we are in the enviable position of being the world's largest oil producer, which means we're not where the Europeans are, we're not where the Asians are. But at the end of the day, this is a global economy.
Quickly, Dan, $4.14 is now the national average for the price of gasoline. Why is Brent, last time I checked, is Brent now back below the price of WTI? Or to put it differently, why are the two trading where they are? Traditionally, we see Brent trading at a little bit premium, a little bit higher price. That's gone away. Sometimes WTI is trading a little bit higher. Both of them influence the price at the pump, so it's not like we need to focus on just WTI.
Well, it may well be because, of course, Brent oil is not, WTI is not impacted, unlike Brent. But Kelly, keep your eye on that dated price, because that tells you what's actually happening where people are trying to get oil and can't get it.
Yeah, 140, as you said, out there in the markets, for the physical product. Gentlemen, thanks. We appreciate your time. Thank you both. Dan Yergin and Charles Kupchan joining us here. Talk about the impact this is having. Stocks are sliding as ceasefire hopes are fading somewhat. And our next guest says the market is now firmly pricing in inflation. And the next stop, if the war continues, is stagflation. Michael Kantrowitz is the chief investment strategist at Piper Sandler. It's great to see you.
You too.
I think it's worth highlighting that you've emphasized over and over again the importance of falling inflation and falling interest rates to the bull market. So where does this leave us now?
Well, besides AI earnings in 23, 24, and 25, outside of AI relevant stocks, that was the big bull macro case, that inflation, energy prices, interest rates, long, short, mortgage rates, all came down for about 2.5, 3 years, which set up the economy coming into this year for a huge amount of tailwinds, which we're still seeing. The Bloomberg Economic Surprise Index is sitting at a 3-year high.
Wow.
We've seen the services new orders component, which came out earlier this week, at 60, the highest also in about 4 years.
Wow.
So there's a lot of economic momentum. And our concern is not that we're going to see a sharp deterioration in the economy, but more so that we've been in a new inflation regime where inflation fears are driving risk premium, i.e. they're driving market multiples. And as they came down in 23 through 25, it lifted multiples across size categories. And in the last month and a half, we've seen that multiple deteriorate roughly to where I kind of point out is the market pricing in inflation at about 18 times earnings. If this persists, we'll start to see negative economic data. And if you get demand destruction and oil prices remain high, the specter of stagflation becomes the word of the day.
Talk through what this means for tech stocks, energy stocks. It was interesting last week you saw, oil prices doing what they're doing today, but energy as a sector was kind of taking a breather a little bit. There's questions about whether to get defensive if everything's going to soften like you describe, or if the economy's going to be able to have staying power and say, okay, maybe we're coming closer to the end of this thing and all of those positives that you describe will carry us through.
Yeah, I see basically 3 different scenarios. 2 of them are in the tails, and they're very fat tails. And then our base case in the middle. And so you can position very defensively for stagflation and a persistent ongoing high price of energy, or you can play for the opposite, that things do get resolved, the strait opens up, oil crashes down lower, all of these fears go away, and the market multiple regains its strength, and we get lower interest rates, and we go back to where we were 2.5 months ago, a pretty good backdrop with mortgage rates touching below 6%. The challenge in that for investors, it's a very binary situation, and it's being controlled by policymakers, not the insides, the inner workings of the economy. So it becomes really tricky to position in one of those buckets. Our view is that we want to be more kind of in the middle, not trying to time the market, time oil prices, time the headlines, but recognize that we've now got this inflation fear that's building, that the economic data is going to start to deteriorate. We haven't seen much yet, but again, it's only been 5 weeks. That's not a long period of time. And so positioning there is basically being really diversified and trying to survive this backdrop of headline volatility, inflation pressure, to look for stocks that can weather the storm. And I don't think that means you want to be really concentrated. And even the AI stocks, there's a lot of questions about those names at the beginning of the year. And at the time we were seeing markets rotate into more cyclical names.
What about, we're going to talk to Victoria Green a little later this hour. She said she's kind of fire sailing international stocks and things like that, which, I mean, so going back to January, like you said, and everything kind of looked like full steam ahead, AI, you wanted to go international, it was outperforming the US and everything. And then we've kind of seen it backtrack as the Iran war has broken out. I don't know if you have anything to say about that positioning as well.
In a way, that's effectively being long oil prices, because if we do get some relief, where are you going to, wherever the pain's been the greatest as a result of high energy prices, it's going to, markets typically see the opposite on a rebound. You tend to get these V-shaped bottoms, and investors that were in the right area as the market was struggling can quickly lose all of that outperformance if you don't get out in time. So it becomes a market timing story. And again, I think you want to be diversified around the world. Yeah, there's countries that have much greater energy sensitivity, like Japan, for example. Yeah, they're going to get hit hard, but the day things do find some relief, that will probably be the best performing area. So I think you just got to be really diversified and pick your stocks, and not pick stocks based on earnings more so than macro.
And I thought we saw a little bit of almost head fake relief if you go back a couple of weeks. I mean, just about 10, 14 days ago, we had WTI crude oil in the mid 80s. Yeah. And it looked like, okay, we had this peak of activity on a weekend. We've kind of come back from that. That was when we had the since deleted tweet about kind of taking ships through the Strait of Hormuz. Yeah. So we've had a taste of what that might look like. Yeah. The problem now is that we're still $30 higher on the oil price than we were back then. Mm-hmm. And I'm not sure if there's going to be a moment, if it's tonight or if it's in another week, or maybe it's the first time a headline hits the tape that says Iran agrees to a deal and the oil price falls $20. That would be an obvious all clear moment. I'm just not sure if we're going to get that.
Yeah, it's hard to know what an all clear moment is, and it's certainly not seemingly just something that President Trump can do, like he did last year with tariffs. This is at least a two-party situation. So, we've been hearing all this positive news out of the administration in the U.S., but whether it's you want to hear that from Iran as well, and that to me is the all clear in this scenario. So, I don't think as analysts and strategists, I don't want to try to time the market here. We shouldn't be timing the market in general, but in the short term, something that's very exogenous and is really something I think you just have to survive the period. But what your point about how the market performed in those days where oil did come down, that shows you what's going to work. And it was home builders and consumer stocks and international names as well. But again, unless you have clear clarity on when exactly that's going to happen, which nobody does, it makes it a very challenging environment. So our base case is that, again, oil prices are going to remain somewhat elevated. I don't think we're going to get back to $60 very quickly. And if we do, that's great. But if we remain in an area where it's $80 and above, what the lagging concern of that's going to be is this persistent worry about inflation. That all really started from 2022, that every time we see interest rates back up, above 4.25, certainly 4.5, equity markets don't do well. So you got to get not only oil down, you need to get the 10-year down as well.
Bingo.
And those may not perfectly correlate because of the investors focus on the data that is
or
going to
some
come
of the
out.
bigger, I think about the bigger picture trends here, whether it's do other countries continue to use the dollar as the global reserve? Do they need the treasuries that they once did? I mean, I even look at the Medicare reimbursement rates. Okay, we're back up to 2.5%. The defense budget's going up 40%. So there's a lot of things that could keep that from snapping back down, along with the oil price.
Yeah, and it gets all of those conversations, which we saw so many times in the last few years, start to again weigh on the market. The deficit.
Yes.
Really, no one's been talking about that in that everyone's focused on oil.
Right.
But it's not just oil. It's mortgage rates. It's the fear of the deficit again. It's the fear of Fed hikes, which I don't see the Fed hiking at all from this scenario. But the market is obviously pricing that differently compared to the beginning of the year. So again, it makes it such a binary backdrop because all of those issues will just continue to percolate until oil prices begin to come back
To quote
down.
the late, great Art Cashin, stay nimble, stay alert. That's what he always said. That was his tagline, which seems appropriate right now. Michael, thanks. Appreciate it.
Good to see you.
Michael Kantrowitz with Piper Sandler. Coming up, new deals with Anthropic and Alphabet have Broadcom shares jumping today, but another tech name could be the biggest beneficiary of these deals in the long term. We'll talk about that next. We're also keeping an eye on shares of Apple, which are down as much as 5% earlier on a report from Nikkei Asia that its foldable phone is experiencing some engineering setbacks. It does raise questions around its launch timeline with the iPhone 18 cycle in the fall, but just within the last few minutes, Bloomberg reports the September debut is still on track, and the shares are down less than 3%. And while we wait to see how that plays out, Bank of America notes this morning that App Store growth has been slowing. And I've been wondering whether some iPhone fatigue could be setting in. For more, check out my newsletter. Just scan that QR code on your screen. And The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. In a deal that could reshape the AI market, shares of Broadcom are moving higher on a deal to develop and supply Google's in-house chips for the next 5 years. Mackenzie Sagalos brings us more in today's Tech Check. Hi, Mackenzie.
Hey, Kelly. So Broadcom may be getting the bounce today, up around 5% right now, as it becomes this new arms dealer for this AI custom chip era. But Google is the one turning that demand into a full stack mode, now monetizing nearly every layer of its AI business. For a decade, TPUs were Google's in-house edge, built to optimize search and to train and run its AI models. But now Google's turning that internal advantage into a competitive business. Anthropic, Meta, and Apple are all leaning into Google Silicon as a cheaper alternative to NVIDIA. And that's especially significant because for a while, investors worried that AI would cannibalize Google's core search business. And instead, ads have beat estimates the last several quarters running. Revenue keeps expanding, and Wall Street is starting to buy into a more aggressive growth path for the company, with Google now flexing what's perhaps the most competitive vertically integrated stack in all of big tech right now: the AI models, cloud platform, distribution, and a chip business that's starting to look like a real revenue driver. Morgan Stanley estimating that for every 500,000 TPU chips sold to a third-party data center, it could add 40 cents to earnings per share. D.A. Davidson's math puts Google's commercial chip business on track to take 20% of the AI market, making it a roughly $900 billion opportunity, potentially worth more than Google Cloud itself down the line. Kelly?
Wow, that's something to ponder. Mackenzie, thank you. Mackenzie Sigalos. We have a couple other big movers today as well in the chip space on some notable calls. Morgan Stanley downgrading ARM to hold on a slow commercial ramp. They're talking about end market softness, DRAM shortages, and a changing margin profile could limit earnings momentum. Those shares were down nearly 7% at the lows. Wells Fargo is also raising its price target on Intel by $10, seeing positive setup ahead of Q1 results later this month, thanks to strong server CPU demand. And those shares are popping about 3%. Our next guest, bullish on semis, has a few names in particular he's buying. What are his thoughts on the overall market here? Let's bring in Jeff Kilberg, the founder and CEO of KKM Financial and a CNBC contributor. Jeff, I'll start with you. We always watch the chips for two reasons right now, because the AI trade has been one of the more sure things in a tough market. Also, it's typically a leading indicator. And if we're running into some cyclical slowdown, you got to wonder about that. So how are you positioning?
Well, I'm a little more optimistic than most, but semiconductors, I don't want to call them a safe haven, but look what they've done this year. If you look at SOX, which is a very popular ETF for semiconductors, and you see up about 14% year to date. So I get excited about some of the individual names. Intel, you just talked about Broadcom and Google. You could equally talk today about Intel and Tesla and XAI and the Terafab. So everyone's kind of racing towards the semiconductor space and making chips inside. So I look at some of the names, and we manage our Mango Growth ETF, ticker symbol Gary. We've been able to dance between the raindrops. That's why we're up 6% year to date when growth has really been repriced. If you look at the Mag 7, repriced in general down about 15%. So think about some of the names. I know Micron's a favorite name. We also talk about Applied Materials, Lam Research. These are names that you have to be tactical in. But I look at Intel, for the first time getting above $53, there is some more room to run, specifically in Intel.
And you said you're more optimistic than most. What's your thoughts, Jeff, on kind of the whole AI trade? Do you stick with that segment of the market? I mean, in ARM's case, they're having a little bit of a problem from the memory shortages. Do you still like the memory names?
I still like memory, but let's just look at the dispersion, Kelly. If we look big broader, take a step back, this has been the most unusual dispersion. We've never seen S&P 500 sectors with 50% dispersion. Obviously, energy leading the top end, financials on the bottom there. But what we have is dispersion inside of tech. Software has been repriced, somewhat could argue decimated, but I think semiconductors and being considered of what is going to move forward the AI race. We don't think AI is going to be lagging. We love the fact that the valuations across the board have come down in the NASDAQ 100, but you still have to be a stock picker here. There's a lot of noise. Obviously, we have to get through tonight, 8 p.m. Eastern. Everyone's going to be looking at their watch, but I think bigger picture earnings season is going to be much better than expected, and we're on our sixth potential consecutive quarter of double-digit growth. So I have a little more enthusiasm. I know people are kind of cheering the market goes down a little bit, but I think the market's come down far enough, Kelly. It's time to buy.
What about that inflation concern? And, inflation's such a loaded word. This is different than 2022. This is really a price shock in a couple of particular areas affected by supply shortages, where that one we had fiscal stimulus, we had monetary stimulus.
That's right.
This time's a little different. It's more like a tax, so which raises the. So we have both this kind of price shock inflation concern and a slowdown concern at the same time. Are you dismissing those?
No, I can't diminish that. There's pay at the pump right now, national average above $4. Remember, in 2022, the national average was over $5. So this isn't new for the consumer. But what is interesting, when you look at crude oil at $115 a barrel, that duration is going to have an effect. However, everyone that was talking about the effects that tariffs were going to have just a year ago, they never came to fruition. We didn't see that inflation. So I'm kind of in the same camp. As long as the off-ramp to Iran is in place in the next week or two, we have the ability to kind of make this a blip. If it goes further than that and we see WTI crude oil stay above $80 or $90, yes, Kelly, that's a problem.
Okay, so in the next week or two, above $80 or $90, those would be more of your watch points for now.
Yes, I think we break $90 and it's kind of the all clear. We talked about that last week, but we would see nothing but crude oil stay elevated. And yes, that is a problem for inflation. It's a problem for economy. It's a problem for the consumer. But I do think that there's some offsetting tailwinds. Lower interest rates are coming with Kevin Warsh. Don't know when, but they're coming. We also see an earnings season that's going to really, hopefully, knock the cover off the ball.
I don't know when he's coming at this point, but we'll get those confirmation hearings at least underway soon. Jeff, thanks very much. Appreciate it.
See you, Kelly.
Jeff Kilberg. Still ahead, UBS is the latest Wall Street firm to lower their S&P target amid this market turmoil, taking it down 200 points to 7,500, still a nice upside from where we are today. We'll look at the impact the Iran war is having on Main Street. Plus, with just hours to go before President Trump's deadline for Iran to reopen the Strait of Hormuz. We'll get the names our trader says offer protection in the meantime. The Exchange will be right back. Welcome back to the Exchange. With the markets, as you see, still in kind of a sell-off position. Really feels like a holding pattern and a cautious one ahead of the president's 8 p.m. deadline for additional strikes on Iran. In the meantime, take a look at the health insurers, which are getting a big boost today. United Health up 10% for its best day since August, after the Trump administration finalized a nearly 2.5% increase in payment rates to privately run Medicare plans in 2027. That's what determines how much insurers can charge for monthly premiums for the plan benefits they offer and for their profits. Remember, the original proposal was almost zero. This is a big turn of events. Shares of CVS and Humana are up as well. Let's get to Angelica Peebles for the CNBC News Update. Hi, Angelica.
Hey, Kelly. ICE arrested more than 800 people at the tip from TSA agents from the start of Trump's second term until February. That's according to Reuters. That number much higher than what was previously known, Reuters reported, citing internal ICE data. That data does not include President Trump's deployment of ICE to airport security lines last month. U.S. Trade Rep Jamieson Greer says the U.S. likely will not reach an agreement with Mexico and Canada for the USMCA by the July 1st deadline. The current agreement was agreed to in 2020 and is up for review this year. Greer said that Trump is dissatisfied with a lot of the outcomes of the USMCA. And Samsung announced today that it is discontinuing its Messages app on all of its Android devices by July 2026. The phone giant is asking all users to switch to Google Messages to maintain a consistent messaging experience. Users can check the Samsung Messages app for an exact date for end of service. Kelly, back over to you.
It's funny, we were just writing about all of this. Angelica, thank you very much. Coming up is the market approaching the point of no return. Our trader says we are getting close, especially if the U.S. follows through on the president's earlier threats. The names she's buying ahead of a potential recession. Yes, recession. We'll talk about that next. Is it too soon to start talking about recession? Not for my next guest. Even as many remain hopeful the Iran conflict will soon wind down, she is positioning for further economic fallout. Joining me is Victoria Green, G Squared Private Wealth CIO and a CNBC contributor. Victoria, in recent years especially, we've heard so much warning about recessions that never came to pass. People are conditioned to buy the dips, to stay along the market. And I mean, look, this is the playbook. So I'm curious, and it does bring my attention when you say you're positioning a little more defensively now. So I'd just love to know, how are you reading the markets and what are you doing exactly?
Yeah, absolutely. So one thing is recessions occur about every 6.25 years. And the last time we had a recession was 2020. 2022, we had a great bear market, a really solid sell-off, but there was no technical recession. So number one, we're getting a little bit of length in time between recessions, which, it can persist. I'm not saying that's the only thing we're looking at, but that's one indicator. It's been a while since we've had an actual recession here. Number two, oil above $100 a barrel is a tried and true recession trigger. Again, not always, but when you start piling these things together, you can make an argument that, hey, there's a potential a recession could happen if this continues to drag on. Our base case is still this conflict gets resolved. We can overcome this. We can think earnings growth is here, tax refunds, all the catalysts we've been talking about. My concern is the asymmetric risk going into tonight. So we did start kind of pulling back a little bit on risk. We did start preparing, and we also have an execution for how we're going to handle the rest of this week if we do have an escalation tonight. Again, base cases, that's not what's happening, but I think you would also need to start considering the massive asymmetrical risk. If this does really, really escalate overnight, then you need to be prepared for what you're going to do tomorrow. And you should be looking at your portfolio and how much risk you have on the table right now.
still, I think a lot of people would fall back to the escalate to de-escalate playbook, meaning the worse it gets now, maybe the swifter there's some kind of resolution, and those stronger economic cross currents that Michael Kantrowitz was talking about earlier on, those could continue.
Absolutely. Absolutely. There is a lot to be said for this bull market. We're not wholesale fire selling. We're not saying sit 30% in cash. All we're saying is be prepared. We've de-risked a little bit. We've taken a little bit of emerging markets off the table. We've loaded up a little bit on energy and real assets, but we still have core tech. We still have stocks. We're not sitting here saying the sky is falling. We're just saying we need to be prepared. Obviously, the trade that has worked is buy the dip, that the best case scenario is going to play out, that we're going to find a resolution. That playbook has worked continuously for the first term and the second term so far. But I'm also thinking there is a lot of risk going into tonight. And we also may not find a resolution tonight. We might punt it down the road 45 days. But we're not the only party in this situation anymore, right? We have Iran, we have Israel, we have our other Gulf allies. We have 4 parties we need to bring to a resolution that don't necessarily have the same goals. Again, all that's doing is increasing risk and making me a little bit more nervous. And for me, I just wanted to reduce that exposure.
So I'll run through it for people who want the specifics. We're showing some of this on the screen as well. But first of all, you would go overweight, or you are going overweight energy, and you note even in 2022, that was the kind of the bear market playbook. Energy was the only sector that worked. Obviously, it's the best year to date. It had a pull, but not a softening last week. Energy, you like names like Exxon, Chevron, those are in here, all the majors that we think of. You like aerospace and defense for obvious reasons. Same for cyber, so Palo Alto, CrowdStrike. And then you have some consumer staples names in here, a couple of nuclear ones as well.
Yeah, I think you want to be diversified. Look, you want some defense. We could see things like health do well, which they haven't done well year to date. You could see this flight to quality, to staples, to health. Energy should be the place to be. If this continues to escalate, energy should be the place to be. The IEA just came out with their short-term outlook today saying, hey, we've got about 9.1 million barrels a day that's now shut in the Middle East. That's significant disruption. It's going to take a while. You've got a lot of infrastructure rebuild. Even if we say go tomorrow night, yeah, the market's going to take off. We still like energy. You're still going to have to invest in this. We still have the AI power demands. We have all of those catalysts behind it. So for me, it's about hedging risks and putting eggs in a basket. I think could succeed both if we get a little bit of a resolution or if we don't.
And you, as you said, the area where you are more fire selling, to use a phrase, is emerging markets internationally. Say just not worth it to keep it as the energy crisis grows.
Absolutely. Asia and especially Europe, I think, are extremely vulnerable to that. I think you could see a large knee jerk down tomorrow in both of those markets because of how exposed they are to Middle Eastern energy. You're running out of floating storage. There's a lot out there, right? But you are starting to see, could they have issues with jet fuel? We've started to see maybe a little bit of shortages of jet fuel. All of that reverberates through this global interconnected economy we have. So even though, yes, we are well insulated here, the Permian's fantastic. We've got Guyana, we've got Venezuela. We have a lot going on in our hemisphere to help us with energy. We're not immune to costs, right? Yeah. Diesel over 5, gasoline prices. What does that do to the consumer? We've got PCE and CPI this week. We're expecting a little bit of a bloody number there on some of the headlines month over month. And if that continues to persist, then it does eat into all of the catalysts we have. It eats in the tax refund. You've still got the issues with tariffs also out there. And so it just becomes a little bit too much of a headwind.
It's not just California. Oregon and Washington State now have gasoline on average over $5 a gallon. So, Victoria, thanks very much. Appreciate it.
Thanks,
Victoria Green. Coming up, Taylor Swift, Lady Gaga, Ariana Grande, and Bill Ackman. With Universal Music Group having its best day ever, the shares are up more than 11%. We'll dig into what's behind the billionaire's push to acquire the record label when The Exchange comes right back. Welcome back. Shares of Universal Music are surging 11% after Bill Ackman issued a $64 billion takeover offer. It's a complicated story in some respect. Julia Borsten has more for us. Hi, Julia.
Hi, Kelly. Well, Universal Music shares are 11% higher today after activist Bill Ackman's Pershing Square proposed a $64 billion takeover deal. That would be at a 78% premium to the company's April 2nd closing price. Now, the world's largest music label is home to Taylor Swift, Billie Eilish, Drake, Kendrick Lamar, and Ariana Grande, among others. But its shares have been struggling amid slowing music streaming growth, as well as the cancellation of U.S. stock listing, among other things. Now, even including today's move higher, UMG shares are still down 17% in the past year and 30% in the past 2 years. Ackman saying that his changes would bolster the stock. Pershing's proposal includes moving the company to a listing on the New York Stock Exchange from the Netherlands, which would make it eligible for inclusion in the indexes. He proposes adding 3 directors, including Michael Ovitz as chairman of the company, and using AI to drive operational efficiencies in legal, analytics, and marketing. Now, no comment yet from Universal Music Group, but TD Cowen weighed in this morning, writing, while the offer appears largely to be an attempt at financial engineering, it does highlight what we believe is severe undervaluation by the market, given UMG's very strong business fundamentals. Now, this deal would require a 2/3 vote of shareholders. Ackman saying that the initial response of the Bolloré Group, which controls a 28% stake, has been favorable. Kelly, it's going to be a fascinating one to watch.
Indeed. We'll see how it goes. Julia, thanks. Julia Borsten. And coming up, a rough day for the home builders. Seaport downgraded the sector. They cite weak job growth and slowing demand. Wolf and JP Morgan see downside earnings risk. You can see KB almost 5% lower. But it's not just Wall Street rejiggering their housing expectations. Real estate agents are lowering their outlooks for the spring season as well. We have the results of the latest CNBC housing market survey after this. Welcome back. Hopes for the spring housing season had been high at the start of the year, with mortgage rates on the decline. But the Iran war has turned all of that on its head. Here on set with what we're seeing now is senior real estate correspondent Diana Olick. Diana, always good to see you. And this is the key moment for a lot of the industry. This is their Christmas, I guess you could say, and not off to a great start.
Yeah, exactly. It is their Christmas, but mortgage rates are now much higher than expected, and financial fears are front and center. Those concerns were already heating at the end of last year, but the war really turned up the gas. Buyers in the first quarter of this year were more concerned about the economy and mortgage rates than they were in Q4. That, according to real estate agents responding to the quarterly CNBC housing market survey. Just 9% of agents said their buyers were most concerned about home prices, and that is a sharp drop-off from the previous quarter's 18%. This, even as nearly twice as many agents reported home prices rising in Q1 versus Q4. And the economy led, even though mortgage rates during the quarter jumped sharply from a low of 5.99% on the 30-year fix the day before the war started to now hovering around 6.5%.
They're fearful of the war. They're fearful of gas prices. Their job security, you know, with all this news lately about AI and AI taking over work, that kind of thing.
Affordability is still playing heavily into why more buyers are leaving the market. 19% of agents reported buyer exits, compared with just 11% at the end of last year. More than half of agents also reported at least one contract cancellation.
You're just seeing buyers that were on the fence and deciding to buy are now on the fence and going the other direction, saying, I'm not going to buy.
Now, there is so much more in the housing market survey, and you can find it in this week's Property Play newsletter. Make sure you're signed up, cnbc.com/property play.
But it's really the turnaround in mortgage rates, you think, that going on the rise again?
I mean, honestly, in the survey, it was pretty close to economic uncertainty.
It was,
yes,
really?
Yeah.
Wow. Economic uncertainty is already...
Absolutely. And don't forget the stock market, too. For higher-end buyers who are looking for, what's happening with the markets, did they just lose a ton of money in the last couple of months? That plays in as well.
All right, Diana, thanks for now. Diana Olick. Our next guest says mortgage rates, like we were just discussing, they're not the only headwind either. We still have tight supply as an issue, along with those what Diana was mentioning. Let's bring in Brown Harris Stevens CEO Bess Friedman. And Bess, economic uncertainty, 6% handle, just psychologically tough for people to kind of, get used to. What else are you seeing in the housing market?
I think it's a tale of many different stories. I do think, obviously, the fact that there's this war that's creating some volatility, but I don't think that's the reason why buyers are hesitant. I think rates are one thing, affordability is another. Prices have gone up since 2020, almost 50% across the country. So that's playing into it, and wage growth has not caught up to that. So I think that's a part of it. There's not this all of a sudden everybody's panicked and nobody's buying. That's really not what's happening in the market. It's been a slow burn, a correction. It's been taking time. We're having a slower than usual spring selling season, and part of that has to do with the rates and the affordability and just the chaos that's ensuing all around.
Yeah, what are you guys hearing from potential buyers and sellers?
Buyers have been cautious because rates have gone up. They can't afford it. Prices are higher than they would like. And sellers are still locked into these lower rates. They locked in a 3% mortgage rate, and therefore they don't want to sell right now because they don't want to lock in a 6% or 6.5%. So that's creating some pause, but we are in what I would describe as a correction. And I think in markets like New York City, the prices have been fairly flat. We are seeing buyers and sellers move product, which is decent. It's just not great. And I think it's going to take time for us to correct. And I would just encourage politicians to create policies that create more supply and more growth. Things like rent control and rent freezes, those sorts of things sort of de-incentivize builders. And we need to make sure that we're creating things or policies so that we can get more supply into especially the United States, because we have a deficit of nearly 5 million homes in this country, and therefore we need to build more.
Is this the, when hear people talk about supply and good supply, I mean, in these areas in the Northeast, my community, yours, I'm sure is part, there's all these fights over affordable housing, and every time there's a proposal for any kind of, really anything, it can be single family, townhome, just any kind of structure where zoning laws are now being changed or overruled in order to put up structures, and everyone is panicking for a variety of different reasons, from traffic to whatever. Is that what you're talking about when we talk about supply constraints, or are we talking about, tracts in the Sun Belt where you can go out and just build, entirely new communities of single-family homes?
I think it's both. I mean, Mayor Adams was successful in getting past the City of Yes, which is going to get us 80,000 more units in New York, which is great. We need to have more upzoning. We need to have tax incentives. We had the 421A, now we have 485X. We have to create policies that make sense. And so zoning is a big piece of that. And rent freezes, which is something that Mayor Mamdani is looking to pass for about 1 million stabilized units, is going to totally de-incentivize landlords from upkeep and doing anything that's going to help progress in the supply arena. So we have to I think we need a little more common sense in our housing mindset.
All of that said, what would happen if the mortgage rate were able to go back below 6%? And I don't know if honestly, I don't know if that's feasible with all the things we're seeing. But is that the most important thing that would start getting, activity going again?
It's a factor. I think psychologically it would help. Roughly 60% of people who own homes in the United States have mortgages. So that could help, I think, persuade some, but it's not a purist mindset. It will take some people and bring them into the market, and some people will still wait and see. But definitely getting below 6%, studies have shown that people are more inclined to get into the market. But look, it's many factors. It's affordability, it's the rates, it's do I find the home that I want to move into? It's all of those different things. And so people consider all of it. It's very circumstantial.
All right, Bess, it's good to check in with you. Thanks for making the time. We appreciate it today.
Thank you.
Bess Friedman. And that's it for us. Thanks for watching The Exchange. Coming up on Power Lunch, an exclusive interview with Transportation Secretary Sean Duffy. I'll join Brian Sullivan for that right after this quick break.
The future of the Middle East in focus. President Trump issuing an ominous threat to Iran. Welcome to Power Lunch alongside Kelly. I am Brian. Here is where we stand at this hour. The big three indexes, they're all lower right now, not by a lot, down about 0.4%. Small and mid-cap stocks, though, they are flat to even higher. All eyes on energy. Oil continues to be front and center. The WTI June contract just under 100. The Brent crude contract at 110 Kelvin.
Plus, an exclusive interview with Transportation Secretary Sean Duffy, answering tough questions on air travel safety and Boeing 787 Dreamliners as production is set to increase later this year. We begin, though, with President Trump escalating pressure on Iran as his ultimatum nears its deadline. Iranian officials now have less than 6 hours to allow tanker ships to flow through the Strait of Hormuz. If that doesn't happen, the president warned, quote, a whole civilization will die tonight, never to be brought back again. He adds he doesn't want that to happen, but it probably will. This comes as the U.S. military has struck down targets on Karg Island, military targets. It's a strategic site off Iran's southern coast and the country's primary oil export hub. For more on the geopolitical risks and their impact on the market, let's bring in Joe Moglia. He's the former TD Ameritrade chairman and CEO, who's here on set with us alongside Michelle Caruso-Cabrera, CEO of MCC Global Enterprises. Michelle, you know Karg Island well. You visited there back in 2016, seeing these facilities. You might be the only Western journalist ever granted access, which makes today's news, from your point of view, probably even more striking.
Yeah, so I don't believe that the president is going to order that every Iranian die tonight through attacks. I find that highly improbable, and I think you see the market reacting that way because of that. Karg Island, he's talked about taking Karg Island in the past, actually many years ago. We have Marines deployed to the region, so this is something I'm going to be watching tonight. Will he order the military to take Karg Island? Why that would matter? That is where 90% of Iran's exports leave from. That's how they get foreign exchange. That's how they get dollars. It is crucial for their economy.
Do you think, is there a little bit of a bait and switch going on where he's saying, warning about action over here on the bridges and on the power plants, but really there's a different operation going on, or is this all part of?
He likes to be unpredictable. He tells people that he likes to be unpredictable. So that's possible. I don't pretend to know what's in his mind. I think a lot of people come on TV and try to tell you what they think Donald Trump thinks. I don't know. And I don't think they do either. But certainly that is possible.
Should we be shocked, Joe, at how calm the markets appear? Markets are down a little bit today, but they've been up. Small and mid-cap stocks are actually higher this year.
Yeah, I don't know, Brian, if we should be shocked at this. I think that this has been going on for a while now. When the president had his speech the other night, he said it was 32 days at that time. It's 40 days or whatever it is now. So we've been kind of going back and forth anyhow. When the market thinks something good's going to happen, it reacts that way. Bad reacts that way. Right now, the market doesn't know what's going to happen tonight. Per Michelle's point, we don't know. We just don't know what's going to happen. We do know that the longer this goes on, we're going to have oil $125, $140, $150 a barrel.
You believe
that's
that?
going to be.
You believe
the longer it goes on, yeah. If this is still going on 30, 40 days from now, I can see us at 125, 130, 135. If it should have not come to an end. And I think the biggest concern that I've got when you think about the Iranian leadership and their mentality, they know they're not going to win this, but from their perspective, they don't have to win it. They just sort of have to wait us out. We're the ones who spend $1 million a missile, and they're spending $25,000 for a drone. Over a longer period of time, that's not a good thing for us.
So you're an active trader now, and you ran TD Ameritrade. So put on sort of the market hat. Okay, there's three, and if I'm wrong, say something. All right, there's three possible outcomes, really, tonight and into tomorrow. Number one, best case, we get some very positive commentary. It looks like we're working toward a real sort of peace deal involving nuclear, whatever. Best case scenario, I think markets rip higher, correct?
I'd agree.
Okay. Scenario two is we kind of get a punt, a taco, whatever you want to call it. Some positive words. Well, yeah, what they say is sort of that Trump always chickens out. We don't have it. Okay. It doesn't work. We punted a day or two. You're an ex-football coach, right? Or outcome three, which we don't want to think about, which is what the president kind of implied, said directly, this mass bombing of Iran. If that's the case, what happens?
The market's going to crash. I think the market's going to crash. I think as far as the individual investor goes, if you haven't made changes in your portfolio as of now, now's not the time to panic. You got to be very careful. One of the things that we did when the war began, was we had actually had a war strategy. We had a template, and we wanted to go long stocks like energy, natural gas, et cetera, national defense that we thought would do well. We wanted to be short cruisers and the airlines, and we shorted the S&P 500, the SPY. Tonight, to do something with stocks, we're not going to be able to do that. But good news or bad news, the SPY futures trade 23 out of 24 hours a day. They'll be trading later on. We'll miss the beginning of that move, but we would cover our short if it's good news. We'll add to it if it's bad news. The typical individual investor is not going to be able to do that. So you can't panic. If you haven't done much now, you're going to have to be able to ride it through.
I'm thinking, Michelle, what you said about oil and Carg Island and what may happen here. And there's been this weird logic where the U.S. has allowed for Iranian oil to move through the market on, to some extent, saying, look, any barrels in the market will keep the oil price lower for everybody. I don't know if we're trying to throw that scenario out now and say we don't really want them calling the shots. We don't want their oil to be the one that gets through. Like we're putting an end to that now, even if it results in a higher near-term oil price.
I think the thoughts about Carg Island are that if they take it, they're able to control more about how much oil actually leaves. Right? Yes, ghost ships have been getting out. Iranians have been able to send oil to the Chinese, their customers, and the U.S. hasn't been against that because oil is fungible. The more oil that's out there, the lower the price is going to stay. Right? I think the way I continue to think about this always is to focus very much on what the Pentagon says on any given day. General Kane, day one, came out and said the military objective is to destroy Iran's ability to project power. That means we're going to destroy their missiles, we're going to destroy their navy. And we're going to do anything. We're going to have air superiority. And I don't think this is done until they are convinced they have achieved that. Because that is the military goal of this exercise from day one.
Just last hour, we spoke with Charles Kupchan, who said he thinks they're surprised by the fact that Iran can still do all of these retaliatory strikes, hit planes, and so forth. They didn't think they would still have this wherewithal at this point of the conflict.
So war games have been done in the past for many, many years where they've said, OK, what if Iran can get off 250 missiles at a time? And day one, they got off several hundred missiles. They got off several hundred drones. They've never been able to repeat that. We've got 40 drones, up to 80 drones, 40 missiles, 20 missiles. Some days it falls to as low as 7. Their ability to project power is definitely degraded a lot because the number of missiles that goes off every day is far smaller than it used to be, but they're not done yet. They always said 4 to 6 weeks. So we're at week 4.
But to Joe's point, I think earlier, as we found, and you were there, you saw Carg Island. It's not very big. Apparently there's a gazelle of some kind.
There's supposedly gazelles there.
Whatever it is.
Gazelles. There's supposedly military equipment there as well. I never saw any of that either, but I was controlled, right? I had a binder. We moved with the jitney in a jitney.
But they can cause, and I've been to that region, you can do a lot of damage with a small bomb attached to a speedboat. You blow up one supertanker, Joe, and you scare everybody off. You scare the insurance markets off. You scare oil prices up. They know they've got the ability, I think, to damage the Western and American economy vis-a-vis oil prices, do they not?
Well, that winds up going back to the point I was trying to make earlier, where the Iranians, the leadership with it, not all the Iranians, the leadership within Iran just has to wait this out. And the longer they wait it out, and the more of a problem is going to be for us. Oil prices are going to go higher. And while we know we're energy independent, we're also part of a global economy. If the rest of the world is paying much higher price for oil, we're going to be paying that as well. And that's going to have a real negative impact on trade. And the possible scenario there could be a global recession.
If Taiwan or South Korea cannot make microchips or memory chips or semiconductors because they have a shortage of natural gas or helium, which goes into all of these things. And that hasn't happened yet, but it gets closer every single day. If we get something like that, does the market fall 10%? Stocks here?
10% is a big number, but yeah, that could happen. Yeah, that could happen. I mean, the whole point, the way Iran wins this is by doing exactly what we're talking about now. They wait it out, oil prices go crazy, chip industry winds up having problems. There'd be a scarcity of supply around the world and all sorts of different things. It becomes a global recession. That's the problem. I think deep down, that's what the Iranian leadership is trying to do. They're not going to win, but as long as they have one drone left, as long as they can postpone the end of this, the rest of the world could potentially suffer from that.
Yeah, they're trying to raise the cost of the war for the entire economy and for the president.
Yes. How are you, Michelle, thinking through the end game and how to you mentioned watching the military officials for kind of their description of the campaign,
of how it's going, right?
And how it's going and what the goals are. And, again, that's what the market's trying to get to.
Yeah, so, I was disappointed yesterday when they held the news conference to talk about the very dramatic and amazing rescue of the airmen, and there was no update on the state of the war. And I didn't know if that was because they wanted to keep it very focused on the heroism, which was just incredible, right? We haven't heard the latest. There are reports that come out every day out of Israel where you get a sense of how things are going, where they continue to target so many different locations in Iran. I mean, we've targeted 13,000 locations.
Wow.
It's a lot. We've gotten off 13,000 flights in that region. So they are highly degraded. Is it enough is the question.
And is it enough to what the president keeps basically saying he wants them to surrender their nuclear program, come to some kind of deal? Who knows?
Who knows?
Yeah.
We hear different descriptions. It's being mediated through Pakistan. Steve Witkoff is in charge. J.D. Vance is involved. I don't know what the framework for a deal looks like at all. What I do know is the goal is to make sure they cannot keep bombing people in the region. They cannot keep sending missiles out. And now we've learned that they have much more ability to project much farther than they did when they tried to attack Diego Garcia. They'd always said that their ballistic missiles couldn't go that far. Well, guess what? Now we know they can. So I think the administration and the rest of the world gets nervous as well as to, okay, just what is left there.
Well, we got about 6 hours to the 8 o'clock Eastern Time deadline that Trump has imposed. Again, we do not know what may happen, what will happen. The world, I think, Joe, it's fair to say, is going to be watching. And to your point, there are things that trade almost 24/7. Nowadays, any positioning you're making between now and tonight?
We actually looked at the options market. You could maybe have puts or calls for 24 hours, even 48 hours, whatever it might be. But the cost of those people is so now expensive. The volatility with regard is just so expensive. It didn't necessarily make sense for us to do that. Plus, we're really investors that do a decent job of paying attention to our portfolio, and we'll adjust them when we need to. We're not like crazy traders. So that we looked at that this morning. We don't think that makes sense. But we will be ready to either add to the short or cover the short and maybe add to a long if something good or bad happens tonight. Anything in the middle of that, we stay pat.
All right. We'll leave it there. Thank you both so much for your time. Michelle Caruso Cabrera. Joe, actually, we'll see you a little bit later in the show. I really appreciate you being here.
Yeah, and just a quick reminder, folks, you can sign up for our forthcoming energy-related newsletter called Power Insider. It's going to be a weekly piece, key news, meeting power players, and more. It's going to launch next week, April 15th. Use the QR code. Sign up today. All right, coming up, an exclusive with Transportation Secretary Sean Duffy. Phil will be speaking with him. What about jet fuel? Is there a risk of shortages here? I'm sure there's a lot to do. But first, we've got a news update on Anthropic. That'll be right after this.
Welcome back. We do have a news alert on Anthropic announcing a new cybersecurity initiative. It involves partnering with some of the biggest tech companies. Kate Rooney is here from San Francisco. Kate, anytime they make news like this, you got to watch shares of the publicly traded names.
Kelly, today it's going to be cybersecurity stocks that we should watch. So Anthropic is rolling out a new advanced AI model specifically for cybersecurity. It is only available to a select group of companies, tech companies, because the AI company says it fears it could be used by bad actors for nefarious use cases. It's called Project Glasswing. The market had been anticipating this after a publicly available description of the model had been found by Fortune last month. Cybersecurity stocks, the iShares Cybersecurity ETF, did take a hit on that report about this model leading up to all of this. Right now, the model, as I mentioned, is only available to 40 companies. You've got Apple, Google, Microsoft, NVIDIA, and Amazon, AWS specifically, for defense security work. CEO Dario Amodei said in a video provided by the company that the model wasn't specifically trained to be good at cyber. Quote, we trained it to be good at code, but as a side effect, it is also good at cyber. Goes on to say, quote, more powerful models are going to come from this company and from others, so they need a plan to respond to this being a cybersecurity risk. Says that they have spoken to officials across the U.S. government and have offered to collaborate on this, but it does come at a tense time for this company with the U.S. government as it's battling back and forth about that supply chain designation, risk designation, guys.
Right, and I think, Kate, we've seen that when they make inroads and say, claim to have these cybersecurity capabilities, it does put the whole industry on notice. But I don't know quite how these would measure up with what's currently out there.
It's right. Well, they're also partnering with some of the companies that also do cybersecurity. I would mention, though, in this blog post, they said that they found thousands of vulnerabilities in some of the existing code out there. Talked about state-sponsored actors, which is top of mind, of course, with everything going on with Iran. And they really are looking to partner with these companies. And it's sort of this double-edged sword where we talk about the power of these models, the capabilities for coding and software. We don't talk a lot about the downside and the risk here. And these companies keep reminding us that is very much one of the big risks as we talk about AI is cybersecurity, and companies, including Amazon, who we spoke to earlier at this conference where we are, they're really worried about it, and they're really having to invest in it and spend to make sure that kind of the good guys are better equipped than the bad guys, to put it simply.
Yeah, absolutely. Kate, thanks very much for now. Appreciate it. Kate Rooney.
Thanks, Cal.
All right, back to stocks and the market. One of your big calls of the day. We're going to tell you what it is, who it is, and the analyst behind it. There is other stuff going on. And we've got it right after this.
Welcome back. UBS says it's time to scoop up shares of Morgan Stanley, calling it best in class on financials, saying it's resilient in the face of these headwinds like the Iran war and these risks in private credit. Analysts upgrading the stock to buy with a price target of 196 today. Morgan Stanley shares have soared 65% in the past year, outperforming the broader market that's up about 13%. For more is the analyst behind the call, Erica Najarian. She covers large cap banks and consumer finance at UBS. Erica, it's great to see you again. I mean, let's just kind of set the scene here. It's been a tough stretch for financials all of a sudden. Do you have a comment on that before we dive into to Morgan Stanley in particular?
Yeah, absolutely. Look, I mean, first of all, we had the concerns over, disruptive employment sort of backdrop from AI. And then you give way to a poor February jobs print, and then you give way to the conflict in the Middle East. But honestly, just taking a step back, if you think about what's going right in banks, you have capital markets activity being robust. You have direct lending actually going strong, and the consumer is still spending. And so while the stocks are down, the estimates are actually flat to higher. And we thought that, why not take advantage of that downdraft to recommend adding quality in portfolios? And that's how we came to upgrade Morgan Stanley today.
Right, and we can definitely get into that. And kind of the larger point being, is this downdraft happening because of one-off factors where you can look back in 5 years and say, wow, what a great opportunity to kind of, get in on this winning franchise? Or are we going to look back and go, well, geez, now we're in recession?
Look, I mean, who knows how long the Gulf conflict is going to last, right? And then, we certainly then would be in a, more visible path for recession. But even in that case, Kelly, then Morgan Stanley is definitely the most resilient among the stocks that I cover. So yes, while there could be, events that would precipitate, a longer conflict, I think Morgan Stanley's defensibility would still be best in class, even in that situation.
I think of them as being a really strong asset manager. I don't know if there's any threats there kind of from AI or what have you, or even literally from some of the private credit stuff. There's obviously kind of capital market stuff to talk about, maybe some big IPOs coming and that sort of thing. How do they stack up against JP Morgan, Bank of America?
So they're definitely best in class, I would say. And let me just parse out some of the topics that you mentioned. First on, wealth management, asset management, and AI. I think Morgan Stanley is absolutely best in class in terms of the ability of seeing the future and not being afraid to disrupt itself. So case in point, they bought E-Trade a while back when they said, okay, something is changing in terms of the way we're going to gather assets. And so if AI becomes a bigger part of how, entry-level clients start engaging, in terms of managing their wealth, Morgan Stanley will be at the forefront of it, either developing their own technology or buying superior technology. On the, capital markets front, software is only 6% of Morgan Stanley's pipeline. So I think they're going to be significant participants in some of the activity levels that you're seeing, particularly given the blockbuster IPOs that we're anticipating. And, on the private credit side, we're not really worried about sort of any sort of spillover with regards to the company itself. And the company's always been very cautious about, selling alternatives into retail and making sure that suitability is really the primary focus first before distribution.
And so for the sector, and appreciate the granularity there then, Erica, would you say for the sector broadly that, be comfortable with people adding exposure here? Or is this kind of more of a Morgan Stanley specific story?
No, absolutely. We finally got a chance to get a little bit of a better price for Morgan Stanley. But, to this end, the stocks are down, but the estimates are up, especially for the G-SIBs. And the deregulatory momentum continues to be very strong from Washington. So yes, for the big U.S. banks, we do think this is a buying opportunity ahead of what we're going to think will be a pretty strong quarter.
All right. Shares of Morgan Stanley down 5% year to date. Erica, thanks for joining us on the back of that. We appreciate it.
Thank you.
All right, now it's time for a quick bond report. Steady yields here. 10 years about 4.34%, though you heard earlier in the 1 p.m. show, The Exchange with Kelly Evans, check it out, that mortgage rates have been kind of on the move higher. It's not exactly a great spring selling season. Things are a little different overseas, maybe a little bit worse. The 10-year German yield approaching 3.10 in early trading. Last time we saw that was last March. And in Japan, 10-year holding above 2.40. Doesn't sound high to us, but it's their highest trading level since 1998. Yields globally on the way up.
Important point. Next, what is the real state of air travel? Are your flights at risk? Transportation Secretary Sean Duffy joins Phil LeBeau to talk about that very topic next.
All right, you can see the Dow is down 197 points, or about 0.4%. All as we approach tonight's 8 p.m. Eastern Time deadline that Trump has imposed on Iran. All right, in the meantime, let's talk about all things flying and transport related and get right down to Phil LeBeau, who's with Transportation Secretary Sean Duffy in an exclusive. Phil.
Thank you, Brian. Mr. Secretary,
Good
good to have you here. What a backdrop, too.
Yeah, well, isn't that fantastic,
You can't
right?
beat this.
No.
We'll talk about this in a bit, but let me first start with, we're a couple of weeks removed from the crash at LaGuardia. Yep. And once again, it's highlighting air traffic controller staffing and staffing at all airports. You're making the big push. How close are you to making a real indent in that deficit of air traffic control?
So I'll say, too, it's number one, staffing, and the other part is technology. So in regard to staffing, we had the biggest year of hiring in 6 years with air traffic controllers. So we hired 2,400 new controllers in the last 12 months. We have more controllers for the first time since pre-pandemic. We have big classes coming through. Next week, we're going to announce a new class of air traffic controllers. We're thinking differently. We have a 30% washout rate. So how do we bring that rate down? Again, we want to have a washout rate, but 30% is too high. Getting the right young adults to get into the school is what we're thinking through right now. So that part is going well. We still have a deficit. I've also included those controllers who are eligible to retire. I'm offering them a 20% upfront cash bonus to not retire, to stay on the job. But when we look at LaGuardia, again, we had 2 controllers in the tower, but I'm looking at how do I update this system to make sure we have the best technology. So humans can always make errors. So how do I have great air traffic controllers and I back them up with great technology? I got $12.5 billion that I'm working on right now. In the next 2.5 years, we're going to spend that building out. We're going to have new telecom, we're going to have new radar, new voice switches. But the next part is we need new software to manage the system. Congress has to give me money for that.
Let me ask you about what's on top of mind for most people who are traveling right now.
Yeah.
Higher airfares because jet fuel prices have almost doubled since the beginning of the year. 2 questions here. One, should we be worried about the jet fuel supply, given the fact that there's not oil flowing through the Strait of Hormuz as we usually see? And 2, what do you say to the people who are looking at these airfares and are saying, wait a second, I can't take my family to California this summer? It's ridiculous.
That's a good question. So thanks to President Trump, and American energy dominance, we have a ton of energy in the U.S. So we are less reliant on the Strait of Hormuz than we would have been, say, 25, 30 years ago because of fracking. I've talked to all the airline CEOs, and I've talked about their supply for jet fuel. They have a deep supply chain. They all feel really good about the supply, but it's a global market, right? So when global jet fuel prices go up, that affects us here in the U.S. And I think we have to think about it, this is short term, and the president thinks about this short term. And we do have a blip and an increase in prices. But in the long run, if we bring more stability to the supply of oil and gas globally, I think we're going to be better off as a country, but also as everyone purchases this great energy.
Because of these jet fuel prices and costs for the airlines, let's be honest, you've got 2 airlines that are bulk of the profits, and the other airlines are all struggling. Nobody's going bankrupt, but there is growing chatter in the industry that perhaps one of the big 4 airlines gets even bigger and buys one of the smaller airlines.
Yeah.
That would have to meet with your approval. Would you like to see one of the larger airlines buy one of the smaller airlines?
Listen, that's going to come through us, but also President Trump, he loves to see big deals happen. He'd have to review that kind of a deal. It has to go through DOJ, and it'll come through DOT. I think who knows who's going to match up, right? There's always chatter, but is there room for some mergers in the aviation industry? Yeah, I think there is. But
even here in the United States?
Yeah, I think so. Now, there's a lot of chatter, and a lot of different people are talking, amongst themselves about what that should look like. I'm going to wait and see. Is there a deal that's brought to the table? How does it look? What impact does it have on competition? What is it going to do for the consumer and the pricing of the consumer? What does it do for us to be competitive globally? To make sure that we are, in America, have the biggest and the best airlines competing around the world.
But what if that means one of the airlines no longer has just 20%, and the big 4 are all around 20% market share? What if they go up to 30%, 35%? Would you be okay with that?
Well, again, we have to look at it at a case-by-case basis. And again, if there was a merger between some of the larger airlines, they're going to have to peel off some of their assets, right? We don't want to have this massive infrastructure with one airline in America. Again, I think that will affect pricing in the long run because there'll be a lack of competition, which we love competition. So again, I'm not going to pre-commit to anything. I'll look at whatever comes across my desk. Another president will look at that as well.
Quickly want to ask you about why you're here today, taking a tour of the Dreamliner production line. They're going to go up to 10 per month production, at least they hope to by later this year. You've been at a lot of the Boeing facilities. How much have they improved relative to where they were a year and a half ago?
So I think there was a lot of frustration at Boeing. You go a few years back. And I think now what we see is a lot of Americans are cheering them on. We do our job as we do oversight with the airline and have strict controls on how many aircraft they can produce per month. But we have seen them take leaps and bounds of steps in the progress in their manufacturing capability and the training and the way they're performing, building these airplanes. So they're in a great place, but we're crawling, we're walking, we're taking our time, but they continue to get better every single day. This is the greatest export of any company in America. This does more to offset our trade imbalance, Boeing, than any other company. So what we build here, whether it's in Washington or here in South Carolina, is sold around the world. This is great American manufacturing, American innovation, and I'm proud of them. I think this is a comeback story for Boeing, and they're doing a great job.
Transportation Secretary Sean Duffy, good to have you here.
It's good to see you.
Thank you. Heck of a backdrop. Can't beat it.
It gets better looking all the time.
Yeah, okay, send it back to you guys.
Gentlemen, thank you both. Really appreciate it. Phil LeBeau with Secretary Duffy. Let's get over to Angelica Peebles now for the CNBC News Update. Hi, Angelica.
Hey, Kelly. American journalist Shelley Kittleson, who was abducted in Baghdad by an Iranian-aligned militia, will be freed today after a week in captivity. Kittleson, who has reported on the Middle East for various outlets, was set to be released in exchange for several imprisoned members of the militia that was holding her. Used car prices are now at the highest point since the summer of 2023. According to Cox Automotive, prices are rising amid relatively tight supply, but demand remains strong. The average list price in February for a used car was $25,000 compared to $49,000 for a new car. And the crew of the Artemis II captured what NASA's administrator called an absolutely stunning photo of the moon eclipsing the sun. The astronauts took this picture from their Orion space capsule, which made a 6-hour flyby of the moon yesterday. NASA Chief Jared Isaacman told CNBC this morning that this is why we send astronauts farther into space than ever before. Brian, back over to you.
That is a very, very cool photograph. Best to them, and thank you to the Artemis crew. All right, coming up, maybe a little good news. Your next guest says oil prices may fall faster than you might expect, and he's got 2 ways you can play that trade. Your market navigator is next.
Welcome back to Power Lunch. I'm Dominic Chu. Higher energy prices have put a dent in the budgets of many Americans out there, but once they do come down and people have a little bit more money to spend, who could benefit the most from that? Our next guest has some specific ideas about the companies to focus on. Joining us now is Chris Brigatti, Chief Investment Officer over at SWBC. So, Chris, when those oil prices do come down, and hopefully it's sometime soon, what exactly would you be focusing on from that kind of consumer discretionary spending standpoint?
From a consumer discretionary standpoint is the types of stocks that can benefit because people basically have more money in their pocket. And one of those ideas is Chewy, the pet food and pet supply company. They're very well positioned and they've actually got a good entry point right now. So if you're looking at an opportunity for something that's going to benefit when people have more money to spend, this is the type of stock that will. People spend about $1,000 on average of disposable income on their pets each year. And so when they're ready to spend again, this is one way to take advantage of that.
And do you feel as though the price action right now is conducive to starting to leg into positions in Chewy?
I do. I think we've seen a little bit of a hit because of the higher oil prices affecting people's wallets and pocketbooks. They don't have as much of that disposable income, so the prices come down a little bit. So part of this is going to be a bounce back, and then it's going to be upside potential, just getting back to normal pre-oil crisis, for lack of a better way of putting it.
And where else would you go where you would try to find a dip to buy, bigger picture-wise, outside of, say, pets?
This one, it's kind of obvious to me that it's things that people kind of pare back from when they don't have money to spend, and it's travel and destination. And so one of those ideas is Disney company. So, you know, they've kind of come down in price a little bit of late. Again, same story as Chewy in that people don't have as much money to spend, so they pare back on this kind of spending. Now, not everybody does. One of my golf buddies over in Knickerbocker just came back from Disney, and they're spending money down there for sure. But the opportunity for this bounce back is going to be beneficial in the long run, and I think one of the things we can see is the price going up meaningfully from here.
All right, so Chewy and Disney, the places you could go for that consumer spending picture. Chris Brigatti, thank you so much. We'll see you again soon, sir.
Thank you.
All right, Kelly, I'll send things back over to you.
Don, thank you very much. Coming up, Brent above 100 a barrel, 109. WTI now below 100. What does it all mean for you? We'll dive further into the oil prices right after this.
All right, Dow's down about 0.5%. Not a huge move there, but the energy market, it remains on edge. It, like the rest of the world, is waiting for any new developments out of the Middle East. WTI's June contract, is hovering around $100 a barrel. The May contract, about $115. Brent crude is trading nearly on the flat line. And we've got just over 5 hours left before President Trump's ultimatum expires. Still no confirmation on whether Iran will allow full tanker traffic through the Strait of Hormuz. That, a live tracking feed of vessels in that choke point. Data from Kipler and our friends at Marine Traffic show just 7 ships made that transit yesterday, 3 sanctioned vessels. Now, 7 is more than 0, but it's still well off where it was. Let's talk more about energy and gasoline and diesel. Joining us, Patrick DeHaan, head of petroleum analysis at Gas Buddy, and Joe Moglia is back with us, executive chair of Greenland, a Greenland-focused energy company. Joe, good to have you back on as well. Patrick, I want to stay focused on diesel in the middle of the country. Again, paying about $1 more a gallon for gasoline than they were 1 year ago. That's a pain, probably a little more manageable for most families. But on the coast and with diesel fuel, especially in places like California, it's getting a little bit out of hand.
Yeah, certainly, Sully. And to your point, something developing here in the last couple of hours is a big jolt is about to come to those inland areas as we see a little bit of an equalization, the ARB's closing a little bit. It looks like product may be flowing away from some of those plain states, and they could see diesel prices now jumping 35 to 65 cents in those cheap states like the Dakotas in the nation's section. These states there are going to now start catching up to that surge we've been seeing in diesel nationally. We're right now at about $5.63 a gallon for diesel. And Sully, I think in the next 72 hours, we'll be setting a new all-time record high when it comes to the average price of diesel.
I guess, Joe, the question, Joe Moglia, is, and you're involved with a company, it's a microcap, so we won't talk about the stock, but you're involved in a Greenland-focused energy company. Look out next year, 3 years, 5 years. How does what's happening now and all the stuff we just talked about with the Strait of Hormuz, a little bit around Bab el-Mandeb, the Middle East, how does that change how we should think about energy investing?
I think we live in an age where the geopolitical stress is as great as we've ever seen it over the span of our lifetime. The center of that is energy. It always seems the energy becomes the focus point about so many things that are going on in the world. I think more than ever, I think we've got to think about how we're going to diversify where we're going to get our energy from. So you think about Greenland as an example. Greenland is at the intersection of geopolitics and energy. I want to go back a little bit to the 1980s, 1990s. And when ARCO, Atlantic Richfield, spent about 15 to 20 years and $275 million in today's dollars in terms of geological exploration. They were pleased with what they found, but from a business perspective, oil prices in the 80s and 90s were crazy, and the country of Denmark took a 35% premium off the top of their revenues. It got to the point where they couldn't handle it from a business perspective. They fired 12,000 people. They got out of there. But the geological finds that they found was very, very, very real. The only company in the world that has rights to be able to drill in the Jameson Basin in Greenland is Greenland Energy. That's part of the reason why I'd gotten involved with them. So the potential there's 13 billion barrels. They're the only people that could possibly do that. They're going to start, now again, as you pointed out, Brian, they're small and they're not going to have an impact.
I don't want to talk about that stock.
But longer term, I'm not talking about the stock, but longer term, this is the type of thing we need. And the potential there's 13 billion barrels.
Is your interest there related to the president's interest or completely unrelated?
It's unrelated, but because of the situation that it happens to be in, it's the choke point for where missiles are going to be flying over. So if we had a successful business there 5 years from now, let's say, wouldn't it be in the United States' best interest to make sure we had some sort of military base just to protect our businesses that are there? And by the way, this is a partnership with the country of Greenland as well. Yeah. So and I think from a strategic perspective, that could be a major, major plus to something like this.
Well, and we're looking to get away from choke points like the Strait. And, like Brian has pointed out many a time, at least Saudi Arabia, because of the Iran-Iraq war, they have all these pipelines. So there's another way to get product through that choke point. But, we're still short about 10 million barrels a day. So we need to get all of that supply back in the market. And I don't know. That's what this all really comes down to.
I agree, Kelly. That's the reason why we have the dilemma we have. That's the reason why a small little country like Iran can almost hold the world hostage because of this.
Yeah.
So that's the issue.
Well, and that is the issue, Patrick. And I think the point around Greenland and whatever else it is do you think that in a year from now, 2 years from now, we're going to change how we look at acquiring energy, where we acquire energy, or when this is over, however that may be, whenever that may be, we're going to go back to just doing it the way we were doing it before because it's over. And in 5 years, 10 years, 20 years, we might be here again because we do seem, particularly with energy, to relive the past over and over again.
Yeah, Brian, I think, some excellent points being made here. And to Joe's point, geopolitical tensions, whether they're overseas or even in the United States, you look at where the investment money is flowing, and it's to the lowest risk areas. You look at a place like California, which has isolated itself through rules and regulation. Refineries are leaving the state because the environment for operating a refinery in that state just continues to close in. It's not a profitable place. If you have a small refinery, there's so many rules there that now you're seeing investment from some companies like Sinclair and Kinder Morgan, Phillips 66, and ONEOK. California has become such a difficult logistical challenge and a nightmare to operate in that you're now seeing 3 pipelines that want to connect areas of the nation's interior, whether it be Oklahoma or Texas. Those pipelines could potentially flow east to west, much like the Saudi pipeline that is now diverting around the Strait of Hormuz. So even here in the United States, you have a little bit of a subset of the same problems. Political views are dictating where the investment is flowing to. You look at some of the biggest refinery expansions in recent years, they're down in Texas. So we're very politically fractured here by where the investment is flowing to, and that's creating a lot of hotspots. You look at Arizona, a state now completely reliant on essentially California and a little bit of flow of oil and gasoline, diesel, and jet fuel from Texas. But a lot of this, global picture also happening in a microcosm here in the United States.
Yeah. And again, as we see along the West Coast, we have prices over $5 on average. Patrick, thanks very much. Patrick DeHaan of Gas Buddy. Joe, thanks as well. Joe Moglia.
Hey, Kelly.
Dow's down 308. More Power Lunch after a quick break.
All right, there is a lot of serious stuff going on right now. Got a couple hours to that Trump deadline, but Joe Mowgli is still with us. And the last couple of minutes we have together, want to put on that cap, that big cap here is one of many that you've had running. You ran TD Ameritrade, but you also were a college football coach, very successful one, by the way, at Coastal Carolina. You also did internship at the University of Nebraska. By the way, I hate to say it, congratulations to Michigan last night, winning the national basketball title. I've been pretty open on my daughter's a former D1 athlete. I know you played college sports. Kate Rooney did as well. How broken is college sports right now with money?
Well, it's a mess. As an example, last night, a great NCAA series.
Great game.
Michigan, all 5 starters, everyone was a transfer. So when you think about it now, it's still a great product. They still get a lot of television. They get all those things, but it's a business now. It is totally a business. And academia and the NCAA, frankly, don't know how to run it as a business. So I think I applaud the president for coming out with his executive order. I think that's just a step in the right direction. There's probably going to be legal conflicts associated with that. But I think the only way there's going to be a long-term fix is that it's a business running like a business. So I think you got to take Power 4 football, because that's where a lot of the money, most of the money is. You break it away, and instead of the NCAA, they become the PCAA, the Professional Collegiate Athletic Association. Wow. They model themselves after the NFL, which, by the way, if the NFL ran themselves like colleges today, they'd go out of business. So it's a great business. So you use them as a model. That means you have real management. You have real contracts that matter. You have salary caps. You have collective bargaining. You run it like a business. I think that could potentially be a home run. You got the Super Bowl, you got the PCAA National Championship, then the Group of 5 schools, that'd be the NCAA National Championship, and then maybe you do it for a Group of 5 schools, or you do it with basketball. But right now, to fix everything at once,
yeah,
you're not going to be able to do it.
Can I go for option B, just go back to the way that it used to be? I guess that's not on the table. Joe, you're smart about all this stuff. What's your take on prediction markets, which have turned into a conduit for sports betting for kids who aren't technically old enough to gamble?
I think legalized betting, I think everybody bets. So I think to be able to legalize that, I think is the right way to go. I think anything AI, right? We talk about AI and the tremendous impact it can have, maybe to find greater energy sources for us, but there's going to be disruption, right? With regards to the prediction markets, you can abuse those. And that's part of what's happening now. So is there a way to be able to have those and still be able to maybe temper some of that?
Hopefully. I think that's the way they're going.
Listen, 10% of Joe Mowgli is 100% in most people, so we're glad to have you on. Joe Mowgli, thank you very much.
Thanks,
Great
guys.
conversation there. Folks, that's it for us. Thank you very much for watching Power Lunch.
As stocks head back towards session lows, Closing Bell picks things up right now.
All right, Kel, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with stocks on edge, that 8 p.m. deadline looming over the markets. Let's show you the scorecard here with 60 to go in regulation. A little bit of a turn lower in the last few moments. Still no really big moves ahead of this evening. Nasdaq's been down about 1% throughout the day. Still is. The others about 0.75% down. Oil has been higher for much of the day. Took a little bit of a dip, but it moves up. Perhaps that's why stocks just maybe moved back a little lower as well. So we're watching all of that. How about Apple shares today? Suffering one of the worst days in months. We're going to tell you why in just a little bit. And Broadcom's higher today. It scored a new deal. We'll tell you with who. That story just ahead as well. Let's begin with our talk of the tape. It is the latest on the war. And we go to our Megan Casella, who is at the White House with that for us. Hi, Megan.
Hey, Scott, the White House now holding firm to the president's latest deadline for the Iranians to make a deal to reopen the Strait of Hormuz or face attacks to its civilian infrastructure. And at this point, we're just 5 hours out from that deadline, and diplomatic talks appear to be on shaky ground. It remains deeply unclear how negotiations are going, whether a deal is still possible, or what it would look like. White House Press Secretary Caroline Leavitt telling me in a statement in the last hour that the Iranian regime has until 8 p.m. Eastern time to meet the moment and make a deal with the United States. Only the president, she says, knows where things stand and what he will do. And the only thing, Scott, that we've heard directly from the president so far today was via Truth Social this morning, where he warned that a whole civilization will die tonight, never to be brought back again. Trump added that he did not want that to happen, but that it probably will. So the rhetoric has escalated, but so have military actions. A White House official confirming to me earlier today that the U.S. struck military targets on Karg Island overnight. Israel's defense forces also warning Iranians not to travel by train today, signaling strikes on rail lines. And Iran has warned that if the U.S. crosses red lines, that their response will go beyond the region. Scott.
All right, Megan, appreciate that very much. On the north lawn of the White House, Megan Casella, we mentioned the move today in oil. Pippa Stevens, always watching those markets for us, joins us now with more. What do you see?
Hey, Scott, so not a big move in the oil futures, perhaps traders focusing on President Trump in the past postponing these deadlines, but the physical markets continue to flash warning signs. Dated Brent hitting a record of $144.42 per barrel today. That's according to S&P Global Energy. This is the price based on actual bids, offers, and transactions between buyers and sellers in the open physical market, meaning it reflects current versus futures pricing. And on the product side, in Singapore, diesel nearing $300 per barrel, with jet fuel also surging. Asian refiners have already started cutting runs thanks to a lack of feedstock. And in terms of Hormuz, we have seen an increase in tankers transiting, 7 yesterday, including hugging the coast of Oman. But traffic does still remain well below those pre-war levels. Scott?
All right, appreciate the update there, Pippa. Thank you, Pippa Stevens. Let's now bring in Charles Schwab's chief investment strategist, Liz Ann Saunders, for more on these markets. Welcome back. It's nice to see you.
Nice to see you too, Scott. Thanks for having me.
You were last with us on the 25th of March, in which you said, quote, "We're still very much at the mercy of oil." That holds to this moment, doesn't it?
It sure does. If we track on a day-to-day basis the day-to-day as well as intraday correlation between Brent and the S&P, and it stayed firmly in negative territory. I think we had 2 trading days since the war erupted where you didn't have that negative correlation, but that really has ruled the day. I think, like many people, a bit surprised at the relative resilience of the market, given what we're talking about potentially in 5 hours. But that's positioning at this point.
I mean, maybe it's also what Wolf Research was talking about today, that in their eyes, the economy remains resilient with the growth outlook solid, even in the face of what's happening. Earnings growth is still projected at more than 14%. So as long as those ideas and fundamentals remain intact, is that something to get us over the line here?
Perhaps, and it has been very resilient in terms of the outlook for earnings. You've actually seen an increase in expectations for calendar year 2026. It's been largely concentrated, no surprise, 1 in the energy sector, number 2 in the technology sector. And in the case of the upward revision to tech sector earnings for calendar year 26, that's largely been driven by the combination of Micron and NVIDIA. I think what's happening, though, we'll soon find out, is that analysts are not equipped with enough information or color from companies to be making adjustments to earnings, at least for companies that have energy as a high input cost. I think we're close enough reporting season that I think the movement in estimates, possibly up in some segments of the market, down, I think that is still ahead of us, and we'll start to get more color on that when earnings season starts in a week or so.
Well, good luck to the analysts who are trying to game it all out, right? Because you know what the commentary is going to be. A lot of we don't know. It depends on, et cetera, a lot of that. So we're going to have to base some investment decisions on what we think may happen in the weeks and maybe month or so ahead.
Yeah, and you might get some withdrawn guidance, maybe not to the same degree as we saw a year ago when we were in the throes of the tariff tantrum, and certainly not to the extreme that we saw during the early part of the pandemic when a record percentage of companies withdrew guidance. But I think the guidance is going to be murkier. I think the questioning on the part of analysts during those conference calls will be about what the vagaries are of how they're thinking about that as input costs. How are they adjusting for those input costs? Are they willing to take it in profit margins, or are they figuring out how to cut costs elsewhere? Certainly labor market related questions will be asked. So I think earnings seasons these days are always impactful. This is a particularly impactful one because it's an opportunity, again, for us to get sort of micro level macro assessment on the part of companies that are reporting.
But are you allowing yourself to think beyond this crisis and make the kinds of market calls, knowing that this is at some point going to be in the rear view, and hopefully we'll get back to focusing on what appear to be still decent fundamentals?
I think this is a backdrop where neutrality probably makes a lot of sense from a tactical asset allocation perspective. Sort of, stay at your strategic allocations. I think it's not the right time to either make a bet on a turnaround here, an end to the war, whatever that looks like, a quick retreat in oil prices. But as we've learned so much in the past, particularly in the past year, you can see a very quick narrative change via some sort of policy post. And I think there's also an unwillingness to sort of bet the farm on the most negative outcome. So I think that sort of moment of neutrality is the one that is here right now. Don't try to be a hero in this kind of backdrop and stick close to the knitting.
You mentioned positioning earlier. That seems to be, frankly, the most difficult thing to figure out. Whether, when this passes, you go back to what was working, this broadening trade and the value trade, or if this has just introduced enough uncertainty that's going to last for longer than perhaps the conflict itself does, that you'll just have people going back to the growth trade and the mega caps and things like that.
No, I've said this to you on this program before, Scott. I think what will continue to be the case, and what's been the case for the better part of this year, is that the momentum trade is rotation. And I think that rotational nature of the market, the fact that, your average member maximum drawdown for the S&P is 18% year to date, where it's only 9% at the index level. That's happened via, rapid fire rotations where leadership shifts on a dime, in many cases because narratives shift on a dime. I think we probably go back into that kind of environment, less at the mercy just of oil prices in terms of direction, but I think a lot of money that is looking to make really fast decisions. And what I meant by positioning is we can't judge what the next post is going to be and what the next policy change or narrative change is going to be. But what we can do is assess positioning. And if you look at some of the dominant players in the short term in the market, retail traders, CTAs, systematic hedge funds, there has been a lot of de-risking, maybe not to the kind of panic capitulation extreme, but enough that you maybe have a setup upon some sort of positive catalyst, whatever that looks like. I think we may be in sort of the first two phases of what you often get in a backdrop like this. You get the correction, you then get a bit of a rally. If the rally doesn't have strong breadth, it sets up the possibility of a retest. And then you look for that breadth surge or thrust, as Marty Zweig, my first boss, used to call it, back on the upside again. We're not at those latter steps yet, but that's what I'm keeping an eye on.
Because we're at the mercy of deadlines, timelines, and rhetoric and narratives and the clock. We'll see what happens. Lizanne, as always, thank you so much.
My pleasure. Thanks, Scott. Good to see you.
Charles Schwab. I did mention the mega caps. Apple certainly lower today. I showed you it as we began the program. One of the worst days in months. For more on what is weighing on that stock today, we're joined now by Mackenzie Sigalis. Tell us more here for what's been a pretty ugly day for this name.
So, Scott, this is all about conflicting reports over the first ever foldable iPhone. The stock was down as much as 5% earlier today after Nikkei Asia reported that Apple is hitting engineering setbacks in the test phase of that device, with suppliers reportedly told the production schedule will be pushed back. Right now, April into early May is that critical window to resolve those kinds of issues. But then a few hours later, Apple shares started to pare those losses after Bloomberg pushed back hard, essentially saying that Nikkei got it wrong, that the foldable device remains on track for a September debut alongside the iPhone 18 lineup, though there could be some initial supply constraints tied to the complexity of the new display. And this is a really huge product for Apple, expected to retail at over $2,000, which would be the most expensive iPhone ever. Out to Apple on this, but no word back just yet, Scott.
All right, Mac, thank you. Mackenzie Sigalis. So still a rough day, not as bad as it was a few hours ago. Now let's bring in our panel. JP Morgan's Mira Pandit and CNBC contributor, Requisite Capital's Bryn Talkington. Ladies, good to have you. Mira, begin with you on a day where Wells Fargo upgraded tech today and downgraded energy. What do you make of that call?
It's hard to ignore that some of those mega cap tech darlings have reset a lot this year. So the Mag 7 came into the year with 29 times forward valuations and now are closer to 24. So that's not overly expensive. And when you look at the fundamental backdrop here of some of these stocks, you're still seeing earnings growth in excess of 20%. So the fundamentals behind a lot of mega cap tech and the broader tech trade have not necessarily changed. It's just that the sentiment has soured. And I think we need to remind ourselves to seek that balance in portfolios across the board because there are still opportunities here. I mean, you look at the Mag 7, every single one is down this year. They're all underperforming the index. But you look within them, and the correlations between them went from a high of 78% last May, as you had this everything rally, to about 35% today. So you can find some opportunities for stock picking within that cohort, but also broadly across tech and outside of the tech complex, specifically when we think about that broader AI theme finding its way into some of the value sectors as well.
Hey, Bryn, is the valuation reset around many of these names, like Mira was just talking about it, is that the most compelling part of the story at this point? I mean, we already knew that you're going to get earnings growth better than other parts of the market. And now you're telling me that I can also get a reset on some of the valuations of these names to go with it?
Right. I mean, so if you look at NVIDIA, which I think is the poster child of valuation reset, NVIDIA has not traded at a discount to the S&P from a multiple perspective since 2013. I mean, that's a decade and a third ago. And it's going to grow earnings at 70%. So I think that you're having the market, which I always do respect, although I do disagree sometimes, is saying that we don't think these numbers are going to be durable, and they're still questioning the capex. And to me, to your question, that's where the opportunity lies. And so from everything we all hear, this opportunity set for the picks and shovels, like a Dell, like an NVIDIA, seems to still be in its early days, and the spend is going to come. And so I do think that's the opportunity for investors as these stocks continue to get cheap. And I do think when you see Exxon trading at a forward PE higher than NVIDIA, you have to scratch your head and say, hey, maybe this is an opportunity if I didn't own NVIDIA to start nibbling here. I obviously own it, but I definitely think it's an opportunity if you think the durability of the capex will continue, which everything we've heard of is the answer is yes.
Bryn, how are you thinking about this deadline tonight? I feel like the collective investing universe is waiting for something positive to pop up on their screens to remind them that what they perceive to be this Trump put, a back off, whatever you want to call it, is still intact. Is that how you feel too?
Well, hope is not an investment theme, so I would just say let's hope so on this one. I don't think anyone likes the commentary when you say a whole civilization. I think that's disturbing. But once again, the Iranians are on internet shutdown, so they're not hearing this. He's speaking to the IRGC and everyone else. And so I think that the market, I think Liz Ann was spot on. The market has digested this incredibly well. Normally, this type of threat would be existential, but I don't think that will come to pass because the stakes are too high and there's 90 million Iranians that are sitting there literally in the dark. So to me, the dates I look at are April 19th, which will be 1 month after, if we're still under the 200-day, that's not a great sign. And then don't forget the War Powers Act, the 60-day clock started, February 28th? And so if this is not resolved by April 28th, then the Senate gets to vote on whether we need to wind this down or not. So I think those two dates, April 19th and April 28th, are very important dates for me looking at positioning going forward.
Mira, how are you thinking about tonight? Same question.
It's impossible to say. And I think what we grapple with and what's so difficult as an economist or an investment strategist in thinking through this is our bias is always to say, what is the path of least resistance to create the least economic damage and the least market damage? And you would think, it's a reasonable assumption because elections are won and lost on recessions and inflation. We've seen that over the last several elections. So it's a reasonable base case to come in with. But the reality is, from a politics standpoint, there are so many other social, cultural, political factors at play that may work against what might make the most sense from the economy and market. So I agree with Bryn. Hope is not an investment strategy. I think that's where the markets are thinking, well, remember last year when all of a sudden tariffs were postponed and then eventually came down. Maybe we have this environment in which we call the whole thing off and we're in a better place. I think that's what markets are hoping for. I don't know whether that's a realistic hope or not.
Okay, so hope doesn't work at the poker table, right? You play the hand you have. And the hand that, as I see it now, you got some cards that you don't like and that could mess up your ability to win, but you've got enough things in your hand now. The economy's still pretty good. Jobs report was pretty good. Earnings expectations are really good. Is that enough to get you through this period and think about what lies ahead once this passes?
You may not have a broad market rally across the board anytime soon unless we have this alleviation moment. So the way we're thinking about investing in this environment is you see elevated volatility, you see even more elevated single stock volatility. So that creates a lot of opportunities for us because there's a couple of things going on. One, the majority of the stocks in the S&P 500 are actually still beating the overall index, about 55%. Two, if you look at sector dispersion, ignore energy. You still have 5 other sectors that are positive year to date and solidly positive, not just on the line. And almost all of those sectors were up double digits before the war. So you have some opportunities there. And even underneath the surface, across those earning sectors or those sectors that are growing, you have 65 to 95% of those stocks also beating the index. Even among the sectors that are really lagging behind, like financials, one of the worst performers, you have about 40% of the stocks beating the index. So there is a breadth of opportunity for specific areas. And what you also typically see in environments like this is correlations spike among stocks because everything goes down, everything is challenged. You're actually seeing one of the lower correlation readings we've seen since 2022. So majority of stocks beating the index, high sector dispersion, and low correlations among stocks. That does create some pockets of opportunity across the markets in a number of different areas.
Bryn, lastly and quickly, if you can, that idea that people are trying to hang on to what they had before this all started and think it's going to work on the other side whenever this ends.
Yeah, well, we got that peak last week when the market rallied, right? And you saw Google up 4, GE Vernova up 5 or 6. And so I think you go back to that, I think it was a Tuesday of last week when we saw a big rally. I think that gives you a sneak peek of what will work. But I do think going into numbers, Scott, companies like Google, like Microsoft, they're going to have great numbers. And so that, to me, going into a weak tape with strong earnings, is actually a good setup for a surprise for some of these bigger tech names and just names in general that have great numbers to actually rally off of these lower prices.
All right, we'll talk to you soon. Bryn, thanks. Mira, to you as well. We'll see both of you soon. We're watching shares of Broadcom today. Christina Partsinevelos tells us what's behind that big move. Hi there.
Hi, Scott. Well, Broadcom is locking in a massive compute deal with Google and Anthropic, giving Anthropic access to Google's AI chips starting in 2027. Broadcom had already projected about $100 billion in AI revenue just next year, and many analysts are saying that number is starting to look a little light. Two major fears have been hanging over Broadcom shares over the last little while, and they've been whether Google would eventually build chips entirely in-house and, not use Broadcom anymore, or whether rival MediaTek was just gaining ground. But a supply agreement through 2031 with Google that just came through with this deal really puts both of those to rest, and why you're seeing shares climb almost 6% higher. So what does this mean, though, for NVIDIA? Companies like Anthropic are definitely now mixing and matching chips, using Google's chips for cheaper everyday AI tasks and NVIDIA for the heavy lifting. NVIDIA CEO Jensen Huang has said many times that the pie just keeps growing. And he may be right. Anthropic alone just disclosed its revenue run rate has tripled since the end of last year. The real question, though, is how long that argument holds and whether Broadcom's growing roster of locked-in customers eventually starts redirecting dollars that would have otherwise gone to NVIDIA.
All right, Christina, thank you. Christina Partsinevelos. We're just getting started here on The Bell. Coming up next, the latest in the ongoing drama between Elon Musk and Sam Altman. Why big technology founder Alex Kantrowitz says it's just the beginning. He joins us live right here at Post 9 next.
We're back. More friction between Sam Altman and Elon Musk bubbling up in public. Kate Rooney has more on that for us. Hi there.
Hey, Scott. So in a letter that we viewed, OpenAI is now asking the California and Delaware attorneys general to investigate Tesla CEO Elon Musk for what they describe as improper and anti-competitive behavior. Musk was an early backer and co-founder of OpenAI. The AI company now accuses Musk of trying to undermine OpenAI with various attacks that they outline, including now coordinating efforts with Meta CEO Mark Zuckerberg. Chris Lahane, who I spoke to, he's the head of global affairs over at OpenAI, described it to me as possible collusion between Musk and Zuckerberg. He points to text messages that were recently made public between Zuckerberg and Musk, where Musk asks for Zuckerberg's help in trying to acquire OpenAI's nonprofit arm. OpenAI also now pointing to reporting in the New Yorker, which outlines Musk's opposition research around Altman. It is the latest drama and back and forth between these two tech titans. Musk sued the company, OpenAI, alleging that he was deceived after the startup, which is now not a startup, massive company, tried to convert to a for-profit. Jury selection, Scott, is going to be beginning in a few weeks. It's kicking off.
We knew what you meant. Kate, thank you. That's Kate Rooney. Now let's bring in Big Technology's Alex Kantrowitz. He's also a CNBC contributor. It's always good to talk to you about this stuff. So what do we make of the fact that this is bubbling up again? Is this Sam Altman trying to tweak him a little bit as, you know, SpaceX is coming to the finish line on going public?
Definitely. I mean, the drama never ends between these two. And the way I read it is it's a schoolyard fight between two, well, they're adults, but they sometimes can get into child mode, form of kids who just can't let it go. And they should do the talking with the product. They should do the talking with the company. But you're right, you now have the SpaceX IPO coming up, and OpenAI's IPO will come up right after that. Meanwhile, Musk is suing OpenAI, claiming that they improperly took his money in their for-profit conversion.
Does Altman, in some respects, have reason to feel a little emboldened in all this? Because XAI, as you point out, has fallen behind OpenAI, Anthropic, and Alphabet too.
Absolutely, he does. And while OpenAI couldn't have started without Elon Musk, his $30+ million at the beginning is the reason why OpenAI exists today. They could point to what Elon's done in his own investments with XAI, and it hasn't held a candle to what OpenAI is doing today. OpenAI is generations ahead of XAI, and many watching this industry say that it's OpenAI, Anthropic, and Google, and then the rest of the pack. Is that going to stay that way forever? Maybe not, but right now, it doesn't look like Musk has been able to do much at all in this AI fight.
The other intriguing, certainly, battle, if you want to call it that, is Altman versus Amodei of Anthropic. Right, we remember the photo op in India. Everybody raises their arms, and these guys were like their arms were like the third rails. Like they're not even going to link hands. Right there's a good picture of it. They refuse to sort of link hands on that. I feel like I hear more people in and around VC and tech in general trying to make the point that Anthropic's stolen a little bit of thunder from OpenAI. Is that fair?
It is
to say that?
Yeah, definitely. OpenAI is chasing Anthropic right now. I mean, Anthropic got ahead of this. They built a coding tool which turned into effectively a personal agent for anybody using it, because you don't have to be technical to use Claude Code to get it to do things for you. And OpenAI is following that. They've built this Codex app, which is technical, but they're morphing that into a super app which anybody can use, and that follows what Anthropic is trying to do. So it really is head-to-head right now, because you could say previously OpenAI had consumer, Anthropic had enterprise. But now both use cases are converging into the super app agent-style use case, and it is basically 1v1 right now.
But it feels like Anthropic's has made bigger strides in the area of courting business customers. You see the story today that was in the Journal. Anthropic in talks to invest $200 million in a new private equity venture, continuing its push for business customers. This is how it feels like Anthropic has set itself a bit apart, going after, I would assume, higher dollar and higher margin customers.
So two different philosophies between these two companies in terms of how they go after enterprise companies. Anthropic always said, let's build for enterprise use cases, because if we are able to do that well, these are going to be the hardest use cases. We'll make the models better, and therefore we're going to win. And OpenAI said, let's build ChatGPT, once it started taking off, into this big consumer app. And then once it becomes popularized in a verb like Google is, then the people who use ChatGPT will bring it into their enterprises. And right now, both are building robust enterprise businesses. But I think if you look at it objectively, there's no way to say anything but Anthropic has a lead here.
Does it matter who goes public first? I mean, I feel like it's almost like you could kind of infer that it's imperative almost for Open to go first because of some of these questions that hang over that company.
I think it does matter who's going to go first. I mean, you think about the pool of money that's available. They're going to be fighting over similar pools of money. And then, we'll see what the narrative is, because the market is going to definitely believe that this AI technology can take off. But if the S1 comes out and it's a lot of smoke and there's not much, there's not a path to profitability there, that's going to be a problem.
I appreciate you as always. To be continued, we know that, because this drama's not ending anytime soon. Alex, thanks.
Thank you.
That's Alex Kantrowitz. Stocks near session lows. We head towards the close. We're off session lows, actually. The 8 p.m. deadline is looming. Coming up, Professor Jeremy Siegel. He games out various market scenarios next. We have news developing out of Washington. Megan Casella joins us now with the very latest. What do we know?
Scott, The Pakistani Prime Minister has posted on social media calling on President Trump to delay his deadline from tonight for an additional 2 weeks while calling for a 2-week ceasefire, he says, to allow diplomatic negotiations to continue. So in this post, the Pakistani Prime Minister says diplomatic efforts for peaceful settlement of the ongoing war in the Middle East are progressing steadily, strongly, and powerfully, with the potential to lead to substantive results in the near future. He goes on to earnestly request, he says, President Trump to extend his deadline for 2 weeks. He says Pakistan, in all sincerity, is requesting Iran to reopen the Strait of Hormuz for a corresponding period of 2 weeks, he says, as a goodwill gesture. And then finally, he urges all warring parties to observe a ceasefire everywhere for 2 weeks to allow diplomacy to achieve conclusive termination of war in the interest of long-term peace and stability in the region. Scott, no immediate response from the White House on that. That was just posted a few minutes ago. I just reached out to them to see if they have any response. We'll have to see if this moves the needle for either side.
One would have to believe, though, Megan, that this idea likely would have already been relayed behind the scenes, that we're all not learning about this, President Trump included, for the very first time through social media. Obviously, that's just a guess, I suppose. But on the idea, too, that theoretically you could suggest that maybe this would give the president somewhat of an out, that it's a third party trying to mediate this rather than the president being perceived as somebody who has backed off his threat on his own. What would you say to that?
I think that's absolutely right. The president is sort of between a rock and a hard place on this, making increasingly escalatory threats while also not wanting to be labeled for backing off again. So does he want to move forward with complete obliteration, as he said, or does he want to be ridiculed for backing off? This does give him sort of a middle path. We know throughout all of this, Scott, that these third-party mediators seem to be the ones that have been making the most progress. There have been mixed and conflicting reports even throughout the day today, but also for the past couple of weeks, as to whether and to what extent the U.S. officials and Iranian officials have been in actual direct contact. But we know these mediating parties seem to have been continuing even when there's been conflicts between the U.S. and Iran. Now we have the Pakistani Prime Minister. Pakistan's been one of the primary mediating countries leading those sort of intermediating negotiations, saying, how about we push everything for 2 weeks? Now the president could look at that proposal, which I agree with you, probably is not the first time he's hearing it, but he could point to that and say, we're seeing enough to allow me to delay things by another 2 weeks.
Yeah, part of this proposal, too, to reopen the Strait of Hormuz in the interim period as well. Megan, thank you. Megan Cassell at the White House. That last point important because as you take a look at, if we can, to intraday, both WTI and Brent, both have improved, albeit slightly. There you see just a move there at the very end of the intraday, a move off of the highs of the day. Let's call it that in crude. In fact, as you see here, Brent is now negative. Let's now bring in the professor at the Wharton School. He's Jeremy Siegel, also Wisdom Tree's chief economist. Welcome back. It's nice to have you.
Good to see you, Scott.
This is everything, obviously, right?
Yeah, I mean, the war is it. And that news about the Pakistani deal came out about 20 minutes ago. We had a 250-point rally on the Dow. I see four scenarios. I'll give them to you from best to worst. The best, of course, is in the next 3.5 hours, Trump tweets, we got a deal. You got a 1,000-point rally, and by the way, if it's a good deal, you're going to get all-time highs in this market through spring and summer. Second scenario is just what we've heard. Comes 8 o'clock, we got good negotiations, promisingly enough that I'm going to delay. Then you get what's called the relief rally, and in fact, we could have just had a little bit of that now, a couple hundred points, and hope springs eternal if that negotiations are going well. Third and fourth, the bombing starts, and you're going to see a big drop, I think, on that bombing if it does start at 8. But the response of Iran is going to be very important about where the market goes. If it's a weak military response, that anti-ballistic missiles are able to take down most of them, and it is not very, effective at hitting its targets, I think the market's going to creep back pretty strongly because that really shows that the U.S. Has the upper hand. If, and this is the worst scenario, if they have rockets that does damage significantly the oil infrastructure of the UAE and other Arab countries, then we got a lot more downside into the market. So
yeah, I don't think anybody.
It can be anywhere. It could be anywhere in between, and all those scenarios are probably going to be playing out in the next few hours.
Yeah, I don't think anybody would disagree with your sort of worst case scenarios should they come to pass. The hope, of course, is that they won't. Are you trying to allow yourself more and more to hang on to the idea? One may be a stretch, right? A firm deal, and then we race to these new highs immediately. But at least to point number two, a deal to delay or do whatever to avoid the worst case scenarios that you laid forward, and that in and of itself is going to be good enough for the time being.
Yeah, I mean, you could call it taco. It's not really a chicken. Now, if there really is progress, I mean, it did seem that there was some slight alteration of Iran's original demands, and Pakistan saying open that to being a neutral position in between, saying to Iran, that was hopeful. I mean, it was 250 points hopeful for the market. So, if that seems to be moving the chess pieces forward, you're going to get a relief rally, and see, what happens. So, I mean, right now, if I were to ask what is the most likely, it's probably that second scenario to play out. But we have to be prepared for anything. I mean, this is a very important geopolitical moment coming up. Now, in any case, and even let's talk about in the best case scenario, we do get a deal. Oil is not going to come down all the way back to 60 right away. There was damage. There is going to be still some risk premium in the market. But I think more importantly is we're going to have to build up our defense forces. I mean, I think Trump already has a $200 billion request in. It's going to go higher. Fiscal expansion. I don't think we're going to see the 10-year drop below 4. In that case, I don't see the Fed dropping rates. As you know, I was quite forward in advocating that early on. But given these developments, and also given developments where I see bank credit increasing and inflationary pressures increasing, I think we have to put on hold any cuts. I think it's going to be neutral for a while at best.
If we get back from the brink, so to speak, then we can get back to focusing on earnings and the economy. And then, oh, by the way, the fact that multiples have come in, too, which now make the market more attractive at a time where earnings expectations have held up, right?
Yeah. But one has to remember that the earnings estimates are not lowered. They're the last to be lowered because of macro events. The estimates are particular analysts that just look at the micro until a CEO says, listen, the consumer is slowing down because of higher oil or gasoline prices, so I'm lowering my guidance. That's when they're going to be lowering their numbers, and not until then. So, yeah, I do think there's been multiple compression, and certainly, I mean, some of the Mag 7 stocks like NVIDIA have been quite remarkable down to almost market levels. I don't think it's as much as the raw data suggests.
How about positioning when we come out of this? Because I think people are confused about what's going to work and whether what was working can still, or if the dynamic of the market itself has now changed, Professor.
Well, I think, one of the things, and it's something I've always been said, bonds are great hedges against certain types of risks. Great financial crisis, certain types of geopolitical risks. It was a great hedge during the pandemic. But it is a terrible hedge against anything that's an inflationary risk. And so, the 60-40 portfolio, in my feeling, is way too weighted towards bonds in that situation. Especially you're getting 4.25% with inflation, in that 3% region. I think this is more and more reason that 70-30 should become the benchmark, not 60-40. Of course, there'll be people who would argue with me, but once you have inflationary shock potential, that really lowers the attractiveness of fixed income, certainly as a long-term hold.
Well, I mean, 60-40 was off to a horrible start as, you know, stocks had rolled over and bond yields were rising. Now you've started a controversy, though, 60-40, 70-30, and that's to be continued. So we will address that at another time. Professor, I always appreciate your insights. Thanks so much. Jeremy Siegel. Next, we track the biggest movers into the close. The bell coming right back. All right, we have about 10 minutes or so, a little bit more than that until the closing bell. Market's been jumping around a bit as well. I just want to give you a headline to let you know where we are and why we're here at the moment, with the Dow now down 122 points that Reuters is reporting, according to a senior Iranian official, that Tehran says it's positively reviewing Pakistan's request for a 2-week ceasefire. Also saw some reporting that the press secretary at the White House, Caroline Leavitt, says that the president has been made aware of the offer as well, which we showed you from Pakistan's prime minister, and a response will come. So we'll continue to follow that, but it's obviously had a bit of an impact, as you see here on the markets, as we're way, way off the lowest points of the session. S&P 500 is back above 6,600. Let's show crude oil too, because it very well plays into this story. You can show WTI if you want on an intraday basis, which we continue to watch as well. So now, again, WTI is now negative as Brent had moved in the same direction within the last 10 to 15 minutes or so. We'll step away for a moment. We'll do the market zone next. All right, we'll go back to the White House and our Megan Casella, who has the very latest for us. A response from the White House, Megan?
Scott, that's right. This is a response to that proposal from the Pakistani prime minister for a 2-week ceasefire, a 2-week delay in the president's deadline from 8 p.m. tonight. White House Press Secretary Caroline Leavitt telling me, quote, the president has been made aware of the proposal and a response will come. So more to watch on that. And then separately, Scott, also just in the last couple of moments, a senior Iranian official told Reuters, also reacting to this proposal, that Tehran is positively reviewing Pakistan's request for a 2-week ceasefire. Now, Scott, remember there were 3 parts to this proposal. It was the delay in the deadline for 2 weeks, a temporary ceasefire everywhere for 2 weeks, and also reopening the Strait of Hormuz for 2 weeks. So both sides possibly now looking and possibly having some positive reaction to this proposal. More to come.
All right. Extremely fluid, as we know. Megan, thank you so much. It's our own Megan Casella there on the north lawn of the White House. We're in the market zone. Mike Santoli is going to give us his instant reaction here. Rick Santelli is going to join us live from SIBO on big oil options activity today, and we'll chat as well with Kevin Simpson and get his thoughts on the market too. Michael, let's begin with you. The market's on edge. Obviously, it's going to move on anything that is perceived to be either positive or negative, and we're witnessing that in real time.
Right. So intraday, we're just sort of turning the dial from de-escalation to re-escalation based on incoming info. It's pretty narrow range altogether. I don't necessarily view any of these thresholds that we're crossing and crisscrossing as super consequential, except I do think it's relevant that the indexes are trying to make use of this cushion that was built up versus last week's lows and perhaps be a little more selective in terms of what's working and what's not, almost treat it as, let's figure out if in fact we want to own some things or not on the other side of all this. I'm not sure if 2 weeks, if it's just a delay and we have more suspense built up over that time, is necessarily a true escape from this trading pattern, mostly because I don't think getting more oil out of the Gulf, but not necessarily having new supply, kind of loaded in is necessarily going to be magic for much lower oil prices. But obviously it's constructive if it means that there's progress being made.
Yeah. Michael, we'll see you at the very top of the hour. Just give me real quick an idea of what you have coming up.
From a different angle, are semis a place to actually hide here? And we got Dan Niles to talk about that.
All right, good stuff. We'll see you then. That's Mike Santoli. Let's go to Rick Santelli live from the SIBO Global Markets in Chicago. Hi, Rick.
Hi, Judge. Yeah, I'll tell you what, today's a big day, obviously, and many are watching oil to get a cue for what's going on. And to that end, I picked a stock that should reflect what's going on in the energy complex, ExxonMobil. Right now, the price is around 163 and change. So let's look at 170 calls, 160 puts. If you're bullish and you think it's going higher, crude oil prices are going to 125, probably want to call. Right now, the price is at about $1.50 times 100. You're paying about $150. Which means your break-even price is right around 170, 150. But if you think it's going lower, 160 put. Right now it's going for about $2.60. $260 is your cost. That's 100 shares, of course, and that will come out to a break-even of 157.40. Go either way. Do both. They call that a strangle. But in the end, pick your direction because most likely you're going to see follow-through one way or the other. Scott, back to you.
All right, great insight, Rick. Appreciate you. Thanks. That's Rick Santelli at the SIBO. All right, Kevin Simpson, inside the mind of a trader, a portfolio manager, all the above, because you wear all the hats. Just give me inside your psyche. It feels like what right now?
Yeah, well, I think you and Lizanne, the conversation you had at the start of the show really nailed it. We absolutely don't know what's going to happen this afternoon. We don't know what's going to happen this evening. Market chatter all day was that we should expect a tweet, a life preserver, some kind of negotiating tactic before the market close. Maybe the news out of Pakistan was just what the market ordered, or maybe what the doctor ordered. But I think the difference here, Scott, for everyone watching is the difference between active and inactive management. If you're passive, if you're in an index fund, there's nothing you can really do. I mean, you're going to go with the ebb and the flow of the market. There's no positioning that you can really take in anticipation of whatever the outcome may be. For us, we've been trimming some strength. We've been adding to some weakness. We've been holding dry powder. So whatever happens tomorrow, if oil rips, we'll continue to trim energy. If the broader market rips and the market's accelerating, that would be wonderful news, and we'll be able to write calls over top of the portfolio. But for us, it's really about positioning, preparation, and for traders, it matters a great deal what happens to the news cycle this evening. For longer-term investors, I think it's all about how you take advantage of these moves over the next 2 days.
If we in fact do get agreement on this proposal from the Pakistanis, are you a buyer of this market in that scenario immediately?
No, I think if that's the case, we'd be writing calls across the portfolio. I would imagine there'd be some kind of relief rally tomorrow, Scott. If anything, energy would pull back, and if you're not allocated there, you could certainly pick up some energy names. But I think tomorrow you're a hedger or a trimmer maybe not a buyer on good news.
Why so?
I have 10% cash in the portfolio so that if you get bad news and the broad market goes down, that's when I want to be buying. But I think on good news, you're built in a lot of it. Like if you look at the reaction to the market today, I'm surprised about how tepid it's been responding. And I think a lot of that must be in large part that we're expecting, if nothing else, at least a kick of the can, and maybe a 2-week kick of the can would be really what the market was kind of thinking in its daily preparation. But other than that, I would have expected there to be a much more severe reaction with today's tape, and we just didn't see it.
Well, if I could say that, well, a kick of the can in your words, whether it's 2 weeks or whatever, this is ultimately more than likely going to lead to some kind of a deal. If not, obviously, all bets are off. But if I think that that's going to happen, why wouldn't I just get back, as I spoke about with Lizanne, that you watched? Earnings, the economy, and compression in multiples that makes stocks even more attractive than they were before.
Yeah, I mean, if you're going to be a buyer, I think you want to follow the underperformers. So you can look at software, you can look at technology. I definitely think that the earnings are going to be really good this quarter. The problem is if we have this continuation of higher energy, that's going to reflect in earnings for next quarter. Maybe we see some of that in the guidance right now. There are buying opportunities. I mean, we added to Palo Alto.
Kev, we'll talk to you soon. Thank you. That's Kevin Simpson joining us. Interesting. Bell's going to ring here, and we are going to attempt a positive close for the S&P 500 and the NASDAQ. Dow's got a little bit of work to do, but it's a different picture. The deadline is looming large. I'll see you tomorrow.
The bell's bringing an end to the trading day at the NYSE. Voya Financial ringing the bell, and at the NASDAQ, SS&C Technologies doing the honors. Welcome to Closing Bell Overtime, live from Studio B at the NASDAQ market site. I'm Mike Santoli. Melissa Lee is off today. Well, stocks closing well off their worst levels of the session. The Dow is down 450 points at the low of the day. The S&P 500 and the NASDAQ turning slightly positive in the final minute of trading. Coming up, we'll get the latest news on negotiations with Iran, which are helping stocks recover, plus the impact on oil and all of the big market movers, including Apple. Our team is all over every side of it. Also on our radar at the close are chip stocks, a good safe haven to hide in while politics cause stock volatility. Dan Niles joins us to talk about that. Earnings season is about to get started. We'll hear from Levi's in just a few moments, and Delta reports tomorrow morning. We'll get a preview of that one. But let's begin with Megan Casella with the latest from the White House. Megan.
Mike, some really fast-moving pieces just in the last hour or so on this, starting with a proposal in the last half hour or so from the Pakistani Prime Minister suggesting that everything essentially be put on pause for another 2 weeks as a diplomatic solution is worked out. There are 3 parts to this from the Pakistani Prime Minister. President Trump would extend his deadline from 8 p.m. tonight for another 2 weeks. Iran would reopen the Strait of Hormuz for a corresponding 2 weeks, and there would be a ceasefire everywhere for another 2 weeks. Now, I reached out to the White House about this, and White House Press Secretary Caroline Leavitt told me that the president has been made aware of the proposal and that a response will come. Separately, we also heard that a senior Iranian official told Reuters that Tehran is positively reviewing Pakistan's request for a 2-week ceasefire. Previously, we had heard that the Iranians were not interested in anything that was amounting to a temporary ceasefire. They were pushing only for a permanent solution, now possibly looking at this view positively. So, Mike, this is the most movement that we've seen in hours on this, as we are just about 4 hours now from the president's 8 p.m. deadline. Mike?
Yes, I guess, Iran giving that comment, they are positively reviewing this. I guess that's not necessarily an affirmation that they are they're game to reopen the strait for 2 weeks. And before all this, obviously, there was a lot of kind of brinksmanship, and there were also additional attacks, right? I mean, we did have some action from the U.S. side on Kharg Island and elsewhere.
That's right. Throughout the day today, overnight, last night, the rhetoric was increasing, but so were the actions. A White House official confirmed to me this morning that the U.S. military did target military targets on Kharg Island overnight. It's key, though, that they were military targets, that they weren't broader oil infrastructure targets, no sorts of civilian targets yet. That's what, of course, the president is threatening to do as of now, as of 8 p.m. tonight. He says he'll do that unless they agree to this deal. So for now, though, they are still targeting Kharg Island, but it wasn't for the first time in this war that they had done that. that. So it was some increase in actions, but for now, kind of keeping things temperate through the afternoon. And now in these final few hours, I think, Mike, it's very likely we get a lot more from this building and from overseas as both sides start to digest and really think about this proposal.
Yeah, well, we'll listen for it. Thank you, Megan. Let's get to today's market action and Christina Partsinevelos. Hey, Christina.
Well, markets closed with a risk-off tone as investors really watch those headlines out of the White House. You have Iran, and volumes normalizing, though, after yesterday's really sluggish session. It was actually the slowest day of the year thus far. The Nasdaq finished slightly higher despite an almost 3% drag from Apple, a big weight there, 2% I should say now. Broadcom surged roughly a little bit over 5% after locking in an expanded deal with Google and Anthropic of roughly 3.5 gigawatts of Google AI chips for Anthropic starting in 2027. Also, a supply agreement with Google running through 2031, so long term there. Mizuho sees Broadcom pulling in roughly $42 billion in AI revenue from Anthropic alone just next year, so that's why shares climbed 6%. Intel also climbing over 4% after joining Elon Musk's Terafab project with Tesla, SpaceX, and xAI, targeting 1 terawatt of compute annually for AI and robotics. Though the full scope of Intel's role is still unclear. There was no press release, so we'll see with that. Axon, another name, plunging roughly 10% to a new 52-week low. Its fifth double-digit drop in 6 months with no clear catalyst. This is a maker of drones as well as body cam equipment. Home builders also fell after Seaport downgraded the sector on weak job growth and softening demand within the housing sector. And then you also had health insurers that moved in the opposite direction, up. United Health, for example, closing 9% higher, its best day since August after the Trump administration locked in a roughly or almost 2.5% Medicare Advantage payment hike for 2027, Mike.
All right, Christina, thank you. Well, Apple, one of the worst performers in the NASDAQ 100 today. Mackenzie Sigalos looking at the latest potential issue for that company. Matt.
So, Mike, it was conflicting reports on what could be one of Apple's biggest iPhone launches in years that left the stock in limbo today. First, Nikkei Asia cast doubt on Apple's ability to debut its highly anticipated foldable iPhone this September, reporting that the company is running into engineering issues during the test phase and that suppliers have been told to brace for delays, really throwing into question whether the device can launch this fall alongside the iPhone 18 lineup. But then a few hours later, Bloomberg contradicted that report, saying that the foldable phone is still on track for a September release, even if initial supply could be tight because of the complexity of the new display. That helped the stock come off its worst levels. And Mike, the stakes here are high. This is Apple's first foldable phone, one of its biggest device swings in years, and it's expected to retail for more than $2,000. Crucially, it could also give Apple a fresh premium product at a time when the company is trying to keep momentum going in China and prove that it can still generate real excitement around new hardware. Mike?
Yeah, Mac, it was interesting. Obviously, for much of the day, a lot of stocks were down, but the volume in Apple was actually much heavier than average. And so that does say that there was some reaction to this news or this set of reports that seemed to be weighing on the stock. On the other hand, hard to avoid the fact that Apple up to today had been a kind of an outperformer because it does sometimes, behave pretty defensively within the tech sector.
That's a great point. It had been the best performer of the Mag 7, although they all were in the red year to date. And part of that is a lot of optimism around its AI strategy, hopefully coming to bear around its developers conference that's coming up in June. But the iPhone, this foldable iPhone, has been one of these big device swings that people were already baking into potential upside in terms of a new lineup. And remember, foldable iPhones are a very popular product in China, and Apple finally saw this major rebound in Greater China in fiscal Q1 2026, revenue surging 38% year over year. So there's this expectation that they could see even more upside from that going into the fall quarter.
Yeah, exactly. No, there's no doubt that the foldable phone had become a bullish talking point going into the summer, and this idea maybe it could kickstart the upgrade cycle and all the rest. So see how that goes, Mac. Thank you. As stocks rebounding from their lows of the day, oil fell from its highs. Pippa Stevens looking at all that for us. Hi, Pippa.
Hey, Mike. Well, the futures market is not telling the whole story. because dated Brent hit $144.42 per barrel today. That is the highest nominal level on record, according to S&P Global Energy. And this is the price based on actual bids, offers, and transactions, and so is more telling than futures prices. Meantime, Saudi Arabia raising its selling price to record premiums, setting May loadings of its Arab light crude heading to Asia at $19.50 above the benchmark. That's up from $2.50 in April, according to Gulf Oil's Tom Closa. Now, Asian buyers are increasingly looking for Atlantic barrels, which is leading to reshuffled energy flows, with WTI tightening into the global system. Some U.S. Midland cargoes are now going to South Korea via the Panama Canal. That's based on data from Kepler, a route that hasn't been utilized for at least a year. Now, product prices remain extremely elevated, but with the jump in spot crude prices, refiners now have to absorb those higher costs. And so just as the system needs more fuel products, refiners might have to start cutting their runs. Mike?
Yeah, it's such a kind of intricate chain reactions all throughout here, Pippa. And obviously, we're just getting these possibilities of a 2-week ceasefire, and maybe that would come with Iran allowing traffic through the strait again more, in a more complete way over that period of time. And I wonder if we could just game out what a 2-week reopening would be if it were only 2 weeks. It seems like it would just sort of clear some product that was already loaded, but it's not necessarily like it would kickstart, production again and get the whole system back in gear.
I think that's exactly right. I think a 2-week pause could definitely get some of the tankers that have been loaded and sitting in the Persian Gulf cleared out, and that will definitely help ease some of the tightness in the global system. But 2 weeks is essentially no time in terms of the global shipping industry. When you just think about how long it takes for a tanker to route around the world, it's going to take far more than 2 weeks to get those tankers back in position. And if you also look at some of the factors that have hampered flows, and insurance, of course, is one of those. If you have a 2-week pause with no real clarity what happens after that, you're not going to see insurance providers willing to insure these tankers. Are definitely going to take a wait-and-see approach and wait for there to be more clarity. And then finally, I would add that once you restart production at some of these fields, it's a gradual ramp up. And so you are not going to think about restarting if it's only for a temporary 2-week period, because then it's even more difficult to then wind it back down with the ultimate goal of re-ramping it up once flows have normalized. And so when it comes to energy markets specifically, 2 weeks could help clear some of the backlog in the Persian Gulf, but not much beyond that, it would seem.
Yeah, it would seem only if those 2 weeks were used to actually create a more lasting resolution would it be, really reassuring to all the markets. Pippa, thank you very much. Levi Strauss earnings just out. Gabrielle Fonrouge has the numbers. Gabby.
Yeah, so Levi Strauss reporting top and bottom line beats for Q1. Adjusted earnings per share came in at 42 cents on sales of $1.74 billion. Sales grew by 14%, but only about half of that was from units. The other half was related to price increases Levi implemented during the quarter. Now, given this strong Q1 beat, Levi also raised its full-year guidance, which was a beat on the top line, but a bit light on the bottom. I spoke with CEO Michelle Goss and CFO Harmeet Singh just before the release, and they said tariffs and higher costs are still weighing on EPS. However, it has not factored in the recent tariff rollback into its outlook, which still assumes a 20% rest of world tariff. If the new 10% tariff stays in effect, that could benefit earnings by $35 million or 7 cents per share. The company could also be refunded as much as $80 million. Now, as far as higher gas prices, Goss told me that the company has not seen any pullback on spending. She said they're well balanced across all consumer segments and, quote, feeling really good about the consumer. Mike?
All right. Market taking it as pretty upbeat. Gabby, thank you. Well, Levi's CEO will break down those results in an exclusive interview tomorrow at 10:30 a.m. on Squawk on the Street. While stocks did move higher into the close on renewed hopes for a ceasefire, the S&P 500, NASDAQ, and Russell all closing in the green. Small gains, but big bounces from the early morning lows. Joining us now is Vital Knowledge founder Adam Crisafulli and Wells Fargo head of global market strategy Paul Christopher. Guys, welcome. Adam, I think the big question is, the reactions make sense in response to headlines. I think the big debate is over what's already baked in with markets at this price, at this level, up off the lows. We really didn't get even a full flush of a correction before this. So what's your read on the risk-reward balance here?
I think if the Pakistani proposal that we saw in the last, half an hour, if that were actually adopted by both sides and genuinely implemented, I think you'd see a pretty powerful rebound rally. I think there's still a lot of anxiety out there in the marketplace about the war continuing and the fallout from the war. And we're already going to see a pretty substantial fallout just in the last 5 weeks, even if things ended today. But I think that if you were to actually see that adopted, a 2-week ceasefire, 2-week reopening of Hormuz, and then presumably more negotiations, I think you'd see a pretty powerful rally over the coming days. So we'll have to wait and see.
For sure. That is the rule. All we do here is wait and see and fixate on the same issues. Paul, though, I wonder what your take is in terms of whether another 2 weeks, if that's what we're going to get, is going to create any wear and tear on the underlying economic story, or are we still in that window when, if we have some kind of resolution, the fundamentals can withstand it?
Oh, no, it will absolutely, Mike, be a friction for the economy. Look for that in that CPI report later this week to maybe post a month-on-month gain of 1%, potentially a little bit more than that. Again, that's going to be a friction for the economy. What we don't want to see is oil up at $175, $200 a barrel for any extended period. That's when we start to believe that oil could start to undercut the constructive fundamentals that we see for this year.
And so what would be your recommendation, Paul, in terms of how an investor behave through all this? Is it just kind of close your eyes and sit tight, or are you looking for parts of the market that have gotten dislocated and are worth getting into or out of?
Yeah, we definitely don't think that this is the end, and the 2 weeks is just another postponement. We feel much better about buying this overall market if we saw stocks, below 6,500, the S&P below 6,500 again. That's where we think it would be closer to a bottom than it is right now, with sort of hopium still running through the veins of the market. So yeah, we would not be big buyers. We're not going to back up the truck here, but for a long-term investor, it's really a good opportunity to rebalance a little bit and look for those markets where we think there's not much more upside, trim there, and put that money into markets where we don't think there's much more downside. And I can give you a couple of examples.
We will get those examples in just a moment, but for right now, we want to show you Ptarmigan Media ringing the closing bell at CBOE in Chicago. That ends the regular trading day for options. Paul, we'll get to you in a second. Adam, I guess it's interesting to have this push-pull because I think it crystallizes things. Paul's suggesting there's still hopium in the market. You're thinking that people are still a little bit downbeat and there would be upside surprise to resolution. I wonder if we're just talking about, within a band, right? We have been in this range from we hit a low of 6,300 in the S&P. The all-time highs were in late January were 7,000. How far does a relief rally carry us, Adam, if we do get one?
I don't think it would be too significant. Remember, we were struggling with 6,900, 7,000 before Iran started. So that's going to be even stronger resistance, even if there is this 2-week ceasefire that gets agreed to. So a couple hundred points on the S&P, it's not massive on a percent basis. So definitely kind of short-term just relief rally. And then I think, we're going to have to deal with the fallout. We're going to see this showing up in the economic data for months to come. Companies are going to be acknowledging it on their upcoming earnings reports. So, there's definitely going to be, at least a pretty substantial impact for a quarter or two, even if everything were to resolve itself in the coming weeks.
Yeah, I suppose it's a big adjustment relative to what the consensus was expecting in the first part of this year coming in, right? Atlanta Fed for first quarter GDP is under 1.5%. We're probably not getting Fed rate cuts, at least unless something changes a lot. So, Paul, you mentioned some areas you think it's worth kind of adding to or subtracting from. What might those be?
Yeah, so let's start with one of the bigger ones. We think crude oil is way overshot. It's up 33% on the year, but in information technology, down 7%. That's a net 40% differential. If you look at tech, it's got a valuation right now, a price divided by 12-month ahead earnings that's roughly the same as the composite market. And at the same time, tech's expected earnings running closer to 35% for calendar 26 versus 18% for the overall market. So you've got one market that's oil, it's really overpriced, another market that looks really attractive and cheap to us. Earlier this week, we made the move in guidance to say, let's trim long-term investors, let's trim from oil or energy stocks, and put that into information technology.
All right. Yeah, we'll see how that goes. I have to say, I hear you on tech looking inexpensive relative to the market, but we just came out of a couple of years with everybody saying, yeah, tech trades at a big premium, but that's because the market knows the earnings are going to be so great. So we'll see, where the disconnect might be as we get those earnings flowing through. Guys, we'll have to leave it there. Thanks for the time today. Adam Christopher, Paul Christopher, appreciate it. WTI pulling back from its highs of the day, but still around $112 a barrel, getting closer to the highs it touched after the outbreak of the Iran war. President Trump trying everything to get the Strait of Hormuz to reopen. Our next guest, though, says if his efforts fail and the strait remains closed, the oil market could see severe consequences. You're watching Closing Bell Overtime, live from the NASDAQ Market Center. Shares of Casey's General Stores falling today despite the stock being added to the S&P 500. Now, typically, stocks will get a boost on the news because index fund managers will have to buy the stock in order to match the index, although Casey's did have a very good run leading into today, year to date. Analem Pharmaceuticals and Marvell Technology, they were lower today as those stocks were viewed as potential additions to the S&P, but got passed over. The opening in the index was created when Hologic was acquired by private equity. And oil now down from its highs earlier today, hitting $117 on WTI, up nearly 70% since the war in Iran started. Prices soaring on President Trump's stated 8 p.m. deadline for an Iran deal before further attacks might be launched. Of course, we had word of a potential ceasefire since then. So where does oil go from here? Our next guest says U.S. natural gas hasn't kept pace with the global gas rally because of robust domestic supply. A separate issue, an incremental export capacity is also limited. He's lowering his 2026 U.S. price view on a return to surplus. Now, with me now is Francisco Blanch, head of commodities and derivatives at Bank of America. Francisco, it's great to have you. Just love initially your reaction to, this report. We maybe get a 2-week break. Let's see if oil flows out of the strait. Does that adjust your view of what's priced into oil and where it could go?
Hey, Mike, thanks for having me. So it doesn't really change our view that much. We've been saying, and we moved our forecasts on Wednesday last week. We said if the war lasts for another 2 to 4 weeks, we will see an average Brent price of around $92.50 a barrel, WTI maybe $5-7 lower. So that's our baseline. And again, we've averaged slightly under $80 in Brent so far this year. So if again, 2 more weeks of extension and we have a ceasefire, I still think we're going to have relatively high prices for the rest of the year. We have to reshuffle global flows quite a bit. There's a lot of oil stuck in different parts of the world where it doesn't need to be. And of course, as you know, we still have potentially a lot of physical infrastructure that may have been damaged, and we don't quite fully know the story yet. Plus, there is, of course, Ukraine also taking down some of the Russian energy export capacity in the past week. So those are some of the issues that we have to contend with. So I think we'll probably be in a $90 environment for most of the year into, I think, probably the fourth quarter at this stage.
2 more weeks seems to get us pretty close to, the imagined date or the projected date where it really was going to be causing more lasting disruption. I mean, I know that you've cited this where it's going to be rationing throughout parts of the world and things like that. Is there a sense in which waiting another 2 weeks could be counterproductive?
Well, to the extent that this 2 weeks allow for more vessels to get through the strait, and we've seen already maybe a little more flow. We saw this morning Iraq potentially getting a pass on flows. Remember, Iraq has been until now one of the biggest losers with 3 million barrels a day of exports offline. That's a lot of money for the Iraqi government and the Iraqi people that needs to be recouped. So that seems to be moving forward. And I think, look, and anything that gets more vessels moving will help temper the price appreciation. But I don't really want to sugarcoat it too much because today, dated Brent, traded at record levels. So even if you see the future market down a little bit today,